Please make your way to your seats. Our program is about to begin. As a courtesy to fellow guests and speakers, we do ask you please turn your cell phones and other portable electronic devices to the silent mode. Again, please be seated. Thank you. Please welcome to the stage your host, Natalie Brunel.
Welcome to day 2 of Bitcoin for Corporations. Bitcoin decided to wake up this morning, so maybe it's the strategy world pump. We've got such an exciting day of panels and talks in store for you, and we want to give a thank you to our room hosts today, Latham and Watkins. Also, if you haven't done so already, we encourage you to submit questions for Michael Saylor and Phong Lee. We're going to be doing an interactive Q&A this afternoon. That's going to be at 4:45. So you still have time to submit your questions by scanning that QR code. And we're going to kick it right off with 2 fantastic speakers. Our first session is going to be Bitcoin adoption trends with Alex Leishman, the CEO of River, followed by Bitcoin for Corporations adoption update with George Mekhail, Managing Director, Bitcoin for Corporations. Welcome, Alex, to the stage.
Thank you, Natalie. Let's see, just get to my slides. Okay, good morning, everybody. Nice little Bitcoin price bump today. It's great to be back at my 4th Bitcoin for Corporations conference. I'm the founder of River. At River, we make it easy for individuals and businesses to buy, sell, and use Bitcoin. And this morning, I'm going to present some data that our team has put together, synthesizing both public data and proprietary data that we have at River to go over Bitcoin adoption trends from 2025 through the beginning of this year. So, as you've probably noticed, we're in a bit of a bear market. The Bitcoin price is down about 40% since the beginning of 2025. But this is one bear market of many in Bitcoin's history. And it's one of the smaller ones. We've been through many before, and we'll be through more in the future. But this bear market is unique. It's actually very different when we look at the data. And what's unique about this bear market, it is the first bear market in Bitcoin's history where we are seeing an acceleration in the institutional adoption of Bitcoin. If we look at who's purchased Bitcoin in 2025, it's overwhelmingly institutions. Businesses, funds, and governments have been net accumulators of Bitcoin in 2025, and they've purchased this Bitcoin from individuals who have been the net sellers. And if we look at this trend over time, we see something pretty interesting. Bitcoin's ownership was overwhelmingly dominated by individuals in the first half of its life. And around 2020, around the time Michael Saylor and MicroStrategy started opening the eyes of institutions, businesses and other institutions started buying Bitcoin, and this trend has continued to accelerate. So this chart shows the proportion of Bitcoin owned by by individuals and businesses. And if we extrapolate the change in ownership from 2025 linearly out into the future, which may or may not be valid, but it's an interesting exercise, we see that by 2035, half of Bitcoin might be owned by institutions. And this is driven in large part by the popularity of Bitcoin now on Wall Street. Over 60% of top US banks are building Bitcoin products. Citi, Bank of America, PNC. Over half of the top US hedge funds have Bitcoin allocations. And 90% of the top RIAs in the country have Bitcoin allocations. In the last 2 years, 2,000 investment advisors have made Bitcoin allocations. So if we step back, we can see the impact of the institutional arrival on Bitcoin by breaking out capital inflows during the different market cycles that we've seen over the years. In the 2015 to 2018 market cycle, the capital inflows to Bitcoin were almost entirely individual driven. In the 2018 to 2021 market cycle, again, this was a lot of individuals buying their first Bitcoin and some institutions starting to enter the market. And in this last market cycle, it was overwhelmingly driven by institutions, and we can see this based on the magnitude of capital that entered the market. Now, a chunk of this capital is from registered investment advisors, RIAs. And an interesting trend here is in the last 2 years, every single quarter has seen an increase in the amount of Bitcoin held by RIAs. But the percentage of Bitcoin held by investment advisors is still a tiny, tiny, tiny fraction of all of the investments that they manage. So only 0.006% of assets managed by investment advisors is allocated to Bitcoin. But the top investment advisors in the country are recommending often single-digit percentage allocations, with Fidelity recommending up to 5% allocations. So I expect capital inflows from RIAs to continue to accelerate over the coming years. Businesses have also been a major factor in the capital inflows to Bitcoin in this market cycle. In 2025, during a down market, we saw record business inflows into Bitcoin, which is pretty remarkable. And these inflows dwarf any inflows from previous years from businesses. And these inflows have been dominated by a lot of treasury companies accumulating Bitcoin, a lot of people you've heard from yesterday and who you'll hear from today. But a very interesting trend is that we are seeing a very steady growth in conventional businesses accumulating Bitcoin as well. Another interesting trend is the amount of merchants accepting Bitcoin payments. We've seen a very steady growth here and an acceleration since Square unlocked Bitcoin payments in their merchant product. And in our own data at River, we saw a more than doubling of our business client base last year. We serve a lot of small and medium-sized businesses, real companies, real Main Street businesses accumulating Bitcoin. And you can see a breakdown here. We serve anyone from churches to trucking companies, farms. One of my favorite ones is a hot dog stand. And the trend here is that despite the Bitcoin downturn, we've continued to see very strong growth. And something that these businesses have in common is that they're typically controlled by one or a small number of people who are just key decision makers in this business. They themselves are Bitcoiners, and they've decided to make this allocation for their company. And we've surveyed these business owners. 63% of them plan to hold Bitcoin indefinitely, which I think is pretty remarkable. These are real operating business owners buying Bitcoin to preserve the wealth of their business for the long term with no plans to sell. So in summary, the data we're seeing is very promising. I think this market downturn is temporary, and I think the next market cycle is going to continue to be overwhelmingly driven by institutional adoption of Bitcoin, both operating companies and investment assets that are still yet to be allocated to Bitcoin. And I want to leave you with an interesting graphic. This globe here is a visualization of all merchants around the world who accept Bitcoin. And I expect that next year, this slide will shine a lot brighter. So I want to thank everybody, and I'll see you next year.
Good morning again. Good to see you all. My name is George Mekhail. I'm the Managing Director of Bitcoin for Corporations. And today I want to take a look at the year of 2025, which was a wild ride. I'm not sure if you guys noticed that as well, but our mission at Bitcoin for Corporations is to accelerate corporate Bitcoin adoption. And I think as you just heard Alex share, that definitely took place in 2025. More corporations are adopting Bitcoin. We're getting closer to a Bitcoin standard. You know, the goal is to make Bitcoin like gold once was, but a better version of it. So today I want to ask the question, what did happen in 2025? It was a little bit chaotic, we know that, but I want to try to filter the noise a little bit and take a look at what's actually happening with adoption by reflecting on the facts, what actually happened. The goal here is clarity, not hype. And so I want to do this by looking at a report that BFC just published. This is our first annual report on corporate Bitcoin adoption. If you haven't had a chance to take a look at it, you can download it online. We synthesized basically some key insights from 2025, and let's look at some of the facts. So first of all, 1 year ago, there were about 90 public companies that were holding Bitcoin on their balance sheet. The start of 2026, that number is closer to about 167. Some figures put this closer to 200, depending on kind of what source you look at. And corporate holdings grew 73% year over year, with about 500,000 Bitcoin added to balance sheets in 2025. So there was basically this Cambrian explosion of Bitcoin treasury companies that came onto the scene. It felt like there was a new one announcing every single week. Like we were just starting to get to know Simon and Metaplanet, and it was like, all right, here's 80 more companies. So this is kind of a look at what the adoption looked like month over month. You can see that blue bar is strategy, and everything else is all the other companies. But it was a lot. It was a lot to take in. And at Bitcoin for Corporations, you know, we saw that growth reflected in what we were doing. At the start of last year, 657 Bitcoin on corporate balance sheets, representing about 3% of the total supply. We're now over 1 million Bitcoin with over 5% of the supply. So I don't need to kind of drill down too much on that. Alex did a great job of sharing what that looks like. But basically, you know, here, this is trying to just contrast what actually happened compared to sentiment. And, you know, despite the growth, there were some challenges, and it's important to address those and you know, take them head on. There were companies that ceased or pivoted entirely away from the strategy. Some were forced sellers. And so, you know, for me, getting a chance to know a lot of these executives and how they think and how deep their conviction is and where they're actually trying to take this strategy has been really insightful. I think one of my favorite stories is Prenetics on this list. Prenetics is a non-endemic company. They're a healthcare supplements company backed by David Beckham. Great business, a lot of revenue. You know, started buying 1 Bitcoin per day, and eventually, you know, their healthcare business was growing faster than sort of the returns on their Bitcoin strategy, and shareholders demanded that, let's focus on reinvesting into the business. And so that was a pivot that, there's no judgment. There's no we're not mad at Danny. Danny's a great guy. He's the CEO. And I think part of one of the insights is we've gotten to build a relationship with these companies that really, they don't come at this from the perspective of, I love Bitcoin and, Bitcoin is the best thing ever. I should start putting it on my balance sheet. They're starting to hear about it. They're starting to learn about it, but they don't have that deep conviction that, Saylor and Phong have, where they understand that this is the digital gold rush to that degree. And so we're here to help kind of guide them and educate them. And when the market turns and shareholders are like, hey, what about that Bitcoin thing? Danny's going to pick up the phone and he's going to call us. So and it's funny. I was listening to Saylor yesterday, and I'm like, man, maybe I need to reach out to Danny and tell him about Stretch. I think that's probably the new play. So Bitcoin, unfortunately, last year was the worst performing major asset. Silver, gold, everything outperformed Bitcoin by quite a lot. So if you're a Bitcoin maxi, I know that's not fun to hear, but it's the truth. And so it's interesting, though, that despite the performance of Bitcoin, corporations continued to add year over year 73% growth. I think that's the real headline coming out of a year that I think ended in a way that was challenging. In 2026, we're up 4K today, and we'll see where things go. But definitely bullish on this stat. I think this is the real signal that corporations that have deep conviction continue to stack. They understand what's going on. They're not looking at price. They're looking at a different leaderboard. And so the growth of the ecosystem, again, is reflected in the growth of Bitcoin for corporations. Our network last year, when we came to this event, we had 13 members. Today, that's over 41 members in about 15 different countries. We have signed on for another 5 years with our partnership with Strategy, and so they're definitely committed to continue growing the ecosystem and resourcing these companies and helping them along the way. This is a look at the top 10 Bitcoin for corporations members and kind of how they stack against every other company. Right now, our membership represents about 69% of all public holdings of Bitcoin, not counting the ETFs. But these are CEOs and executives and teams that again, believe in this mission and are stacking because they know that Bitcoin is a scarce resource and that we are in the middle of a digital gold rush. And so I'm excited to see kind of where this goes at this stage of the market. We've been having conversations with companies who have been developing their Bitcoin strategy, getting approval from their boards. And actually this drawdown has been a blessing for them because so far they've raised their capital, but they haven't deployed yet. And so they're just chomping at the bit. So again, this is what's actually taking place despite of the price action. We also saw mergers and acquisitions, Strive acquiring Semler. We saw the completion of the company that I work for, BTC Inc., becoming acquired by Nakamoto. And so that's exciting for me personally. I'm now part of a company that's putting our money where our mouth is and building our own treasury strategy. And I think what is ahead for us, that means we're going to be able to have more resources to be able to scale faster and bring this mission to different parts of the world. And so again, just to kind of recap, the conviction class to me is this group of executives who are continuing to come, continuing to show up, continue to get to know each other, resource each other, help each other. They have a strong financial incentive. They have a duty to execute the strategy that they have put in front of shareholders. And so the reason that's bullish for me is because they're not paper hands. They're in this to win. And so they're unfazed. The conversations that we're having here at this conference, there's actually excitement. Even before the 4K pumped, people were excited about kind of where things are headed. I was just talking to Sam Callahan backstage, and he's just like giddy. He's just so excited. And so I think, again, coming to events like this, you get to pick up a little bit on the signal. And one of those things, this is kind of the theme of the week here, right, is the birth of digital credit. And basically, this came out of nowhere. This is a brand new market class. I mean, 6 billion market cap total at the end of the year, delivering 370 million in dividends. And so it's crazy to look at the innovation that just emerged out of nowhere. A year ago, this literally wasn't here. Now it's a $6 billion industry. And I love coming to Strategy World. Genuinely one of my favorite events because you get to run into people that are coming from all different kind of parts of both the Bitcoin ecosystem, but also business intelligence. You get to kind of reflect on how massive strategy is as an operating business. And I was hanging out last night for a little bit at XS. Don't worry, I went to bed at a responsible hour so I could be here. But I was having this conversation with a guy who showed up. He's one of Strategy's clients on the business intelligence side. And he was telling me just how excited he was about Stretch of all things. So he came here to learn about the new business intelligence software that Strategy was delivering. And he's leaving now knowing that he can earn 11% on his money. He's telling me, he's texting his buddies like, you got to do this, like. And so it just kind of dawned on me that people don't know yet. People are just now starting to find out that this is a thing. And so how exciting is it heading into a year where we have this new asset class that we can talk about and show off the innovation of this part of the space. So despite some of the good news, some of the positives, we did see some headwinds, and not just Bitcoin price action, but also through some unexpected places. Back in October, MSCI, which is one of the largest index providers in the world, proposed a rule that would have reclassified Bitcoin treasury companies. There were 39 companies that were at risk. About 8 of them were Bitcoin for Corporations members. So we mobilized. We're like, this is kind of what we were built for, a network that can advocate on behalf of our membership. We gathered signatures. We coordinated with our main members, especially the ones who were affected. I was coordinating very closely with the strategy team and Andrew Kang, who's kind of leading their effort. And in the end, TLDR, spoiler alert, MSCI backed down. And this is a great example of the power of the community coming together and again looking out for each other. We got to sit down with MSCI through this process, and we got their attention by making a lot of noise and saying, hey, this is a bad idea. These companies are actually operating companies. And to me, it was a reminder that, again, different segments of the market that we interact with have no idea really what's going on. And that's not like I'm not saying in a negative way. I'm just saying they just haven't been educated. They haven't had the opportunity to learn about what's going on and understand what strategy is doing and how that's different from sort of legacy financial products. And so this was against, I think, a lot of odds, including Polymarket, which had this at a 73% chance that strategy would be delisted by the end of the quarter. So that was an exciting win. And so I want to share a little bit more just about the Bitcoin for Corporations network and how it operates, how we continue to evolve and grow. With this plug from our boy Gary from Germany, who says, without BFC, the current scale of global corporate Bitcoin adoption would have been hard to imagine. That's our member company in Germany. Thank you, Gary. Appreciate the plug. But basically, we are trying to scale this year in a few different ways. We hit critical mass, I think, with the treasury companies that are now part of our membership. And so we've been slowly building the vendor and provider side of the network. So we've seen Kraken, BitGo, Crypto.com, different custody, legal, accounting, IR solutions come into the fold as a part of the network who provide products and services to these treasury companies. And to round out sort of the operating system that we're creating, we're now talking with more and more capital allocators to be a part of the network as well. And so this kind of makes a flywheel that I think can be very virtuous for our network. And so we are now onboarding capital allocators and continuing to expand the scope of the network. And so if that's you, we'd definitely love to talk. But the point is, you don't have to do this alone. There's a lot of companies that are on the same page, fighting for the same things. We're not in competition. We are trying to collaborate. And so as I wrap up here a little bit, I want to help you plan your next conference. It's always sad when we're coming to an end here on the final day, but good news, you can come right back here to Vegas in just a couple months. We'll be at Bitcoin 2026. One of the main things that we do is symposiums, very similar to this, all around the world. We have 4 that are locked in: Vegas, Hong Kong, Amsterdam, and Abu Dhabi. We have 3 that are almost at the finish line, so we might be up to 7 events. If you want to join us, we'd love to have you at any of them. We're looking at New York, DC, and one more international event, TBD. So mark your calendars and join us. So again, whole point is you don't have to do this alone. We're here to support, and our entire team, in fact, is here. This is who they are. We would love to meet you if we haven't had a chance to meet yet. Thanks again for coming. I really appreciate you being here, and enjoy the rest of the conference. Cheers.
from 4 leaders of Bitcoin treasury companies around the globe. We're going to be hitting Asia, Latin America, as well as Europe. The next sessions will start with Simon Gerovich, CEO of Metaplanet, followed by Guy Gomez, founder and CEO of Orange BTC. After that, Alexander Lizet, Director of Bitcoin Strategy at Capital B. And last up, Andrew Webley, CEO of the Smarter Web Company, and Jesse Myers, Head of Bitcoin Strategy there. So first, give a warm welcome to Simon Gerovich of Metaplanet.
Bitcoin is down almost 50% from its all-time high. I'm not going to pretend that didn't happen. I'm not going to skip past it. I'm going to show you exactly why it doesn't change a thing. My name is Simon Gerovich. I'm the CEO of Metaplanet, and we're building Japan's Bitcoin standard. Over the past 20 months, we've transformed in scale, structure, and ambition. I'll walk you through what we've built, why Japan specifically, and where we're headed next. I don't need to explain Bitcoin to this room. 99.99% uptime, 21 million hard cap, no central issuer. But here's the framing that matters. Bitcoin is absolute. Its supply is fixed. What's volatile is the human opinion of it. Sentiment, fear, and greed. The price is just the market's mood at any given moment. Bitcoin is the constant, and nowhere is that more significant than in Japan right now. Japan just held a snap election with the most overwhelming mandate in post-war history. Fiscal impulse is coming. Rearmament, infrastructure, industrial policy. There is renewed political will and clarity of direction. And yet, 240% debt to GDP, the highest of any country in the world. 10-year JGBs at 2.2%, decade highs. Inflation above 3%, for the first time in 30 years, and $7 trillion in household financial assets sitting in cash, waking up to a debasement risk for the first time in a generation. Japan is no different from the rest of the G7. The math is the same everywhere. Japan just got here first, faster, and at greater scale. So how do these situations resolve? Growth is unlikely with Japan's demographics. Austerity is politically toxic. Default is off the table in a fiat era, and nobody wants hyperinflation. That leaves financial repression, the rational choice, the path of least resistance. Inflation runs persistently above interest rates on cash, and debt to GDP falls not through repayment, but by inflating the economy. This is a well-known scenario, and it's playing out across the West right now. So what are the consequences? A tidal wave of capital from an economy of habitual savers is venturing out for the first time in decades into government bonds, into money markets, into equities, and into alternative monetary assets, gold and Bitcoin. This is the environment that Metaplanet was built for. This is from our white paper dated May 13, 2024. Acquiring Bitcoin through the issuance of long-dated yen liabilities, utilizing the entire range of capital market instruments, harnessing Japan's global capital cost advantage. 9 months later, Strategy issued the world's first Bitcoin-backed perpetual preferred, what is now referred to as digital credit. And this was our thesis then, and this remains our thesis today. Real rates in Japan remain negative. The spread between our cost of capital and what Bitcoin has historically returned remains extraordinary. And the opportunity in front of us is as large as the day we started. And speaking of what hasn't changed, let me show you something about Bitcoin itself. There are 2 ways to value this network. Market cap is simple. Take the circulating supply and price it at the last trade. This gives you roughly $1.5 trillion, down significantly from the all-time high. But that captures human sentiment at any given moment, fear, greed, narrative. And for a decentralized asset with no central authority, price always overshoots on the upside and the downside. Realized cap is different. It values every coin at the price it last moved on chain. Long-term holders are valued at what they paid, not what the market is feeling today. And look at how realized cap behaves. It moves like a step function. It consolidates and then appreciates. Almost none of the volatility you see in the spot price. Market cap drawdown from all-time high, 48%. Realized cap drawdown, just 2%. 2%. What that tells you is what long-term holders already know. A $1 trillion decentralized monetary network is bootstrapping in real time. No one steering the ship, no central committee, no policy intervention. And yet, the underlying economic reality of the network is essentially at all-time highs. Bitcoin's price is volatile, but its fundamentals are not. And that's the distinction and the foundation of everything that we do. Now let me show you what we've built on top of it. The orange line is Bitcoin's price since we adopted the Bitcoin standard in April 2024, roughly flat. The white line is Metaplanet's Bitcoin per share, up 5,000%. That gap is the entire argument for a Bitcoin treasury company model. We grow Bitcoin per share by issuing equity and fixed income intelligently, deploying into Bitcoin, and repeating. Every financing decision that we've made, how we've structured it, when we executed, how we communicated it, has been in service of that singular objective: increase Bitcoin per share. Here's capital formation at scale. For us, 2024 was proof of concept. We raised $130 million, a shareholder rights issue, and our first experiments with moving strike warrants. We were learning what we could accomplish in the Japanese capital markets. 2025 was transformational for us. $3.25 billion, 25 times the prior year. We executed Japan's largest moving strike warrant program. We then completed Japan's largest primary equity offering of the year, with Morgan Stanley as our lead underwriter. And in November, we issued our first perpetual preferred with Goldman Sachs leading the deal. And that opened up an entirely new institutional channel to fixed income investors. 2026 year to date, we've raised another $130 million in a stock plus warrants deal. Each year, we've added new instruments and reached larger, more sophisticated pools of capital. Bitcoin doesn't look like traditional corporate assets. It's a bearer asset with no cash flows, and it's volatile. And yet, it's incredibly powerful if you know what you're optimizing for. We use our Bitcoin in three ways. First, our long-term reserve, 35,102 Bitcoin, never sold. This underpins our entire capital structure. Second, dynamic collateral. Our Bitcoin balance sheet enabled us to raise over $1 billion in straight bonds and credit facilities. The bonds have now been fully repaid. Lenders are simply comfortable extending capital against a balance sheet anchored in Bitcoin. Third, Bitcoin income generation, $55 million in revenue in fiscal year 2025. We deploy capital into volatility strategies where we can get paid to enter the Bitcoin market as a buyer. This generates revenue that supports our interest and dividend obligations. Bitcoin is not static, it's incredibly dynamic. One of the most distinctive things about Metaplanet is our stock volatility. And rather than seeing that as a problem, we've turned it into a genuine advantage. Take our moving strike warrants, the Japanese equivalent of a US ATM facility. Market standard is an 8 to 10% discount to share price. We raised $1.5 billion at zero discount. Our volatility is so elevated that counterparties accept far better terms just to participate. That same dynamic shows up in our stock plus warrants structure. We sold common equity at a 5% premium while simultaneously selling a one-year call option 15% out of the money. Convertible economics with no future obligation. Institutions pay a premium for a package because the volatility makes those warrants extremely valuable. Our Mercury preferreds came in at 4.9%. Our balance sheet and volatility made the conversion option enticing to investors bullish on Bitcoin for the long term. Every instrument I just described exists because of our volatility. We've built a capital structure specifically designed to harvest it. We hold approximately 85% of all publicly held Bitcoin in the Japanese market. Globally, we're the fourth largest listed Bitcoin holder, the only Japanese company in the top 10, and the only company outside of the US. We're proud to represent Japan on the global stage, and we're proud to have inspired other Japanese companies to follow in our footsteps. When you take our Bitcoin holdings and you subtract our debt, we rank number 13 out of some 3,000 non-financial public companies in Japan by net cash position. We sit between Tokyo Electron and Mitsubishi Electric. We've built a balance sheet that ranks alongside Japan's industrial giants, using digital capital that didn't exist 15 years ago. And even with Bitcoin nearly 50% off its all-time highs, we can absorb shocks that would cripple most companies. Being well capitalized, being over-collateralized on the scarcest asset in human history is the strategy. Prior to becoming a Bitcoin treasury company, we had just over 10,000 shareholders in Japan. Today, that number has grown to over 216,000. And to put that in perspective, roughly 1 in every 600 people in Japan is now a Metaplanet shareholder. Japanese households hold approximately $15 trillion in financial assets, $7.5 trillion sitting in cash, earning almost nothing. Inflation is back, yields are rising, and capital is moving for the first time in a generation. And that capital needs somewhere to go. Metaplanet is building that destination. Amplified Bitcoin exposure for equity investors, high yield digital credit for fixed income investors, $15 trillion. We don't need much of that to make this one of the most significant financial stories of the decade. Our preferred equity program is how we capture this opportunity. Mars, our Metaplanet adjustable rate security, is our most senior non-dilutive preferred. We're targeting a variable cost of capital under 8%, and this is for investors seeking low volatility, high yield fixed income. No Bitcoin correlation, just yield backed by a fortress balance sheet. Mercury, our Metaplanet convertible for return and yield, gives you both. Senior liquidation preference, quarterly cumulative dividends at 4.9%, and full upside through a one-to-one conversion into Metaplanet common stock at 1,000 yen. We've issued $150 million so far. And our aim is to become the most attractive fixed income issuer in Japan. Here's the regulatory timeline that matters. In 2024, Bitcoin in Japan was a speculative asset in a regulatory gray area. Today, in 2026, it's a niche corporate asset. We're operating in an environment that tolerates us, but doesn't yet fully embrace us. By 2028, that changes. Bitcoin becomes a regulated financial instrument under Japanese law. The FSA framework finalizes, banks can begin to custody, insurers can begin to allocate, and institutional capital can finally flow in. Japan's 2028 will be what 2024 was for US markets, the year Bitcoin became an accepted financial asset. And that is happening alongside a monetary policy shift. Japan is getting both at once. And the recent election mandate will accelerate this. We see enormous opportunity ahead. We intend to lead using our brand, our balance sheet, and our track record to build what comes next. We're building today for a market that exists in 2028. And when those doors open, we'll be ready. This is the world we're building. Equity investors allocating through common stock, fixed income investors through perpetual preferreds, retail savers through self-custody and ETFs, institutions embracing Bitcoin as an asset they can custody, allocate to, and underwrite as collateral. Our treasury operations are a foundation for something much larger. If we succeed here, it becomes a template for Asia and the world. Corporate treasuries, sovereigns, pensions, banks, insurance portfolios, all of it built on a monetary foundation that no one controls and that everyone can verify. We're early, but look around this room. Everyone here is part of something much larger than just one company. For free markets, for property rights, for economic self-sovereignty. Over the next decade, holding Bitcoin on a corporate balance sheet will not be unusual. It'll be standard practice. Metaplanet won't be an outlier. Metaplanet will be the template. This is from our shareholder meeting last year in Tokyo. Thousands of people on a Monday morning. This is our community, and we're building Japan's Bitcoin standard together. Thank you very much.
Morning. Let's see if this is working. All right. Okay, my name is Gui Gomes. I'm the founder and CEO of Orange BTC out of Brazil. We just heard a little bit about what Metaplanet is building in Japan, and I'll share a little bit about what we're building in Latin America. I think it's clear that Bitcoin is global and adoption is spreading around the world, but adoption is still uneven, and that creates a lot of opportunity. What I'm trying to say here is that when you take a look about what happened in the US over the past few years, is mind-blowing. Bitcoin has deeply integrated into US capital markets. From Strategy, Block, Coinbase, we have over 50 public companies that give you access to Bitcoin and digital assets. On top of that, we have asset managers, we have banks that have fully embraced Bitcoin. IBIT, the most successful product in the history of Wall Street. So that's quite mind-blowing for anyone following this industry for a few years. And all of that was built on a booming private sector with a lot of successful companies building solutions around Bitcoin. And of course, there's the community, Bitcoin Twitter, that is following the industry, sharing insights, and helping adoption. That combination is quite special, but to some perspective, it's kind of unique to the United States. When you go to Latin America, adoption is real, undeniable. We've seen 67% year-over-year growth on on-chain volume. Almost $1.5 trillion has been circulating in that economy on-chain. When you see year-over-year, it's actually accelerating at a CAGR of 60%, the amount of capital flowing through digital assets. Of course, Bitcoin is part of that. Stablecoins are also a big piece of that story. And I'm happy to say that Brazil is leading the way. Almost 77% of that volume is coming out of Brazil. We have about 25 million Brazilians holding Bitcoin and other digital assets. So adoption is undeniable, grassroots, but mainly on the retail side. When you go to the institutional side, it's quite an opposite story, especially when compared to the US. We have no public miner, no public exchange, no real big banks embracing Bitcoin as of yet. And that creates a big opportunity. And one could argue, is that because we're talking about a small economy and a small country? It's quite the opposite. Brazil is always ranking among the 10 largest economies around the globe, a $2.3 trillion GDP, 215 million people, most of them live in urban areas with full access to the internet. And we also have the largest capital markets in Latin America, much smaller than the US, but it's still sizable at around $1 trillion in total equity and something around $60 to $7 billion in new issuances every single year. On top of that, it's a quite sophisticated market because this is a market facing inflation and currency debasement for essentially 3 or 4 decades. This chart here shows how much the BRL, the local currency, has lost in value against the dollar since 2012, almost 70%. And we all know what happened to the dollar during the same period. So Bitcoin is not an alternative, it's a structural need. Brazil has had savings, frozen savings account, almost 6 different currencies over the past few years, and has lost close to 82% of its value against the US dollar. As I like to say, if you think Bitcoin is good for America, Bitcoin is structural for Latin America. So we're talking about a large economy that has a structural need with grassroots adoption, but the institutional adoption is still not there. All the conditions were in place, we needed a local champion. And that's why we started Orange BTC last year to be a public champion for Bitcoin in Latin America. Our mission is quite simple. Our goal is to accelerate Bitcoin adoption in Brazil and Latin America. We want to spread the Bitcoin standard in the region. To do so, we had to be big, we had to be meaningful, and we have accumulated 3,722 Bitcoin. We're the largest holder in Latin America, the largest holder in the Global South, and we rank, as of today, number 25 of public companies holding Bitcoin around the globe. That's a pretty big number for Brazil. But our mission is to grow Bitcoin per share. That's what people like the most. So we designed the entire company with that mindset. We built a capital structure that is very clean, equity focused, no warrants, little debt. Even with the recent market correction, our debt ratio as of today remains around 9%. On top of that, we had to think about how to expand the balance sheet. We all know what Strategy and other US-based companies have done with the ATM. ATMs do not exist in Brazil. What is there is shares in treasury. So we build shares in treasury that allow us to sell them into the open market, capitalize the company, and buy more Bitcoin, and have done so over the past few months. We can also buy back shares if we're trading below MNAV, and we've done that in the past few weeks when the market was under pressure. And that allowed us to grow our Bitcoin per share over the past few months. We have been around for around 4 months, so very early stage, but we've done about 2.5% so far. On top of that, we're trying to change corporate governance in the region, being fully transparent with all the metrics in the dashboard as many other companies in the space, and also proof of reserves, so anyone can audit our coins on chain. And how do we think about the company? The treasury is at the center of the business. Our mandate is to grow Bitcoin per share. But we think about the company in 3 different pillars. We have principal investments, we have education and marketing, and we have financial products and access. And I'll share a little bit more about each one of those segments. Principal investments, we just heard from Simon on Metaplanet. They have the Bitcoin income generation. We're thinking in a kind of similar way. We want to use the strength of our balance sheet to generate returns, to cover all of our operating costs, have profitability to buy more Bitcoin. Our intent is to be profitable by end of year, and I'm happy to say we have made good progress in that direction. We have a very strict mandate, very specific rules of how we think about it, extremely conservative, but we see a lot of opportunities to use the strength of the balance sheet to generate returns to shareholders. And I'll not share much of what we're up to, but I'm happy to share that we are the first public company around the globe to have Stretch as part of our corporate strategy. Strategy has been the first company. Strategy has been the first company to adopt Bitcoin as a corporate strategy, and we have now adopted digital credit as part of a corporate strategy as well. And that's one of the examples of how we're monetizing to generate returns for the shareholders. We have a decent position right now, and our goal is to get to about $10 million in Stretch exposure over the upcoming weeks, and being the first public company doing so and helping to spread adoption around the globe. So buying Bitcoin, adopting this ecosystem, adopting these new solutions is one way to drive adoption, but education is our mission. And we're doing a lot on that front. We have launched our blog, which brings best-in-class content from the US and around the globe to Brazil in both Portuguese and English, having thousands of visits every single week. We have done our first corporate event, was the first institutional event in the history of the country about Bitcoin. And we gather about 500 investors, bankers, and asset managers to talk about Bitcoin and Bitcoin corporate strategy. And we are honored to have Saylor joining us to share a little bit about his journey. We also have built a meaningful online presence. We're using a lot of AI. We launched our first AI-generated video about the history of money, and thousands of Brazilians have learned about what's going on around the world. And we have content every single week about Bitcoin and what's going on around the economy. And on top of it all, we have just added a new toolkit to our platform. And we took over bitcoin.com.br, the most prime digital real estate in Brazil around Bitcoin. And we're going to turn that into a hub, starting with content and education, and then eventually growing that into a platform with products and services around Bitcoin and this new ecosystem. But it's not only about buying Bitcoin, growing Bitcoin per share, spreading the word, and driving education and adoption. We need to build access. We need to bring new solutions and new offerings to the local market. And that's what we're up to. Over the upcoming years, we're going to bring new solutions helping to drive adoption. We're starting with capital advisory, helping local companies to understand Bitcoin and add Bitcoin to their balance sheet. We're doing the opposite as well. We're helping a lot of global companies who want to build a presence in Latin America to penetrate the region and understand the best way to do business there. Asset management, as I mentioned, we have many US players bringing a variety of solutions around Bitcoin, and we want to do the same. We're going to bring new ways for local investors, both institutions and retail, to get exposure to Bitcoin through different products and solutions. And in credit, you cannot get a Bitcoin-backed loan in Brazil issued by a local company as of today. We hope to solve for that in the upcoming years using the strength of our balance sheet and our local presence. And the remaining question is that resonating? We're a pretty young company, but when we were raising capital last year, many investors were asking, is there a local demand? Are you guys be able to actually grow your shareholder count? And I'm glad to say that, although very early, it's looking pretty good. We became a listed company on October 7th, all-time high day. Bitcoin has gone down 50% ever since. And in the meantime, we grew our shareholder count by 44x, going from 150 shareholders to essentially 8,000 shareholders in fewer than 100 trading days. With that, we brought liquidity. We're among the most liquid stocks in the local stock exchange. We're in about 25% top percentile, number 87 by turnover, and that was done without an IPO, through a direct listing with no distribution. Liquidity is growing because the local market has a demand to get exposure to Bitcoin and digital equity, which was not there before. And now we have some wind on our sails as well. As we all know, emerging markets were kind of put aside over the past few years, given how booming was the US economy and US tech. But now we're seeing capital rotation. We're seeing a lot of capital flowing from developed markets to emerging markets. And Wall Street is kind of very bullish in Brazil and Latin America. So we believe that capital flow will not only help the region increase the size of the local market, but also help Orange BTC to keep growing. As of today, the only company listed in Latin America that is a native Bitcoin company that gives you exposure to not only Bitcoin, but emerging markets is Orange BTC. And that's a key differentiator for anyone trying to grow exposure in the region. So as I mentioned, Brazil had all the conditions: a sizable market, a structural need, a grassroots adoption cycle, but it lacked a champion, and that's what we're up to. We want to have the champion of the region, help to drive adoption in the global south, and get Bitcoin on the hands of millions of people. Thank you so much.
Hello everyone, hello Strategy World, how are you doing? Doing great, I'm excited to be here with you today. Thank you first to Mekhail, Phong, the strategy team. We are very thankful for your great leadership. I think there is no second best leadership in the world for Bitcoin institutional adoption. Thank you to our shareholders. We are extremely honored to be with you together on this journey to shape the future of Bitcoin retail and institutional adoption in Europe. Capital B is Europe's first Bitcoin treasury company listed on Euronext Growth Paris under ticker ALCPB. I am Alexandre Lézé, Board Director of Bitcoin Strategy at Capital B. Capital B is the #1 company in terms of Bitcoin on the balance sheet, the most volumes, the most institutional and retail interest, the most BTC yield delivered last year, and the best performing company over in France and Europe last year. Capital B is in Europe. Europe is 500 million individuals increasingly needing Bitcoin securitized exposure, increasing taxes, increasing security and privacy threats, increasing levels of pension funds, trillions and trillions of euros being the target of political pressure for reallocation into European-based companies. Low deposit rates, and on top of that, 70 plus years of capital market maturity over in Europe, the second largest credit market in the world, and France being 40%, the top one in Europe of that overall market. And that is one of the strongest foundations for Capital B to be the best performing stock, not only in Europe, but compared with global benchmarks when it comes to our Bitcoin standard era. 3x gold despite the small Bitcoin downturn. And the Bitcoin recent downturn is temporary. The reality is that Capital B is powered by the 20x asset, the asset that is creating a bottom that is 20x higher than 8 years ago, the asset that is becoming the world's capital reserve network for the world. And Capital B is capitalizing on the asset that is growing at 70% CAGR year over year. And there is a fundamental reason for this, is that digital monopolies are better than traditional monopolies. Digital intelligence is outperforming physical capital by 2 to 3x over the last decade. And guess what? Digital capital is better than traditional capital. Digital capital is absorbing the value creation and absorption of digital intelligence, gravitating towards the black hole of Bitcoin, and Bitcoin is outperforming digital intelligence by 17x over the last 10 years. Speaking of black holes, digital capital treasuries are transforming the 30 trillion market of Bitcoin into a 300 trillion market of Bitcoin credit markets, and on a sufficiently long time horizon, since their respective Bitcoin treasury company strategies, Strategy, Metaplanet, Capital B, and later you will see Smarter Web are outperforming Bitcoin in orders of magnitude. We've seen that, in fact, it's a 300, 900%, 3,000%, 900% potential returns over time that these companies are doing because of the power of digital credit. Strategy is leading the way with, of course, the perpetual preferred, Metaplanet with the different credit instruments and also the perpetual preferreds. strive, of course. Capital B is the #1 issuer in the world in terms of Bitcoin-denominated convertible notes. We have issued close to $200 million of Bitcoin-denominated credit, raising our amplification to 40+% with zero fiat leverage. And of course, our next logical step is toward the example of listed digital credit of the likes of Stretch and the growth of this asset class that is now already a 12x growth over less than 1 year. And Capital B is focused on digital credit, of course, for the future in a listed way, and for the present as well in the most convex way, both for investors and the company. Bitcoin-denominated convertible note has been a major innovation last year that Capital B has done that allows and can allow for investors a -50% drawdown reduction and a 2 to 3x amplification upside increase. And doing so, Capital B has been able to increase the number of Bitcoin on the balance sheet by 6,000%, and the number of sats per fully diluted share by 1,600%, based on a very strong foundational layer of conservative Bitcoin maximalist and capital market savvy principles of raising capital, accumulating Bitcoin, and holding it forever. The strategy playbook at European scale, that is our focus. It means accumulating Bitcoin consistently, relentlessly, and no matter the market conditions, with, of course, a focus on increasing the number of Bitcoin per share. Since the start of our strategy, we have transformed the equivalent of 100K investment of 1.4 BTC into 4.5 BTC. Our focus is the steady, consistent accumulation of Bitcoin in a way that increases Bitcoin per share and has effectively multiplied that number by 42x since the start of our strategy. Of course, that Bitcoin maximalist energy is allowing and increasing the institutional adoption into passive flows that are entering the company. Through Tobam and generally in Europe, we are now part of life insurance flows from asset managers, and of course also global equity flows from the likes of Bitwise. And Capital B today is already 1.4 billion of liquidity in the market, 3 to 5 million euros of average daily volumes, top 150 company, over 8,000 plus listed company in Europe in terms of volumes, #1 on Euronext Growth Paris, top 10 in terms of short interest, and 20,000 individual shareholders across the world, 40 plus institutional investors, 90 plus countries represented, 40% in France, a very strong local base of shareholders. Thank you again. 40% of European outside of France investors, very strong local footprint, and global demand from, of course, North America with 10%. And our objective is to have the flows of the 50 trillion European credit markets and equity markets flow over time toward the Capital B nuclear reactor of European hyper-Bitcoinization. And our ambition is to raise over 100 billion euros of capital over the next 8 years in order to accumulate 1% of the total BTC supply, 21 to 42,000 Bitcoin over the next 3 years, and 100,000 Bitcoin over the next 5 years towards 210K Bitcoin by 2033. And our objective is continued, it is consistent, it is at every operation level to continue to grow the balance sheet, grow the Bitcoin per share, and provide peace of mind for our investors to increase their Bitcoin exposure over time and to lead the integration of Bitcoin in digital capital markets for Europe. Thank you very much all.
Good morning, everyone. My name is Andrew Webley from the Smarter Web Company, and myself and Jesse today are going to talk to you about what we're doing with Bitcoin adoption on the balance sheet from a UK perspective. If you're interested in reading the full version of this deck, you can access it on our website, smarterwebcompany.co.uk, but we've picked out a few slides that we thought were particularly interesting to cover today. So we are the Smarter Web Company. We're an operating business based in the UK, founded in 2009 by myself, web design, content management system. In approximately 10 years ago from now, I first found Bitcoin. But my Bitcoin moment wasn't until I stumbled across Michael Saylor's strategy when they pivoted to their strategy that you're all familiar with. I tell everyone that that was my Bitcoin moment. And very soon after that, I started trying to find a company like Strategy, but in the UK. Our company, the Smarter Web Company, started accepting Bitcoin as a payment in 2022. But after several years of looking, I couldn't find a company in the UK doing this strategy. So I decided I would list my business on the stock market, which I did in 2025. 2025, approximately 10 months ago, was when we formally announced our Bitcoin treasury strategy, where we're trying to build our balance sheet on digital capital. Last year, we were the best performing equity in the UK, which is something that I'm very, very proud of, and I've got some highlights to show you in a moment. In the UK, you've got two stock exchanges. You've got something called Aquis, which is a junior growth market, which is where we initially listed. And then you've got the London Stock Exchange, which you're probably all familiar with. Earlier this month, we uplisted to the London Stock Exchange after approximately 6 months of work that we weren't allowed to talk about when we were doing it. And today we're listed on the London Stock Exchange. We've got the largest Bitcoin treasury of any company in the UK by quite some margin, approximately 4 to 5 times bigger than the next biggest. And we're the 29th biggest Bitcoin treasury company in the world, according to recent figures. We've got a really good, experienced team. We've spent a lot of time building out our non-executive board, so we've got the highest standards of governance that we can. That's really important because being a public company, especially listed on the London Stock Exchange, there's quite stringent rules there. And we've got a growth of progressing through the indexes, which I'm pleased to be able to share with you. Will probably start from next week when the quarterly rebalance happens in the UK. So we can go to firstly, the FTSE All Share. I believe later this year we should be able to get to the FTSE 250 and then the FTSE 100 from there. We'll talk about our ambitions at the end. So here's some stats that I'm quite proud of. As I mentioned, we were the best performing UK equity last year. We've got 2,689 Bitcoin on our balance sheet. We've raised almost £250 million to invest in Bitcoin since we listed in 10 months. That's approximately 300 and a bit million US. Last year, from the IPO to where we closed, 1,200% share price increase. It was a lot higher. Obviously, it's been a very volatile year, which we make no excuses or apologies for. One thing that I'm very proud of is we've got the #1 community on X in the UK for a Bitcoin treasury company. We're actually the third largest Bitcoin treasury community globally after Strategy and Metaplanet, two great companies. We've had over £1 billion of our equity traded. You know, we're very proud and we put a lot of effort into the liquidity in our stock. As mentioned, we uplisted to the LSE. And not everyone knows this, but we're one of the largest traded stocks in the UK for retail investors. There was a stat released recently putting us as number 10. If you adjust it for market cap, we're probably the number 1.
All right. And many of you are familiar with this sort of view of the global asset landscape, this here shown in pounds. Bitcoin is still just 0.2% of global asset value. We think that will grow considerably. But we're focused on the UK, so we've done the analysis to show what it is in the UK. And you'll see how things have shifted just now. UK commands 6% of global asset value, and you can see how the equities and money buckets have relatively grown versus the global view. The UK has 9% of global equity value and 10% of global money. This is because the UK is a financialized economy with a proud history. So we'll go next. Yeah, interesting. So what does the Smarter Web company bring to the UK? Well, we amplify Bitcoin's volatility. So that's what a Bitcoin treasury company can bring, amplified Bitcoin exposure. So this illustration here on the left shows what's possible with a Bitcoin treasury company. You can grow your Bitcoin ownership over time, and that can be better than one Bitcoin equaling one Bitcoin if you just hold cold storage Bitcoin. Obviously, this layers volatility on top of Bitcoin's already considerable volatility. Our volatility is 100 to 120, and we think that's a great thing, especially in the UK. In the UK, equities lack volatility. It's historically a defensive market that tends to underperform US public equities. And the Smarter Web company brings volatility to London public markets. We are about twice as volatile as the most volatile stock in the FTSE 350, and that is because we are amplifying Bitcoin's volatility. At this point, we have emerged as the clear leader in the UK as a Bitcoin treasury company with 4.3 times as much Bitcoin as the next closest UK Bitcoin treasury company, and a lot more average daily volume. And this puts us in a great position going into what's hopefully the next Bitcoin uptrend as the UK's premier Bitcoin treasury company, increasingly synonymous with how you get amplified Bitcoin exposure in the UK for all of that capital that is in the UK and doesn't have great exposure to Bitcoin products as of today. And as Phong here points out in that quote, there could be a strategy in every capital market, and we intend to be that in the UK.
Thank you, Jesse. So where are we going with this? What are we trying to achieve? Our goal is to be one of the largest companies in the UK. So let me first explain what that looks like in terms of where we are today, and then try and explain at a very, very high level how we're going to get there. So if you look at this slide, you can see our market cap as ratios of aspirational milestones. So you can see that today we need to grow by about double where we are to get into the FTSE 250. In the UK, you've got something that's called the FTSE 350. It's 100, then 250, 350. That's the 350 largest companies. If we double from where we are today through capital raising and Bitcoin returns, then roughly we should get inclusion in that index. We've got a little bit further to go until we get in the FTSE 100. when I listed the business, we listed the business with a market cap of approximately £3 million. So we have done quite well compared to that point. I did an article in one of the mainstream media things when they were kind enough to interview me when I first listed the business, and everyone laughed when they heard my dream of becoming one of the FTSE 100 companies. But I think some people can believe that, and I certainly very much believe that, in the medium term. Once we've got into the FTSE 100, then I want to get into the top 10, and I believe that we can become the largest company in the UK in time. And I also believe that this sector, this new sector that we're all part of, Bitcoin treasury companies, digital capital issuers, digital money creators, whatever you want to call all of the different great companies that are doing good things at the moment, I believe that these will become the most valuable companies across the world in whatever markets they operate in. So how are we actually going to do that? That's probably what you're asking. So if you look at this pathway to success that we've included, the ticks are what we've done, the dotted ticks are work in progress, and then we're working towards the other things. So structural properties are very, very important if you're a public company. One thing that we've worked very, very hard at is making sure that the company's structured correctly from a capital point of view. So we've raised, as I said, almost £250 million. Pretty much all of that has been equity, and that equity's been raised through subscriptions and placings, and then approximately 25% of it has been raised through an at-the-market style program that we have. So we're very, very cautious, and we're very, very sensible, I believe, in terms of how we're structuring the capital of the company to give it the best possible chance with a volatile asset over the medium to long term. We also put a lot of work into our investor base. So I believe in transparency, I believe in honesty, I believe in free speech and all of these things, and that's how we run the company. And that's resonated, in a small way with people so far, which has led on to our community support, our global investor reach, etc. And we're also starting to get a bit of a name for ourselves in terms of how we've delivered Bitcoin per share growth, even in what's been quite a tough market since July last year. After some of these things have been progressed a little bit further, we'll work on different capital tools, which we can't talk about at the moment, but there's probably no major surprises if we could talk about those ones, and to continue growing the company so that this Bitcoin treasury company that's coming out of the UK, that's listed on the UK, which is one of the best capital markets in the world, is understood and respected and hopefully invested by a broad reach of global investors, which is becoming more and more institutionalized as we go on. And then finally, the last two things is over the medium to long term. So obviously we're proud of the yield that we've delivered to date, but we want that to be something that lasts for years and years, that people can use, because that's the most important thing to me. The Bitcoin yield, the compound Bitcoin, call it whatever you want to call it, how that grows over time. And then all being well, providing we can deliver that, which we believe we can, we'll have a global investor base with multi-index inclusion, a range of different capital tools, all within our toolkit that we use when the market conditions are right, so that we can continue adding value for our shareholders. And the only other thing to say is thank you for listening.
Thank you so much for joining us for our morning of panels. We're now going to take a 15-minute coffee break and come back for an exciting fireside chat hosted by Phong Lee. So please enjoy your coffee, get caffeinated, get energized, and we have an exciting afternoon in store for you. Thank you.
Tonight there's something inside that I can't ignore. Hold me close till I get up. Time is barely on our side. I don't wanna waste what's left. The storms we chase are leading us, and love is all we'll ever trust. Yeah, no, I don't wanna waste what's left. And on we'll go, through the wastelands, through the highways, till my shadow turns to sun rays. And on we'll go, through the wastelands, through the highways, and on we'll go.
Please make your way back to your seats. Our program will resume in 5 minutes. As a courtesy to fellow guests and speakers, we do ask you please turn your cell phones and other portable electronic devices to the silent mode. Thank you. Please make your way to your seats. Our program is about to resume. Again, please make your way to your seats. Our program is about to resume.
Welcome back. I'm so excited to introduce this next fireside chat. We're going to have President and CEO of Strategy, Phong Lee, interviewing Amy Oldenburg, Head of Digital Asset Strategy at Morgan Stanley. Welcome, both of them.
Amy, how are you this morning?
Good to see you.
Good to see you too. Okay, so this is going to be an interesting one. I have 3 panels I'm doing. We talked to Jeff Solomon yesterday, who was former CEO of Cowen, which was a challenger bank acquired by TD. I have Brett Tejpal later today, who's co-CEO of institutional Coinbase, and I have you, who's running digital asset strategy at Morgan Stanley, which is, to me, a huge deal that Morgan Stanley has appointed somebody as digital assets. But why don't we just start a little bit? Just tell everyone about Morgan Stanley, because I think a lot of people in the DeFi space think every single big bank is the same. What's Morgan Stanley's expertise? What do you do? And why don't we just start there?
Sure, and I think that's a great point to start, because I think when you look at the GSIBs, a lot of folks want to compare what Morgan Stanley does, what JP Morgan, what Goldman, what Citi do, and many of our business constructs are quite different. We have a considerable investment banking business, investment management business, and the largest wealth management business in the US. And with that, that's really where we need to align our digital asset interests. We don't have retail banking. We don't have to manage corresponding banking business like some of our peers do. So I think that gives you just a good construct of where our alignment and our strategy is really going to fit when we look at the digital asset space.
Great. And you sort of just, sort of yada through it, but you have $8 trillion of assets under management.
That's right.
Through wealth management, which means you're managing actively, for the most part, $8 trillion of other people's assets. Is that right?
The next largest platform is 30% smaller than we are.
Yeah, so this is a big deal. If there's somebody who can help orange pill the world, it would be Morgan Stanley.
That would probably be accurate.
And that's now your job to orange
and
pill.
I think the one thing also to highlight there, we do have our E-Trade business. I'm always surprised sometimes when I run into folks that don't know that we own E-Trade and that they're now part of the Morgan Stanley brand. But I think we have an entire spectrum of wealth management, from basically self-directed to your mainstream wealth management, to your high net worth and family office business. So we really have the whole spectrum covered within that wealth management space.
Yeah, so great. So there's also, Morgan Stanley probably has the longest term history as a banker of then MicroStrategy, for everyone's perspective. When we were just a software company, which we still are, in addition to our Bitcoin, Morgan Stanley was our lead technology banker. We used to, ironically enough, buy back stock with our excess cash. Morgan Stanley led that. When we transitioned to our Bitcoin strategy and we did our first Dutch tender auction, Morgan Stanley led that. And most recently, the largest IPO at that time last year was Stretch. Morgan Stanley led that. And what was unique about that, one, it was a very unique instrument, a perpetual preferred with a floating dividend. And two, it was the first time it was distributed to Morgan Stanley's wealth, which was $8 trillion of AUM had access to Stretch. Tell me about how that decision came to be, because I know it wasn't an easy one.
Yeah, well, I think one of the things that we've lived through over the last number of years, and this isn't going to surprise anyone in this room, is a very different landscape in terms of the regulatory environment. So as you could imagine, one of the largest banks in the world, we had a fair bit of pressure on us around really navigating that regulatory environment. So there was a limitation in terms of what we could do, and I think there was a risk management component to that that continued to open up last year, right? So 2025 was an incredible year for us in the organization, where many of us that have been working on these digital asset initiatives across the organization felt a lot more flexibility to take the next step and push things through a little bit farther than they were before. And I think that's really, it was perfect timing even with that stretch offering. I think the other thing too that's really interesting about that product is just what it offers. I mean, I'll tell a little bit. You're the expert at it, so I can just put my highlights in there. But most of what we've seen come to the market is just passive exposure, where you have to eat all of the volatility that comes along with that. And this is the first time you started to see products roll out there where you were quite thoughtful in doing this and offering the stability, the yield. I mean, yield is a huge topic beyond just the digital asset space, but just in the wealth space overall. And the tax efficiency. I mean, those are just key words, and you're able to put that all in a package, with the underlying being that Bitcoin asset, which many people feel very strongly about. And it's a very interesting product to talk to clients about.
So give folks a little bit more perspective. We'll talk about Stretch a little bit more. A preferred, a hybrid, if you will, has primarily been issued by banks, including Morgan Stanley and other banks. And you've seen charts where the liquidity on a preferred typically trades about $1 million a day of public preferred. Give people maybe the history of how do preferreds work before Stretch came along, and what do you think the future is going to look like?
Ooh, I am not the expert at that. That's going to be my team, and I'm not going to go into detail on that.
Okay.
I'll leave that to the bankers to go into. The one thing that I would just highlight there, though, is I think there's a major lift on the education of how these work. I think you guys have put a lot of time into doing that, but I think there's still a lot more work to be done, just in terms of really having clients understand. And I guess the other thing is, how much do they really focus on that? Or do they really just focus on some of those high level points that I brought up before around the stability and the yields, the income component that they have on that?
So your advice is, forget about the fact it's a preferred and just talk about the yield, the tax deferral, the income component, how it's stable, how it's over collateralized.
You know, I think that's from the experience. They have so many products put in front of them every single day. You really have to make it quite simple to understand. And I think that's one thing that you've done specifically with the Stretch product beyond some of the other products that you've put out there.
Okay, great. Well, we've worked with pretty much all of the banks, and I can attest that Morgan Stanley is one of the more digitally forward ones. Tell me how that came to be, and what is your role? What are you doing?
So we've been working in the digital asset space for a long time. We might have not had a head of digital strategy or a digital asset team, but this goes back years ago. We were focused on blockchain technology, DLT, when everyone was really focused more on the private blockchain initiatives in the mid-teens prior to COVID. And you saw this continued adoption. It's really almost at the same time you started. I remember sitting in COVID on your first institution, Bitcoin for institutions, when you rolled that out during COVID. I think it was all just remote at that point. And really it was at that moment that you just saw this continued discussion and exploration of institutions around spot crypto. We are rolling out on the E-Trade platform spot crypto. We've been public about that. We're looking at wallet technology for entire wealth management space. We filed for a couple of crypto ETPs, so we will be offering those to clients in the coming months. And across our entire sales and trading business, anywhere where there's an opportunity to assess a connectivity point to the digital asset space, we're exploring. If that's tokenization of equities, tokenization of structured notes, some sort of opportunities within our fixed income, our FX business. There really is every area that we need to explore to see if it's a crypto opportunity. So looking at things like Bitcoin, Ethereum, Solana, and otherwise, or looking at just using that technology for some of the opportunities that you've seen as folks have talked more about tokenization and stablecoins this year.
And so what's your role? Like, do you have a number? They're like, Amy, you're going to run digital strategy at Morgan Stanley. You need to grow X percentage of, you need to convince $8 trillion worth of people have put 50% of that into Bitcoin. Is that seems like a reasonable objective?
Yeah, there we go. That's a good KPI to give my boss. I think really what we need to do, and we've seen this, we've learned over the years because we've quietly been living through a number of these cycles, is as these things have popped up around the business, we've really had to stay more coordinated with building out the infrastructure to support this. This is not the same infrastructure that we're running today in terms of our legacy trading. Spot crypto, the custody that goes along with it, the data that goes along with it, the consolidation, making sure you're getting the liquidity across all the exchanges. These are all infrastructure elements that we need to build out internally to be able to offer that institutional support for the business, regardless of which direction this goes. So I'm trying to do this at the firm level and make sure we're coordinated across every division. Because as you can imagine, it's very easy within an organization as large as ours to have 52 meetings with the same vendor. And many of us all have friends. Some of us in this room work at fintechs. You don't have that much space to deal with our organization with that sort of fragmentation. So we're really trying to get this more coordinated. The second piece of this is the client side. So we have, it's really part of our entire ethos at the firm is really the client-led initiatives. And when we get into something, it really is many times driven by the client demand. And there is significant questions that we're getting from clients. If that's allocations, we've put out a fair bit of research from some of my colleagues that are here on the allocation within the wealth management space. How much should you allocate to Bitcoin or the cryptocurrency space? But also, as we see some of these other topics, how is tokenization going to disrupt my business? What do I have to think about with the introduction of stablecoins? Do I have to be ready for this? Are there businesses that are at risk that I haven't thought about yet? So there's a significant amount of incoming, and we're also trying to coordinate that.
That's great. So let's talk about some of the products that are coming up for Morgan Stanley. You'd mentioned you're going to allow folks on the E-Trade platform to buy and sell crypto, spot crypto, which is great. And I think you're doing that through a partnership. And then I think later on, at some point in time in the next year, you're actually going to build out a native custody and exchange solution, which I'm pretty excited about. You'll potentially be the first major bank to offer that. Why is that piece important? And what are you thinking about? Like, how does that strategically fit in?
Yeah, I think it's a natural, we really need to build this out internally. We can't just primarily rent the technology to do this. People expect Morgan Stanley, they trust our brand to be no fail. And when you sit in that position, you have a significant responsibility to your clients to make sure that you're delivering that in any level of technology. So I think that's one of the things that we want to do. It's a totally different environment to know that you are custodying your assets. You have legal custody with Morgan Stanley, and Morgan Stanley is overseeing those assets for you. There's always those that are going to want to self-custody. That's a natural part of this space, especially in the Bitcoin space. I think for some of you in the room that may not know my background, prior to being in the digital asset strategy space, I ran our emerging market investing business for the last 13 years, and I've been at the firm for 26. So my entire background in emerging markets, as you can imagine, the adoption of Bitcoin and cryptocurrency. I think we lead 17 of the top 20 markets of adoption around the world. This has been a very, very long journey for me, being on the ground with many of these companies and investors and users of cryptocurrencies early on. So, one of the things that we really want to do is just make sure as this continues to mainstream and institutionalize that we're being able to provide those services to clients.
Well, that's pretty exciting. So you're going to offer the ability to custody and buy and sell crypto and Bitcoin specifically, and probably some other coins. Do you think you'll offer yield and lending services against that Bitcoin?
I absolutely, that's part of the discussion and the exploration. It's a natural part of the roadmap to continue to explore. I think we're in very early journey on that, just in terms of the number of products that are out in the market. I think we've seen even this year, little bit surprised at how much momentum there is around DeFi lending. That's definitely a topic that we've seen pop up again and again. We see headlines around that in this year, but a little bit of a different product than what you have with Stretch.
Yeah. And so awesome. So crypto, custody, exchange, yield, lending, which by the way, I think is going to be world changing when you do that. So $8 trillion in assets on platform. I assume part of this is a commercial decision because people have crypto assets off platform.
Yes.
Do you have a sense of how much that might be?
It's a considerable number.
Yeah, so it's a lot
of current clients.
Right, and so you would then get that onto your platform.
So you can
too,
so you can either bring that in through at one point you'll be able to bring it in through spot deposits, but there's another way that the regulators have created for us just in the last few months, where you're now able to in-kind Bitcoin into ETPs.
Yep.
So as you've seen, we filed the first week of January for an ETP for Bitcoin, Ethereum, and Solana. And the intention would be that you can also in-kind into any of those ETPs. The other thing is once those assets are on the wealth management platform, you're able to provide the client many other services around that exposure that they have on the platform. I mean, that's pretty incredible. That, unfortunately, is something that the crypto space has not done well, offering their clients additional services around just the trading aspects of the business.
Yeah, I think the opportunity here for you is significant. So I do some of my wealth management through Morgan Stanley, and you guys have done a great job. And I have my Bitcoin off platform.
Yep.
And my wealth manager is always asking me, how much Bitcoin do you have? And I'm like, I don't know that I want to tell you.
No, probably not.
And so then, but then I say, can I get a loan against my Bitcoin? It becomes a very clumsy conversation that when you bring it all on, it's just simple loans, etc.
Well, you'll be our first call.
I would love to be your first customer. So let's talk about tokenization,
okay.
Right? And what you're thinking about doing there in that space.
So I think that's a unique aspect. I mean, even as you highlighted, the build out of wallet technology, being able to hold crypto within the wealth management platform, there's a broader extension of this as we're really starting to see very active work around tokenization of every asset, if that's equities, different fixed income products, or even privates. So there is that component of it where you may have a wallet in the future that we're able to help democratize the access to privates, really strip down some of the administrative burden in that. And I think that's really where we're spending our time. I think we don't want to tokenize for the sake of tokenizing assets. It needs to really have that like value add for the client. So are we stripping out the admin? Are we making it easier to use as collateral? Are we able to move it faster? We've seen a lot of headlines now around 24/7 trading. Those are all things that we have to support. And that's a pretty heavy duty tech lift, risk lift, operational lift. And I think the one thing that maybe I would just highlight a little bit, which is pretty distinct when it comes to thinking about our business. Historically, in the financial services firms, we've always thought about front office and back office. Are you a front office person? Are you a back office person? And they usually don't mix too much. I mean, even when I grew up in school, you either went into finance or you went into tech. And they were like this far apart. There was very little crossover. The thing that we're seeing right now, both with the digital assets trend and also the AI trend, is that these are side by side. And even as we're designing products, we really can't just do that client-facing or the product-level design without having all the back-end understanding and considerations right up front. So I think it's changing the entire way we think about even constructs of our businesses. And that's actually one of the reasons, too, to have this central team so we can make sure everyone's in that discussion from day one when we're looking at product design.
Great. What about stable coins? Will Morgan Stanley be a player there?
If digital money happens in whatever format that is, we'll be there. We don't have a choice. If that's stable coins, if that's digital deposits, if that's tokenized money market funds, we have filed for tokenized money market funds. We have one product that's already live in the market. And maybe this just continues. Sometimes I forget how many different activities we have going on out there, but this just highlights my point that I was making earlier of going through the entire business, looking at every single business line and understanding where that opportunity is to consider the future of digital assets.
Great. So this is Bitcoin for Corporations. You know, we talked a lot about the wealth management part of Morgan Stanley because that's what you're very well known for. You also do a lot of work with corporations, especially through your investment bank. We work with you, and we started with this idea in 2020 with Bitcoin for Corporations that Bitcoin is what corporations should put on their balance sheet, and we've evolved to this idea that there should be Bitcoin treasury companies, but for I would call it more traditional company, something like Stretch would work on a balance sheet. What are your thoughts around if you're a corporate CFO, corporate treasurer? You saw a couple of announcements yesterday. What are your thoughts around the role of treasuries, the role of corporations, and should they be yield seeking in addition to capital preservation? And could Stretch be an interesting instrument for that?
So one interesting point in terms of my focus, last year when I came to this event in Orlando, and the team knows this well, the one reason that I wanted to come is just to sit in the sessions around adding Bitcoin to balance sheets for corporations. It's where you started when I sat on so many of the early initiatives that you had trying to educate the institutions. But I think one thing that happened last year, which was interesting, where we sat in these sessions and we're really trying to understand the construct of how much Bitcoin do you put on the balance sheet, how do you consider it, how do you manage it long term for a leadership team. The DATs came in, and then it just became all about the DATs in 25. So I'm still very interested at looking at this opportunity where you see some of these announcements where they still have that core business, but they're looking at continuing to just put a percentage. They're not taking the whole company and focusing on just Bitcoin or some other cryptocurrency, but really being thoughtful about what that means for their balance sheet. I'm an independent director on a fintech company in the Middle East, and I was telling Phong this just before we walked on stage. Just about 2 weeks ago, our board approved putting Bitcoin and a couple other cryptocurrencies on the balance sheet of the fintech. And it's something that we had worked on for quite a long time, and I would like to continue to see corporations just be educated and understand what that opportunity is for them going forward. And Stretch is an interesting product, right? Because that's the one thing that we have always struggled with is some of the volatility, especially for potentially smaller fintech that may not want to take on so much risk, even larger organizations where that product offers different volatility dynamics and income dynamics there.
Oh, great. The Morgan Stanley, I think Denny Galindo sort of led, research that said that for the right types of customers, they should consider having 2 to 4% of their balance sheet in Bitcoin. Tell me about where that came from, and is it the right number? How should people think about that?
You know what pains me the most about that number? Do you know what
it's too low.
Do you know what the?
That's what pains me.
I mean, I've spent 26 of my years in the emerging market space, and I think the allocation to emerging markets is like 2 to 4%. So I'm in competition with Bitcoin now in terms of allocation, and some of it is crossover there. Look, I think that the clients are looking for some sort of starting point, and I think that's a safe starting point depending on your risk, your risk level to really step into some. I mean, again, maybe it's the reason why it's the same or very similar to emerging markets. They have some similar risk dynamics. It's not for everyone. Not everyone will have the exposure in their portfolio, but for those that are interested and want to take a position, that 2 to 4% is a good starting point. Some of us that are more committed to the space probably have more exposure than that. Just guessing.
Yeah. Well, look, where you've come in the last year, supporting some of our products like Stretch through Wealth Management, where I think you're going to come in 2026, allowing people on E-Trade to buy spot Bitcoin, creating a custody and exchange platform, offering yield and lending. Those are huge things. You're going to move into tokenization, into stable coins. That's all fantastic. That's just year one of your job. What happens next year? Where do you see this all going?
The one thing that I actually see is the products are still pretty basic. I mean, we're still at such an early, and I made this point earlier, passive single asset ETFs or ETPs that are in the market. We need, for some of us that have had exposure for years, like where's the active management where I can put my cryptocurrency in an account and have an advisor on my cryptocurrency exposure? It can be considered in that, or that someone's actively managing that for me. That really doesn't exist in too many areas now. Separately managed accounts. I mean, I'm just talking my own personal exploration of going through this space. There's still so many more advanced products that we should see out there. There's still very few actively managed funds that are looking at the cryptocurrency space, and you could kind of go on from there. So I think we're still in very early adoption of this, and there's much more sophisticated products the same way we have in every other asset class today.
Well, look, we're very proud and excited to be partners with Morgan Stanley, and the evolution I've seen in the bank over the last 10 years has been fantastic, and we'll continue the journey together. So thank you, Amy.
Thank you, appreciate it. Good to see you.
Afternoon for our interactive Q&A. Next up, we have 3 sessions. Our first speaker is going to be Ranga Kanthadai, the Managing Director at Jaywood, talking about Bitcoin-linked convertibles, followed by Gordon Grant, Portfolio Manager and Head of Derivatives at Bitwise Management. And then we're going to have Alex Bloom, Co-founder and CEO of 2Prime, discussing methods for generating Bitcoin income. First, please welcome to the stage, Ranga.
So we're here to talk about everyone's favorite topic, Bitcoin-linked convertibles. I'll keep this pretty interactive. I'll just go through the presentation that we have. I'll just click through it, and then we can leave some time at the end for some Q&A if we have. So a little bit on who we are first as a firm before I kind of dive into the meat of the presentation. So we're Jaywood Capital. We're an independent capital markets advisory platform. We're focused on the equity link space. And so this is everything from convertible bonds, mandatories, convertible prefs, and then all the accompanied derivatives that come with. So call spreads, capped calls, ASRs, and the like. It's a more complicated capital markets product, as you can imagine, compared to equity and debt. And that's why we have a great business. We partner with issuer clients, largely public companies, to help them understand and then execute these transactions in a more efficient manner. Since our inception about 13 years ago, we're proud to say we've now done over $225 billion of overall deal volume, and we're only about 25 people, so we're really proud of that. Okay, so a little bit more on the value proposition, how we partner with all of our clients. So everywhere the convertible kind of touches the company, we've got a module or a platform to help them understand and bridge that information asymmetry. So things like, what kind of structure is optimal for me? Should I do a debt structure, a more equity-like structure? What tenor do I want? Should I add a derivative, a capped call, or not? And then we really get into the weeds on all the fun stuff like legal, tax, and accounting. Often we work with issuers for months, and in Strategy's case, even for much longer than that, before we actually come to the market and execute the transaction. And then there's kind of ancillary things that we think about. What kind of investor composition do we want in our final order books? And how do we work with our banking partners and lay out the best syndicate to achieve the best execution, the best research, and ultimately lead to the best superior results? So I'm really proud, really proud of this page. I think two key takeaways from all of our advice in kind of crypto and what I'll call the HPC AI space. The deal sizes vary. You know, we've done deals as small as 100 million for Saylor Scientific last year, where they used the money to buy Bitcoin, to deals as large as GameStop. I can just see on the page 2.7 billion, and then a couple months before that, we did another $1.5 billion for them. So that was over 4.3 billion just in a couple of months. Really just shows the depth of the market, and then also the variety of use of proceeds. And so Strategy, of course, pioneered this. You can use the money to, of course, buy Bitcoin, Solana, whatever, whatever ultimately you want. But you can also use it in certain cases like Iron or Cypher, for a different use of proceeds. If you wanted to kind of build out an AI data center platform, there's a lot of capital sitting on the sidelines waiting to be deployed for growth capital. The only other thing that is probably worth mentioning on this page is, again, I come back to the Strategy example. We raised over 8 billion for them. I mean, the depth of the market is really deep, and you can, again, use it all for building a DAT if you want to, or again, even in Galaxy's case or some other cases, exchanges and the like. Okay, so the numbers may appear a little small on this page, but I just want to contextualize how small our market is actually relative to some of the bigger Titan markets that you guys have probably seen. So you can see in 2022, 23, 24, the convertible market yearly in the US is it's less than 1/10 of the size of the investment grade market. It's roughly about 1/3 of the equity and the high yield market. And again, that varies year over year with equities and IPOs. But the interesting thing on the bottom left of the page is last year, the convertible market was the best performing asset class when you benchmark it against the S&P, investment grade, and high yield. Okay, and so why is that? The index itself returned north of 20%. That's good for both investors making money and also good for issuers. As more capital trickles into the asset class, it just means better terms, better accessibility, better sizing for all of our issuer clients. The biggest reason why the market is so strong and why it's returned a lot in the past year boils down to two things. Volatility. We naturally live in a more volatile environment right now, and a huge driver of the convertible return profile is the option component, and options are driven by volatility. And credit. Credit has naturally tightened in the past year and a half, at least across the different portfolio components in the index, and that's led to a big valuation boost. Okay. Another, just drilling down on specifically the market, last year was a banner year for us in this kind of narrow part of the ecosystem, raised more than 112 billion overall in the market. Globally, I think the stat was over 165 billion in the global convertible universe, and half of that is coming from technology, and another kind of 15% or so from healthcare. So really think about it as growth capital for issuer clients, largely public in nature, and even amongst that growth capital, about 40% is coming from the, call it, the crypto/AI HPC wave that we're seeing. So I like this page mainly because it shows all the different, this is the kind of the who's who list here, right? You've got Coinbase, 3 billion, 0% coupon, 50% conversion premium. You look at some of these terms and you're like, wow, investors are really willing to accept that cost of capital or that return profile for some of these investors. They're willing to give up basically no interest for someone like a Coinbase or a CleanSpark or anybody. And in exchange, they only participate in the upside after 30 to 50% has already elapsed. And the biggest reason is, again, continued volatility that enhances that option component. And that's why we're able to drive such favorable issuer terms. The last thing I'll say on this page is just the maturity stack. The interesting thing about convertibles is it's, on average, the maturity is around 5 years. Both the companies and investors prefer relatively shorter duration. But that being said, the market can be pushed and stretched. So if we want to do 6, 7, and even 10-year, that's open. It's all a question of the ultimate economics. What is the interest rate? Where am I selling stock? And what the final duration is going to be. So just stepping back and just kind of breaking down the various components of, okay, what is a convertible bond? First and foremost, it's debt. So sometimes it gets lost on people, but the important thing to know is if you borrow 100 million from our market and the stock price, let's say, doesn't perform, it stays stagnant over 5 years or it goes down, you do owe that 100 million back in cash. It's a loan. On the upside, if the stock does convert, then you can deliver as the company any combination of cash or shares that you ultimately desire. So you have that flexibility. And so naturally, the convertible is roughly about 70% bond and about 30% kind of this equity call option component. So we have a quick snapshot here, and I'll throw another shout out to the strategy team. They've just revolutionized the market in many ways. Depth and accessibility. We've done over 9 billion now, I believe, of just overall convertibles and convertible prefs that have been raised in this market dedicated to buying Bitcoin. And the kind of the weighted average coupon is under 50 bips. I mean, it's 0.421%. And at least where the market is currently, it's functioning as cheap debt because largely they're out of the money. They're not yet dilutive to the company. The other thing I'll say from a kind of a different vantage point is the liability profile is also pretty largely stacked year over year. So it goes from 2028 to 2032. So we've ultimately, what have we done? We've maximized the net proceeds and we've layered the maturity days just to minimize kind of overlapping risk. Okay. So I wanted to spend a little bit of time on this page just to break down how we think about the real economics when you compare convertibles to, common stock and high yield. So what this chart does on the page is the y-axis shows you cost of capital. Simplistically, it's IRR, it's the return on all your cash flows. And the x-axis, we plot that against stock price at maturity because with any equity or equity-linked product, it's not a fixed point in time cost of capital, it's what we call path dependent. It's you look back at the stock price, see how it does, and then you can judge what is the dilution, how much am I ultimately paying. So the easy way to think about it is for, let's say, high yield, just a regular way bond, that's the green line, that's just a horizontal line at around 8%. Doesn't matter where the stock price goes, I always end up owing 8%. That's the coupon I borrowed or whatever combination of coupon and OID, and that's just fixed. Common stock on the other side is a little bit of a 45-degree sloping line and just shows you that if you sell stock today and the stock price goes up, it's dilutive. There's an inherent cost to that. And conversely, if the stock price goes down, it's a negative cost. It's a benefit to you because you've sold stock higher than where the future stock price is. So the bottom line, the orange line, it's a natural mix of both high yield and equity, which is what a convertible ultimately is. You'll see here for strategies 0% convertible notes, the cost is 0, that's the coupon at the bottom, and then it starts to kink up when it becomes in the money or when it's dilutive to the issuer. And the way to interpret this chart is when you're comparing it to equity, it's cheaper on the upside, and when you're comparing it to debt, it breaks even at around a 15% compound annual growth rate, or CAGR. And so it's a relatively cheap cost of capital, and even when the stock price goes up, it's something that's affordable at that point. You look at this and say, if my stock's going up 20%, CAGR per year, you can afford dilution at those levels. And this chart really, I think, helps especially boards and management teams get comfortable with the product and why it's so economically advantageous. Okay, so specifically for what I'll call Bitcoin-related, crypto-related issuers, Why does this make sense? Why are there so many of them? And why has this been such a market boon in the past couple of years? We talked about volatility. When you hear volatility, really across a lot of capital markets, it sounds a little scary. It sounds like it prevents you from accessing the market. It's not like that for convertibles. The higher the volatility, usually that's an asset in our kind of situation, just because you're able to capture better terms with that volatility. So previously, in our market, before strategy came to our market, the investors applied a cap of 40% volatility. They just said, I won't pay more than 40% volatility. Because normally you would think that over 5 years on an annual basis, stock prices don't move around that much, don't move around plus or minus 40%. Now with kind of the crypto-related space, and especially with strategy, we're able to push that cap all the way up to 60%. And that's led to even substantially lower cash coupons. And so on average, you're seeing here 1.6%. That's the coupon that you pay to borrow money, leverage the balance sheet to go do whatever it is you want, whether that's buying Bitcoin, whether it's building a new data center. It's intelligent leverage. And it's cheap debt on the downside, and it's equity on the upside. So naturally, if the stock goes up, it's a natural de-levering mechanism that you can build into it. And then, of course, you can add all sorts of hedging and insurance protections on the dilution side as well. Why investors like it? This is the hardest part to conceptualize. Why are investors okay accepting a 0% or 1% coupon? So we have a page on this. There's two investor components in our market. There are the hedge funds. So these are not the nefarious hedge funds that you read about in the news. They're putting on a fundamental short. That's not who these guys are. They're looking at overall high single-digit type of returns year over year. They're locking in the equity by shorting a portion of the stock that's relating to the equity sensitivity of the option that the company is selling. And then they're just trading around that slowly and steadily, day by day. And so the natural value proposition for them is volatility. They're able to source volatility at, let's say, 40 to 60% vol, and they're still able to make some amount of spread on that volatility. And then there's about, I'll call it a third of the market, which is the outright or fundamental investor base. These are the Franklins, the Fidelities, the T. Rowe's, the Voyas. They view it as downside protected equity. They're credit investors first, and so they passionately do care about credit. But they say, okay, I have a balanced portfolio. I have high yield here. I've got a bunch of other investments in investment grade. This is just another component of the portfolio where I trade off coupon for potential equity upside. So if they really fundamentally believe in the company, the story, whatever it is, they get unlimited upside potential. Okay. Last thing really, and then I'll kind of turn it over for if there's any questions. Who is this the most applicable for? There's, of course, private convertibles. I won't spend too much time on that because it's a different kind of ball game there. But we largely do our work for publicly listed companies that have a minimum market cap of around 400 to 500 million. Stock borrow is important as a tool for our investors because they, again, borrow those shares and they sell it short and they manage their risk positions around there. And then you just need some level of trading volume. So you need some float out there. If you're a company that's maybe a 500 million market cap, but with only 100 million of float, it's probably not the most applicable for you right now. But it's just something to, I would say, just keep in mind as, for a lot of you guys, as you continue to grow the balance sheet, acquire, if it's a DAT that you're building out, as you're growing and steadily acquiring more Bitcoin or whatever it is, and you're growing as a company, keep this in mind because it's a really great tool for growth capital further down the road. Okay, and that's it. I'll open it up if anyone has any questions. If not, I'm done over here. Thank you, guys. All right. Thank you, guys. Appreciate it. Have a good one.
Here we are. Welcome to Strategy World. Welcome to February 25th of 2026. Welcome to a bullish day for Bitcoin. Feels like a bit of a change. Glad to see that here. So we're going to do this in a little bit of a pedagogical fashion. I'm wearing the bow tie, so I'm trying to be the professorial sort. You've heard a lot about investment opportunities and ways in which you can operate in this industry and find alpha. We'll get into the alpha, but first, a little bit of taxonomy. A derivative, as most people know, is defined in lay terms as a financial instrument whose value and payoff profile depends upon or is derived from the price performance of another instrument. It could be another derivative. It could be a spot asset like a stock or a currency or a bond, or it could be a commodity, a digital one like Bitcoin. So we're here to talk about derivatives. It's not a simple or single thing. Different classifications: linear, like futures and forwards; nonlinear, like options, or power perps, or exotic products. It can be listed, over the counter, bilateral, under ISDA, or in our world, increasingly, not so much in Bitcoin, but in crypto, on chain. So what do we do with these things, right? That's what it is. Why do we care about them? Because derivatives can be a mechanism to create uncorrelated return streams on top of or in addition to the asset that we're all here to talk about, which is Bitcoin. You heard a lot about Stretch. Stretch in its own way has derivative characteristics. I do something a lot simpler, which is I use vanilla options in order to create return streams above the holder beta of Bitcoin. Derivatives can serve a couple of different purposes. I like to put them into three buckets: risk management, capital efficiency, and diversification. We'll talk about how we do that in the next slides. But the key thing is, don't be intimidated. People say, I don't know a lot about options. Seasoned institutional investors say, I don't know how to use this tool. I can't engage with it. We're not going to demystify them. We're just going to approach them as they are, a piece of financial machinery that can be a cog in your machine. There are a number of different facets to them. How long the tenor is. Is there a strike? Is there another obligation? Is there a contingent claim? Is there a whole host of Greeks affiliated with them that you can use to determine just how much your sensitivity is to a change in the price of spot or implied volatility? It can lead to confusion, but confusion should not be a catalyst for inaction. Understanding the basics can get you to making decisions about your derivative strategy. And I'll tell you a little bit about mine. I show you this, I think your eyes, even though I'm a little bit blinded by the light, are going to start to glaze over. You see moneyness of an option on the horizontal axis, and you see the implied volatility on the vertical axis, and you go, what in goodness name does this all mean? What it means is that there are specific relationships that a professional derivatives portfolio manager like I pay attention to in order to extract value from the markets. But you don't need to know, and the dirty little secret is most investment professionals don't know or understand even basic concepts like variance, skew, kurtosis, and the Greeks. We're not going to do a quiz. You can be relaxed. But let's skip beyond this and start to talk about what these mean in pragmatic terms. The idea here is simple. If you hold Bitcoin, you get one-for-one payoff profile. Whether you hold a spot Bitcoin ETF, whether you hold essentially a linear exposure like a future on the CME minus the change in basis, or whether you're actually holding it in a cold wallet or at your favorite qualified custodian. You can get that without talking to me, without talking to an investment professional that is going to think about charging you some sort of fee structure. But what you don't get is the uncorrelated return. And that's what derivatives are here to do. They are here to grind away and mint and mill out that alpha for you while you sleep, while your duly appointed portfolio manager is at work, while your in-house treasury is scouring the volatility surface for the right opportunities. And that differentiation is what separates increasingly the winners from the losers. Interesting statistic, right? We're here today, 69,000 Bitcoin. Anybody know why that number is significant? Not for the obvious reasons, please, but because it is where Bitcoin was in October of 2021. That's 21. What year are we? 2026. 5 calendar years later, Bitcoin has gone nowhere. What did you do? Did you mine alpha, or did you just sit and hold the beta? What does the successful utilization of derivatives look like? Well, of course, I'm going to toot my own horn here a little bit and say that this is a representative series of quarterly returns of an SMA that I've managed over time. Those are percentages in absolute in Bitcoin terms. That's starting in the second quarter of 2021. That's how long I've been doing this. I've been managing derivative strategies, both for a prop book as well as a principal market maker and an asset manager, more or less since the Bitcoin options market came into its institutional adolescence. I've traded about $100 billion of crypto options, not a small amount. What you can see here in the orange chart, of course, Bitcoin's got to be orange, is that in spite of the vicissitudes of price, the derivative strategy continues to accrete value. How do we do that? We start by looking at data. That's what makes the Bitcoin derivatives market quite exciting. There's actually not that much of it. When you look at the S&P 500 options market, VIX vol, Treasury bond futures and options, foreign exchange. I cut my teeth trading G10 and emerging market foreign exchange, something that Amy from the previous panel knows a lot about. You've got decades of data, low latency information with high resolution about the volatility surface and the forward curves, the basis swaps. In Bitcoin, basically, we only have 5 years of data. From Deribit, CME to a lesser extent, OKX and Binance, you can probably throw them out. And since November of 24, options on IBIT. Not a lot, not enough resolution in order to generate the same type of statistically robust inferences that you get if you're doing this in equity land or credit land or rates land. So people like me need to weight just how much we can use that data in order to make decisions. And a lot of us, I think as you'll hear from speakers that follow, take what we would consider to be a blended approach between discretionary management and purely programmatic portfolio execution. I've mentioned a few of the players up there, but as you can see, it's a pretty motley crew. And they don't all trade in the same venue at the same time under the same terms. We're in the process of a grand unification. I started at the beginning talking about over-the-counter listed. There's cash settled, financially settled in coin, physically settled Deribit convention, CME 11 a.m., New York time convention. Take your pick, it's all there. We're still standardizing the landscape of this asset class. But very soon, each of those individual bubbles is going to start to look like one another. It won't matter where your Bitcoin or your IBIT or your WBTC or your LBTC, if you're a Lombard fan, is hanging out. No promotion for Lombard, it's just a big Bitcoin DeFi player. You're going to be able to trade on each of those interoperably, and your capital will become fungible. And with it, new alpha opportunities will unlock themselves. But what that all means is the landscape is evolving. The players are evolving. When MicroStrategy started buying Bitcoin, nobody else was doing it at any meaningful size. Today, Bitcoin treasuries and DATs are a thing of the present and the future. Their participation in these markets is affecting the behavior of this animal we call Bitcoin and Bitcoin options markets. And that means that the old data needs to get thrown out, and the number crunchers like me need to put on our green eye shade and figure out where tomorrow's alpha comes from, because yesterday's is obsolete. So coming back to those three things that I mentioned at the beginning, risk, mitigation, capital efficiency, and diversification. You could talk about them in a couple of different ways. These are some other labels, corollaries. Risk mitigation can sometimes mean principal protection, both passive and active. You got a stack of Bitcoin, like some of my first clients. You wrote it from $100 to $50,000. What do you do when it gets up there? How do you put a floor under the price of your Bitcoin? How do you pull cash out of it or compound it so that you're not just sitting on it? That's a way to think about protecting your principal. Yield, or what I call static return. When you sleep, when Bitcoin does nothing over a 5-year horizon, as lamentably it has done or not done, do you have anything to show for it? And diversification. It could be as simple as you hold Bitcoin, but you want to pull fiat out of it without taking an expensive loan. You want to take the fiat and put it back into another crypto, or use it to buy cash margin derivatives or instruments like ETFs. All of those can happen. The key thing for people like me, and that you need to understand, is that these are not independent facets. Think of them as belonging to an increasingly n-dimensional, we'll call it a dodecahedron, for lack of a better word. And the facets of principal protection are adjacent to yield, are adjacent to diversification, and now there will be bets on correlation. There will be bets on basis. There will be bets on a number of different things. Outcome markets are starting to include Bitcoin and Bitcoin price changes and Bitcoin volatility movements as part of their substance and fodder. All of those are fair game for us that apply the derivatives waters and are things that you need to know about and incorporate into your decisions or ask your own managers to do for you. Relationships as simple as what Bitcoin spot does and what implied volatility does have continued to change and evolve over time. If I were to have said to you a year, 2, 3, or 4 years ago, shock Bitcoin plus or minus 10%, what does implied volatility do? Implied volatility is a parameter that tells you how expensive or cheap an option is going to be based on the expectation of the variance of the return profile. You would have known pretty well what would happen. 2021, back when Bitcoin was hitting 69K for the first time, a 10% upward movement in Bitcoin when the first Bitcoin futures-based ETF called BITO was launched would have been associated with a nearly 1-for-1 movement in vol. Spot up, vol up. That's a regime. From stochastic processes, you could think of it as a Markovian framework. It's a state. Today, snap Bitcoin up 10% like it's done over the last 24 hours, vol might be down or flat. Why? Changing landscape, changing players, changing characteristics, changing balance sheets of dealers and other liquidity providers. If you know what those relationships are, you can take what we call a Bayesian or conditional probabilistic framework for assessing alpha opportunities. What do I mean by that? Well, as a representative example, if the market is pricing that implied volatility will remain flat for a significant rise in Bitcoin, but we have statistical confidence that it will go down, there's a trade. Contrariwise, if we think that the discount in Bitcoin implied volatility for a significant rise is too aggressive, we can take the other side. And the iteration goes on and on every day of every hour with our eyes and our increasingly agentic intelligences looking for these types of opportunities. The point is the landscape is dynamic. The players continue to evolve. The capital is increasingly institutional, and the amount at stake is growing. We can think of a world very soon where everything from stretch to strategies like mine to digital money market funds all have some exposure to Bitcoin's volatility. And what's likely to happen then? More money will come into the system. More alpha miners like myself will begin to apply these waters. And institutional allocators such as yourselves will be asked the question, what are you doing with your Bitcoin? Hopefully today's topic has given you a little bit of fodder for that thought. And hopefully in the coming weeks and months, I'll have the opportunity to discuss some of our alpha with you. Thank you very much.
Thank you. Today I want to talk about something a little uncomfortable, something the industry doesn't want to discuss openly because it disrupts a very profitable narrative. And that narrative is that Bitcoin can generate yield, well, at all, but safely, predictably, and without trade-offs. That doesn't exist. That is false. Not because people are dishonest, but because the language we're using has become detached from the reality of what is actually happening. I'm so grateful to be here. My name is Alex Bloom. I am the founder and CEO of 2Prime. We operate an SEC-registered investment advisor. We are a CFTC-registered commodity trading advisor. And we trade Bitcoin derivatives to generate alpha. And we do one of the largest Bitcoin-backed lenders in the world. We also hold Bitcoin ourselves as operating capital, not as ideology, but because we think it's a good asset to hold. It's worked well for us over the last 7 years. Our clients include many of the largest Bitcoin treasuries in the world, about 8 public companies, some here, including many of the largest on the rankings. And so this gives us a unique vantage point. We see the institutional pressures firsthand, the board meetings, the shareholder calls, the questions about making Bitcoin productive. And we also see what happens when those questions get answered with solutions that can sound sophisticated, but are actually just tail risk dressed up as yield. And the thing about Bitcoin is that there's a lot of tail risk. It is severely mispriced, and it eventually happens. We just saw a 4 standard deviation move earlier this month. So over the next 15-ish minutes, I want to strip away some of that jargon and show you what actually is real and what is possible and what you need to understand before making decisions about Bitcoin treasury management. So it's not a product pitch. I'm just hoping to impart a framework for how you can think clearly about risk. So let's begin. Once Bitcoin moves from speculative bet to treasury asset, once it appears on a balance sheet, once it's no longer some crazy founder's wild idea, but it's a company's, especially public companies, strategic capital, there's a whole new set of pressures that appear. Now you're on board meetings, you're talking to shareholders, and it all shows up basically as one reasonable question, which is, can we make this asset productive? And it's not a greedy question, it's not irresponsible, it's a sign of sophistication. The person asking it understands opportunity costs, that sitting idle cash sitting around has its own risk. And so this is modern treasury portfolio management. And nobody with $500 million would just sit on it in a bank account earning nothing or 0.1% or whatever banks do now. And so the problem is not the question of what can we do to make this productive, it's that a lot of the answers marketed right now are very dangerous. They seem very low risk, and they're not. So let's first talk about what is yield. Like, I know we know what yield is, but the common understanding of what yield is like a treasury. It's something where you, for providing capital itself, you're getting paid a risk-free rate. There is no risk-free rate in Bitcoin. It is not possible. That's it's a feature of Bitcoin. It is a sovereign asset. So calling any products yield in various ways, it conflates income with risk-free returns. To earn a return on Bitcoin, you are inherently short something, some kind of risk. And so part of the confusion comes from how casually we use language. Yield has a definition. I guess there's you could just do a math problem, but usually when people talk about yield, they're talking about treasuries or risk-free rates. It implies predictability, and it implies a high expectation you're going to get your principal back. Treasury bills, again, that's what generates yield. Investment grade bonds generate yield. Yield is extremely boring. It's very low vol. And that's not Bitcoin. Bitcoin is not boring. Bitcoin is highly volatile. Bitcoin is convex. Bitcoin is a strategic asset with different risks. So when we talk about Bitcoin yield, we're already outside of these mainstream financial definitions. It doesn't make it invalid to want to make a return on your Bitcoin, but it's not yield. And so I think we just need to be explicit about what actually is happening, because Bitcoin does not pay coupons and does not produce yield. It does not distribute cash flows. It doesn't yield anything by default. If you're getting yield, you're doing something, whether you know it or not, that's taking some kind of risk. You could be lending it, you could be leveraging it, trading it, writing options against it, exposing it to counterparties and the risks there. And that's not a criticism, it's just a categorization. The yield is not intrinsic to Bitcoin, it is compensation for risk. So here's what people believe when they start exploring Bitcoin yield strategies. They believe that if they're just disciplined and if they work with really sophisticated counterparties, if they use the right structures, they should just be able to make a return without ever losing Bitcoin. And I think especially in tech, we use all this Bitcoin jargon, and it's as though the normal rules of finance don't apply. But if you don't understand what anybody's talking about, it's not because you're dumb, it's because it probably doesn't make a lot of sense. And so people want to preserve upside, they want to minimize vol, they want to avoid losses, permanent losses, and they want to return. And so you can't have all those things at once. What actually exists is different kinds of risks to take. And often they're marketed as yield. They're risks, and they can blow up in your face. And that's the entire story. Every strategy, every product, every method claiming to generate income is compensation for risk. It's not yield in the traditional sense. And the smoother the yield looks on paper, the more likely it's just risk deferred, black swan risk. Hidden, and it's compounding quietly in the background until it's not quiet anymore. Historically, Strategy, this conference, they've generated yield measured as an increase in Bitcoin per share. They sell more shares, they buy Bitcoin, and this works when the market cap of the stock is greater than the NAV. Almost every treasury is trading below NAV, and Strategy itself has moved to selling preferred shares as a fundraising mechanism, and they can uniquely do this. They're way larger, they have a deeper liquidity, they have a derivatives market, unlike almost anybody. Metaplanet is the second closest and is doing similar stuff. For almost everybody else, this is a dead in the water strategy. So other ways of generating income, not yield, on Bitcoin to be differentiated, as Gordon was saying before, need to happen if you're going to put this asset to work. So, and I think that companies that can show consistent compounding returns should be credited with a multiple, just like cash flows have a multiple. Like if the market believes these guys can grow Bitcoin 4% a year, there's probably a 5 or 7x multiple on that 4% if people understand how it's done and it makes sense in some kind of normal financial framework. And that itself can create an MNAV that allows you to maybe go back to the ATM sales strategy as one leg of a broader strategy. And this is the way we think this industry is going, is operating businesses that generate income, strategies that generate income that can be explained and are predictable. So I know we all know what income is, but that is what is possible on Bitcoin, is Bitcoin denominated income. We can take knowable, defined risks, and we can generate returns. And there's no risk-free return. The best you can do is I can at least know when I'm going to lose and when I'm not going to lose, and manage those risks. Anything else is confused. So let's take a look at how Bitcoin returns are actually generated. There's all these sophisticated, both TradFi words and crypto words, hedge funds, structured products, DeFi, derivatives overlays, Delta One. Many of these approaches, they work most of the time. They're well designed. Some work for years. Some generate good returns, but they don't generate yield. They are risk capital strategies optimized for Sharpe or total return. It depends what your priorities are. And calling them yield strategies creates this impression that you're never going to lose your Bitcoin, that it's stable, it's repeatable, and it's not. Alpha moves around in the market. So you're getting paid a return for counterparty risk or liquidity risk, leverage risk, vol risk, often more than one at once. And when those returns are quiet, it looks super smooth. It can look like a very high Sharpe. If you lend your Bitcoin, it's basically infinite Sharpe until they go out of business. And suddenly you wake up and your losses are very sudden and nonlinear. We talk with companies holding thousands of Bitcoin literally every single day. And across all those conversations, different industries, different kinds of businesses, sizes, they all want basically the same 5 things. They want principal protection, they want low beta, they want low vol, they want low correlation, and they want a 5% return. They would be thrilled. And that is understandable. It sounds reasonable. Sounds like modern portfolio management. It's not possible. All those things at once does not exist. You cannot have all 5. And the one you have to sacrifice for any kind of return is principal protection. So I just need to be clear-eyed about that and understand the dangers in pretending that there's no trade-off to be made. So, for those of us around in the early 2020s, this is what happens when risk masquerades as income. In 2020, 2021, all these lenders were offering I remember when they were offering 8-10% yield on your Bitcoin just for lending it to BlockFi, for example. Paid monthly, it comes in, it's like a miracle. And then they're all out of business. Genesis, BlockFi, Celsius, FTX, poof, your money's gone. My mother's still waiting for bankruptcy claims from her money in BlockFi. These were institutional companies. They were everywhere. It looked so risk-free. But what nobody appreciated was that these borrowers were taking that lent Bitcoin and doing extremely risky things. They were lending it to hedge funds using massive leverage, trading it in e-liquid products. They were making unsecured loans across back and forth to each other with fake balance sheets. And they were taking equity level risk, but being paid credit level returns. 3 to 6% near the end. It was higher at times, 8, 10%. And then when it exploded, they all imploded at the same time. Not over months or weeks. Poof, in a day, your 10 Sharpe strategy is all your money's gone strategy evaporated. So what'd they get for collecting all these returns for 3 to 6 years? For 3 to 6% returns, they got years of bankruptcy claims and legal fees was the reward. And that's what deferred risk looks like in Bitcoin when it finally arrives. Covered calls is one thing everybody says, oh, you could do covered calls. Yeah, you can make 1% selling a covered call all the time. It looks great. And then you get a high vol month. And again, you can lose years of return in a single day. These strategies work beautifully until they don't. You sell the call options against it each month, and you collect that premium, and then poof, it's gone. This is just, if you look at covered calls over time, this is what the actual graph looks like. Up, 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 and then down, 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 brutally, sharply over time. And And these trades have gotten harder. The ongoing institutionalization of Bitcoin, these are very crowded trades. A lot of companies in this room are selling covered calls to generate income. So you're not even being compensated well for this massive vol risk that you're taking. Like I said, a single month, you can lose a year of returns in a single implosion, and it's not pleasant, especially when you have to report to a public company. This is just to say we've seen the market structure shift a lot over the last 9 months, year. Basis trade has gotten compressed. I remember when basis, you could earn 20% just being long Bitcoin and short a future, risk-free, delta neutral strategy is as close to risk-free as you can get. That's getting harder. Basis is down, implied vol is down, and then you get these massive spikes in price that destroy you. There's DeFi yield products. Most of them offer under 1% yield. You're taking all sorts of tech risk. You don't even understand that's wrapped up in jargon to make you think that it's safe. And a lot of them are just doing TradFi regular strategies on the other side. I know because some of them hire us to do the yield on the back end of it, the quote unquote yield. So in the end, you're getting a very poor yield. You're taking a huge tech risk. You're taking a huge tail risk, and you're getting worse returns than just doing it in a TradFi way. You can lend Bitcoin out to other groups. It feels great. Oh my gosh, I'm getting 3%. Some big companies paying me. It seems so safe. People lend us Bitcoin. We trade it and make upside beyond 3%. And so again, you're taking equity style risk, but getting paid credit type returns. And there's a long graveyard of companies that have gone bankrupt. I mean, for those around the 2020s, like Genesis, BlockFi, these were like the leaders of the industry and suddenly gone overnight. So for every goal, there's a price. If you want principal protection, you're not going to be able to get a return. If you want low vol, you must accept maybe risks to the upside or the downside. If you want no beta or or if you want very low beta, there's some kind of counterparty risk. If you want low correlation, there's complexity to it. If you want a 5 to 8% return, you got to take some risk. So what actually is possible? There's unsecured lending, Bitcoin secured borrowing, short vol trading, and delta neutral ARB. For us, we think the real opportunity lies in ARB trades across infrastructure. There's still a fractured market, and the most durable returns come from bridging those gaps and getting paid for it, providing liquidity here and borrowing liquidity over there in delta neutral, risk managed ways. It's not magical. It can be explained. It will not last forever. New things show up over time, but there's gaps between TradFi and DeFi rails, different crypto exchanges, and onshore and offshore markets where you can run trades that offset each other, but have some differentiation in what you get paid for them. So, to me, the Bitcoin treasury doctrine is don't lose the Bitcoin. That's what everybody wants, is don't lose my Bitcoin. If you could do something beyond that, great, but don't lose it. Rule 1, rule 2, don't lose the Bitcoin. And so, the first, like I said, you don't lose the Bitcoin. And so, for us, it's just about clarity. It's understanding that every strategy, every structure, every method is a decision about what risks you're taking. And if you accept that Bitcoin does not produce yield, if you accept that any return is compensation for risk, you can at least make clear-eyed decisions. You can choose, I want counterparty risk, or I want derivatives risk, or I want directionality, whatever it may be. It's just to say that these trade-offs do exist. So for actual treasury policy, what does it mean? It means changing the questions you ask. It means not asking what's the yield. It's saying, what am I risking? And that language can shape different expectations. And I wouldn't ask, what can I make on this trade? But say, what can I lose on the trade? Like, where's the downside in this? The upside in Bitcoin is nice, but losing that Bitcoin is a question of survival, especially for public companies. And I wouldn't ask who else is doing this or do they seem smart, but ask yourself, does it make sense to me? If it doesn't make sense to you, don't do it. Just because other people are doing it or it sounds complex or sophisticated doesn't make it a good investment. So these are uncomfortable questions that maybe counterparties, they ask us this stuff when people are hiring us. They don't like it. And there's no rush. Like, make slow decisions. If Bitcoin's going to $1 million, $10 million, you don't have to make a decision this week. Like, you should make very robust decisions that are going to last decades. There should be friction in it. Friction is what makes hard decisions become thoughtful. It makes what looks like fancy marketing become sophisticated. So, I'd say for us, like I said, we're not Bitcoin maximalists. I'm here to make money, and I think Bitcoin is one of the best assets to do it. We hold it on our balance sheet because we think it's a good long-term decision for our business, and we manage the risk around it. We run a lending business, we run derivatives infrastructure, we work with hedge funds, pubcos, trading firms, institutional clients, and we see both sides. We see the pressure to generate a return, and we see the products being marketed, and the language being used, and we see the risks that are not being disclosed. And so the talk is not about criticizing competitors or promoting our services. It's just to say there needs to be a higher standard and greater clarity on what's being done. And we think like if institutional adoption is really going to happen, you can't have blowups of firms and bankruptcies that freak out the entire market and Wall Street. It has to be built on clarity, on transparency, on respect for the fact that Bitcoin is hard, treasury management is hard, there are no magical shortcuts or little turnkey solutions. It's not going to be built. The future isn't yield. It's not available. What's possible is clarity. Clarity about what Bitcoin is, what Bitcoin yield is not, and what trade-offs you're actually making. And those that are willing to make those hard decisions with maybe giving up what they think is a 20% return to get a 5% return are the ones that are here to stay. There will be inevitable volatility, market dislocations, counterparty failures. That's all still ahead of us in many ways, maybe soon with the market down. And they'll become as understood from the beginning. It's not about squeezing out every cent. It's about discipline and survival. It's about long-term thinking. It's about knowing what you're risking and why, and being honest with your board and your shareholders and yourself about what you're in this for. And so that's the work ahead, is not yield products. It's better questions and better partners. So thank you.
It is time for lunch, so please join us in the pavilion for a break. We're going to return here at 1:30 for our afternoon sessions. And remember, at 4:45 p.m., we're going to have that very special interactive Q&A featuring President and CEO Phong Lee and Executive Chairman Mekhail Saylor. We'll see you this afternoon. Have a great lunch.
Hey, Charles, you're free to go to lunch, buddy. Just be back in about 45.
said you said you said like the cool blue light, 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 like the cool blue light.
electronic sound for the home is recorded on 2 separate tracks, each one giving special emphasis to certain sections of the orchestra, as heard from those positions. Now, when played back simultaneously on 2 separate systems, the sounds are blended together to achieve a new dimension in sound, impossible to obtain in a monaural recording.
Welcome back from lunch. As a courtesy to fellow guests and fellow speakers, please turn your cell phones and other portable electronic devices to the silent mode. We will get started here in about 5 minutes. Thank you. Please make your way to your seats. Our program is about to begin. Again, please make your way to your seats. Our program is about to begin. Thank you. Please welcome back to the stage your host, Natalie Brunell.
Good afternoon, everyone. I hope you all had a wonderful lunch. I'm excited to introduce our next fireside chat hosted by the one and only CEO Phong Lee. He's going to be discussing tokenization, the next era of corporate finance, and many other topics with Brett Tejpal, the co-CEO of Coinbase Institutional. So please welcome Phong and Brett to the stage.
What's up, Phong? Nice shoes.
Thank you. I just got them backstage.
All right, we're going to bring this home. My first fireside chat was with TD Bank and Jeff Solomon. My second was with Morgan Stanley. And now I get Coinbase. And I thought that was a nice progression, a nice crescendo into digital assets. Why don't we just start with Brett? I know your background, but maybe some others don't, because you started in traditional finance and now you're co-CEO of Coinbase Institutional. Why don't you let folks know a little bit about yourself? Just a little bit, though.
A little bit, okay. I started at JP Morgan way back when in 1994. as an exotics and interest rate derivative trader. I stayed there for 10 years, moved to London, started running global businesses at a pretty young age. Went into credit and kind of all things new. So equity derivatives, structured products, everything esoteric. Went to Barclays in 2003 and spent the next 17 years there. And I was fortunate over time for 13 years in a row, I was asked to run another business. So it began in fixed income, converts, asset backs, high yield, private, public, prime finance, FX, rates, emerging markets, equities, converts. Eventually, at the end of my 17-year tenure, I was in the executive committee for markets, responsible for all of fixed income and equities. If there's one thing that ties together with that experience, I was always spent my career bringing new things to institutional investors and then running the flow businesses at scale. And so the opportunity to join Coinbase to build an institutional business from scratch 6 years ago was kind of like an epic moment where through boom and bust in banking, I learned a lot. I learned more in the bust and in the post-financial crisis than I did in the boom. And so I was fortunate to have a partnership with Greg Tusar, who complements my skill set, which is deep in fixed income and also equities, but he's got the HFT background, and together we started and built the institutional business. Today, it represents 500 people at Coinbase of our 4,000, circa 500 people. We're somewhere between 20 to 30% of revenue. The institutional assets under custody, the institutional assets are bigger and have been for many years, so about 55% of the overall business is the institutional business. So we've scaled from a very modest beginning to a pretty epic position that we're in now. We have three things. So the Coinbase institutional business has three big pillars. Pillar one is actually the institutional business operates all of our exchanges. So we were your first exchange and custody client. We were on the U.S. spot exchange. So most people who don't know Coinbase think we're an exchange, a retail exchange. The retail consumer is the biggest client of the U.S. spot exchange. We have a CFTC regulated futures exchange on which we have now perps, and we do things beyond just Bitcoin. So we've got other contracts, including things like oil and gold. We have a Bermudian regulated international swap exchange. So that our big splash into the derivative space came about 2 years ago, and now we're circa fourth in overall global derivative share. So we've got a myriad of contracts listed there. And then a year ago, a little more now, we bought Deribit. And Deribit, for those of you that aren't familiar, is the world's largest options exchange, operated out of a combination of Dubai and Amsterdam. And so those are the four exchanges. We've integrated that. Now we have, we think, the biggest and most complete institutional platform, ranging from everything from spot to perps to dated futures to staking to options. So that's pillar one, exchanges. Pillar two is the Prime platform. The Prime platform, for those of you in the room that are institutions, should know all about it. It's the same platform that powers our 90% market share in ETFs. Okay, it's the same platform that we offer to our high net worth, clients that are on the platform. And so that platform is the place where you can buy, sell, store, finance, stake, do all the things that you need to do. What's really interesting about that, and this will be a segue into the next part of the conversation, but that platform, over the years, we've begun to offer the infrastructure that we built as a service. So crypto as a service. We'll come back to this later, but we've actually started a third product group at Coinbase. At the very top, we have institutions, we have consumer, and then dev PG. It's called internally. Externally, I call it crypto as a service. And that's where we've accumulated all these banking partnerships. So that's where PayPal, Revolut, SoFi, PNC, JP Morgan, Citibank are using that platform to power their entry into the space. And the last pillar, the third pillar, is asset management. So maybe 4 or 5 years ago, we helped set a gentleman called Eric Peters and One River at the time, and he filled that business with, I see a few people here, with, I would say, predominantly TradFi people that came from places like Two Sigma, the leading hedge funds, but we're also, mathematicians, academics that came from great places. And that business offered institutional offering for high net worth and pensions. We bought the full business now, I think 2 years ago, rebranded it Coinbase Asset Management, and that is our asset management business. That business manages third-party capital. So high net worth, pensions, UK pensions, so on and so forth, and manages billions of dollars. So pillar 1, exchanges. Pillar 2, the prime business. Pillar 3, asset management. Sorry, that was a long intro.
Tell us a little bit more about yourself.
You said
Brett.
briefly. Was that brief?
Oh, it's super brief.
Okay.
So exchange, prime, asset management, strategy is a customer of the first two. And you were our first exchange and custodian when we first started buying Bitcoin in August of 2020. We had a lot of conversations. I got to know Brett really well at that point in time. And tell me about what's changed in the Coinbase institutional business in the last 5 years. I know the answer is a lot, but tell us about some of the major trends you've seen with the front row seat.
So at the time you came in, we had custody as the foundational. It's the number one thing and will always be the number one thing. So we had that. We were operating at scale, not quite the scale we operate now, but you did exhaustive due diligence on the custody platform. The second thing that we built was the smart order routing platform. And we don't do any market making. You know that, we went through it. Why is that good or bad? I think it's fantastic that we just do agency trading. So we take all of Fong's order flow, we present it in the marketplace, we hide its footprint in markets, and we're able to use it through a host of algorithms and different types of orders in the marketplace. It's really important because I don't principal trade against Fong's flow. So those are the two big pieces. We were adding on other things like staking for those that hold non-Bitcoin, related assets. But then we had this event a couple years ago where, FTX happened. And at that moment in time, it was a pivotal moment for the industry because it was fraud at a massive scale. We didn't lose a dollar. We spotted it. We withdrew our financing businesses, other businesses. Unfortunately, other people did. But it was an important moment. And at the time, the value proposition to trading crypto was really just the investment proposition. Buy Bitcoin, buy other assets, be part of the technological disruption. But we didn't have a full complement of other things. We didn't have international derivatives, which is where the lion's share of all the trading happens. We didn't have perps in the US. We didn't, at that time, have futures, just dated futures, normal futures. So we made a couple acquisitions to help fuel the growth. And what's emerged from that now, there's a good quote that came from John Collison from Stripe. He said, it could be a crypto winter. I don't believe that's true now, but it's a stablecoin spring. And so what's happened is that with the passage of the Genius Act, it's the most important thing that's ever happened to crypto from an institutional perspective. That's the moment where crypto became into the mainstream. You were in the mainstream. You were the first act at scale that brought Bitcoin in, an investment in. The second big act was ETFs. Epic outcome. BlackRock's biggest ever ETF. Phenomenal beyond their wildest dreams at the time. That became true. And then Genius Act. Why is Genius Act so important? It's because at this moment, all the banks, I just came from Davos, we announced that 5 of the largest 20 banks in the world have chosen to partner with Coinbase, just like they did in ETFs. But the thing that's driving their participation is the stablecoin use case, stablecoins and international payments. For a long time, they've debated, is it better, faster, cheaper? It is, but did everyone see Jamie Dimon on CNBC 2 days ago, where he clearly said that JP's always believed in blockchain, and he's scaling it all in. He's a visionary, and I compliment his views entirely, and I mean that sincerely.
Does Brian feel that same way?
We're feeling it because we announced partnerships with them. They demonstrated to the market in December of this past year. I announced that we did a trade with them. I'm not going to say too much about non-Bitcoin, but we did do a tokenization with Galaxy issuing debt. Coinbase Treasury bought, Coinbase Treasury custodied. We also facilitated that with USDC, and it was done on the Solana blockchain. So that was really the, no one's really kind of quite light bulb on that moment. That's the big thing that JP signaled to the marketplace, that everything's going tokenized, everything's being disrupted. And Jamie said it best, where he said, it's obvious, it's better, faster, cheaper. I liked his quote to say, you know, still they're enormous. They did 16 trillion in payments on a Tuesday. So he said the system works, but this works better. And so that's the thing that's changed. So now you've got the investment case of owning Bitcoin, the investment case of being long this whole portfolio of assets, and then you have the utility that we've talked about for a long time is coming true in the form of stablecoin and payments. So now those use cases, like in this moment, we're like, oh, we'll talk about Bitcoin price and what's changed. What's not changed, and especially since Davos and having all these attestations and partnership announcements, what's not changed is actually the institutional adoption of the technology. So that's going to drive us through whatever price dip we're going through now. And it's a tremendous moment for the industry. Market structure is going to happen. Brian's been in DC this past week. We have amazing engagement. We did the right thing as a firm. Brian did the right thing as a leader and bravely withheld his support until we got into a better place. We don't have to deep dive on it, but it's super important. So even if we get a change to administration, which will happen, from my standpoint, I've been in financial markets for 30 years. What big thing has happened in regulation that's been really repealed? And you can't put the toothpaste back in the tube. Once you're operating at scale, you have millions, of people, whether you're aligned to Democrats, Republicans, or whatever, invested in the space. The banks are doing it. Everyone's in the space. You're not going to have a technology that's a better technology to facilitate these things. We're not going to go back.
So that's awesome, and I think the advocacy work that Coinbase is doing for this space is great. So we appreciate it. You get excited that 5 out of the 20 banks are working with Coinbase. Eventually, these banks, and you might have heard earlier, Morgan Stanley stated they're going to create their own custody platform, their own exchange platform. They're going to offer lending. They're going to offer yield. At that point, and as other banks do that natively, not partnering with Coinbase, do you see that as a competitive threat? Do you see that as just making the market bigger? How do you see that? Because it's your business.
Making it bigger. Yeah, it's our business. So I love it, and I'm embracing it, and I'm pushing it forward. It took me almost 4 years to get the PayPal deal done, where we listed PYPL and we gave it great status. And I'm a real advocate of actually having I want to be a marketplace. I don't want to pick winners. So we can skew things a little bit in the favor of USDC as we should as a firm, but I want to see competition. When it gets to banks and everyone, I remember I had a Goldman Prime sort of thing in London. They said the same thing to me. What do you think? And I didn't blink. I said, I think it's awesome. And it's awesome because if you think of Amazon AWS, you think about Coinbase Institutional as an infrastructure layer. Do I think there's going to be 200 banks that build what we have? No, I don't. And I think that they're going to continue to hire us, and they're going to continue to use our infrastructure, and you're going to see Coinbase as the major infrastructure provider to the entire stack. And so it's definitely an expansion of the ecosystem, and it's going to benefit us tremendously.
Great. So we've been talking a lot about digital credit and Stretch, and we've seen Stretch. It's nearly pegged again to $100. It pays 11.25% yield, cash, monthly basis, tax deferred. That's one option. Another option is yield, hopefully at some point in a material way, on a stable coin. How do you see those when you're talking to your institutional customers as options? Do they compete? Are they the same? What do you think about Stretch?
Well, I just want to say you almost made it to 15 minutes without saying Stretch. was a prediction market, I'm sure, somewhere out there on the amount of time. I didn't bet on it myself, but so my big picture on Stretch, I think it's worthwhile to just zoom out for a second and talk about your entry into the space, because what you did then is what you're doing now. So when I remember, because we lived through it together, but when I was looking at the charter of what MicroStrategy at the time could and couldn't do in its treasury, and honestly nervous and a little anxious as you were putting a big bet into the treasury. I'm not sure all of you remember, but there was a massive amount of the right type of disclosure that came from MicroStrategy. And they amended the treasury
the investment policy.
But it wasn't like hidden in a bunch of things. It was advertised. You know, it was put out there and saying, this is what we're doing. We're buying a lot of Bitcoin. The other thing you did is you gave everyone an off-ramp. So I remember that you said, if you don't want it, you can opt out. And you gave investors a chance to actually tender their stock.
Yep.
And you did an amazing job at that. In fact, there's probably, I think there is, I haven't read it yet, the Harvard Business Review on some of this stuff.
Mm-hmm.
So that was an important marker for me on who and how you operate in markets. So that's important. Disclosure, regulatory approval for all those things. When we get into the next chapter of MicroStrategy, I remember again what you said to me. I think at the time you planned to raise $6 billion, which I thought was, I ran converts for 15 years, and I remember just the market being saturated with convert issuers. You know, there's a time in marketplace where it's good, but also, you know, who's going to buy it? You know, how much flow is there really? How much borrow on the stock is there to allow the convert arb world to come in and short the stock? All those things, but yet you surpassed your expectations. You did it again. So that was like chapter 2. Chapter 3 in financial innovation is Stretch. And again, I think you're doing what you're supposed to do, which is to say explicitly what it is, how it works, where it falls in the capital structure, what happens to coupons, what happens to deferred coupons, and under what circumstances you may need to defer coupons or not. And I think you have a pretty compelling to very compelling product. So what else stacks up against it in the world of opportunities? You have things like preferred stock. You have different things that pay, you know, a high nominal coupon, but what's the risk, you know, in it? And so you, again, done all the right things. I think you're advocating, as you have for everything that you've done before, and you have what seems to be an incredible loyal following of people that want to continue to fuel your ability to tap capital markets and actually invest in a scarce asset. So it makes sense. Now, what's really interesting, and I only told you about this backstage a minute ago, was you can get treasuries, you know, who are institutions to nibble and buy a little. And from time to time, we'll do things to say, there's a way to demonstrate that we think this is a viable asset. The next big thing that happens after that is that people that get paid to manage other people's money, SEC registered investment advisors, elect in a world of choice without your advocacy to buy that security. Coinbase Asset Management has done that. So that was the big news. So we've bought, you know, a healthy 8-figure amount of Stretch in client accounts on behalf of those clients who have asked us to execute a strategy, which could be yield enhancement strategy, and we've done it. So that's a big deal. So I know, you know, Fong's been at me for a while, like, you need to buy this, you need to buy this, and you know. Let's see what an independent SEC, you know, RIA chooses to do based on the mandates that they have. And that's happened. So that's a big deal. And I think it's the beginning of continuing to grow your investor base beyond what I think is predominantly a retail, you know, a retail concentrated investor base. So again, demonstration of institutional capital staying invested in the space, finding, you know, they probably bought it at a point where the price had dipped and it was like even more compelling at a lower price than it was at, you know, the initial coupon. So I love seeing that, because that is like, these are the building blocks of getting liquidity in the space, formation. People don't want a one-way door, right? They don't have to buy something like the early ETNs that were out there trading at a discount. We have DATs. Unfortunately, the DATs are in a pretty challenging space right now, trading at deep discount. So we don't want to see that. We want to see the ability to enter, exit with sufficient liquidity. And having, it's kind of cool to have, the marginal buyer when price dips, and that's what happened here. So that's a big deal.
That's great, and I also, Coinbase has also added Bitcoin to its own actual corporate balance sheet, and hopefully, next time we talk, we can talk about Coinbase having stretch on its own corporate balance sheet too. But let's move to tokenization, right? Because if you think about some of the real amazing work Coinbase has done in the capital markets, and the work we've done to revolutionize the capital markets, and what Bitcoin has formed the foundation for 24/7 trading. Where are you on tokenization, and when do you think something might happen, and what would that be?
So I've personally been, having spent my first many years, remember in the beginning, almost 30 years I ran securitization for both JP Morgan and Barclays, and brought tons of new asset classes, made high yield loans and structured products and all sorts of things available to new investors. So tokenization is a really interesting concept. I have a long list of people that want to tokenize things. What I've been trying to think through is like what makes sense. And when I think about someone who sits at the nexus of issuers and investors, I have to reason through what makes sense, right? And so it can't be just a one-sided, it's better for me and not good for you. It has to make sense. So tokenization's interesting. Some people latch on to it because there's a disintermediation of banking. I'm not sure. I'm not really sure that I get the use case where private equity company can lend capital to investment company.
Yeah, and I think for our purposes, let's talk about tokenization of real world securities.
Well, that's an example. But so tokenizing stocks, I think, is incredible. December 17th, Brian announced we're tokenizing stocks. We're all moving to 24/7 trading. All my TradFi buddies are like, Brett, is it really true? Like, how am I going to deal with this? Like how do I structure my work week? Like only the FX guys really run a 24/7 book, and everyone's trying to grappling around how to get this all done. We're already doing 24/7, on our Chicago futures exchange. We're doing 24/7 on tokenized stocks. It is, you've heard Larry Fink say it, you've heard now Jamie Dimon say it, that's where the market's going. So the value proposition for TradFi is better, faster, cheaper at a lower cost. That works. That lower cost should be transferred into, investors, day traders, long-term investors, et cetera. So the technological transformation has value in and of itself for those that are running big, expensive, heavy, bloated tech stacks. That makes sense. But I'm less excited about that part. Coinbase is more excited about getting the user experience to be amazing, right? And being able to go to one place to have your crypto account. Brian is the most eloquent on this, and he's the retail side, it's not me. So you look through, you're able to trade in the same place like you can in our base app now, and you can trade crypto and tokenized stocks, like what else? So what I get excited about is Brian's announcement about Coinbase thinking about bringing new issuers to market, opening up access. All the things that we've talked about for many years are now happening. We've done an Apollo, Coinbase has done an Apollo tokenization. Okay, we just announced a Mubadala tokenization in Abu Dhabi. Big deal. The first sovereign wealth fund to do a tokenization just happened, at the end of December. Coinbase participated in it. So those type of things, that is like a real example of setting the stage for future democratization where people can buy small sums and trophy portfolios of great assets, right? So these are things that I gravitate towards, because I think both the issuer and the investor both benefit tremendously. If there's a single theme to my long list of things that people want to tokenize, I'd say right now it's mostly asset managers who need to find another incremental, not dissimilar to you, by the way. They need to find other pathways to continue to open up the investment pipes for new capital to flow in. So you're doing stretch, you can buy the stock, you can do lots of different things. You can buy ETFs, you can trade in perps, and then getting new assets that are, I don't know, SpaceX is probably headed towards doing something amazing. Maybe Anthropic, maybe OpenAI. Maybe it's not crazy to think that maybe, you'd be able to open, your Coinbase app and have access to something which is exclusive, the privilege of other super high net worth, venture investors only. So this is a really exciting moment in sort of the evolution of crypto markets.
If we go back to the finite, less interesting thing, but I think people get excited about, what's the roadmap, what's the timeline to being able to buy and sell coin and MSTR 24/7 on Coinbase?
I knew you'd find a question that I shouldn't answer right on stage.
How long are we talking about here?
Listen, it's happening, right? Did you all see the announcement on Yahoo Finance that we made yesterday? Nodding heads. So it's all happening. So I'm not saying specifically that's happening, but Brian's talked about wanting to do something along those lines for quite some time. So, the window's open, let's say it that way. And I think it's a more is better, type opportunity. So I would hope to continue to see, lots of new assets come to market in different forms.
Okay. All right. So what's Coinbase Institutional's next $1 billion, $100 million product?
I'd say it's the formation of the CAS business right now, so the crypto as a service business.
Yep.
So that we've accumulated, north of 300 clients now.
That's the one you talked about earlier.
Now,
what's the next one?
No, but this is the thing. This is it's happening.
Yeah.
Okay, so here's a quote from a CEO in Davos. He said, Brett, what you don't understand about our business is that we are the nth largest, but let's say top 5 largest payments provider in the world. Behind JP Morgan, but if you take out the internal transfers, we're even further up the list. And the last 3 board meetings have focused on the fact that we think that this stablecoin payments use case international is actually a threat to our entire operating model. So that's a big deal for him to say that and say we're all in and we're going to go down this path and we're going to choose the right partners to help facilitate it. And we think that the best way to do it is to partner, not to necessarily build in isolation. So if that's been said and is being put into place with the top 20 banks in the world, what are the next 200 banks going to do? So it's not we talked about it and let's move on to the next thing. This is the big chapter that's going on right now. And that by itself is a pathway because then it reopens and, how do we pay interest? How do we finance? Do we use it for collateral? Do we use it for derivative trading collateral? Do we use it for collateral management? I'm not going to go too far into TradFi speak, but these are the things that are really driving. And so you take the combination of crypto forming by itself, TradFi operating at huge scale. We had a small intersection on the investment case, but most of the transactional activity happened in payments across the world. That is the thing that's happening right now, and it is operating at enormous scale.
Awesome.
It will soon operate at enormous scale.
Very exciting. Brett, thank you for your time. Thanks for the partnership and the stuff that Coinbase is doing and you and Brian are doing are amazing. Appreciate it.
Thank you, Phong.
many great insights from that fireside chat. Thank you so much for joining us. We're now going to have 3 more sessions coming up. Our first speaker is going to be Bill Barhydt, founder and CEO of Abra, speaking about wealth and treasury management in the Bitcoin and AI era. Then we're going to be hearing from Nisha Surendran, head of digital asset company at Citi Investor Services, talking about banking Bitcoin. And finally, Denny Galindo, Morgan Stanley Wealth Management's lead cryptocurrency strategist and executive director, speaking about Bitcoin in wealth management portfolios. Please welcome to the stage Bill Barhydt.
All right, good afternoon, everyone. Bill Barhydt, I'm the founder and CEO of Abra. I want to give you a few minutes of our perspective on how we got here, vis-a-vis Bitcoin, crypto, where I think it's going over the next 5 years, and how a wealth management-oriented services portfolio, I think, is going to really be the next wave of Bitcoin and crypto adoption. So at Abra, we run a wealth management playbook, which is basically custody, trade, earn, borrow. And we have a lot of clients who started out middle class and have become crypto wealthy over the last 10, actually almost 15 years now. It's crazy. As a result, they're looking for advisory services on what to do with their newfound wealth. And so we'll advise them, as a fiduciary should, on the best ways to optimize their newfound wealth. And in some cases, it's yield strategies, some cases it's lending strategies, some cases it's both. But to start, we basically give them access to almost a prime brokerage quality service infrastructure to manage liquidity needs. If you're used to managing cash, I don't know how many of you here come from traditional treasury, right? You don't think about liquidity in terms of depth of order book, right? You think about liquidity in terms of, do I have access to my cash? But if you're holding $50 million worth of Bitcoin, right? The idea that you would sell by picking up the phone and calling someone, it sounds simple, and the order execution probably is simple from your perspective because you're saying just go sell, but that's where the fun begins, because you have to trust somebody on the other side that they're not doing silly things like going to an order book, putting in a $5 million sell order, and the next thing you know, you're 20 levels deep in an order book and getting a 4% spread on what should probably be a 20 basis point spread. So I'm going to give you a couple of hints on some questions that you should be asking, even if it's not a fiduciary. And I would strongly encourage you, even if it's for yourself or for your company, is the first question you should ask is, what is your responsibility as my service provider? Are you a fiduciary? If I hold assets with you, are they on your balance sheet, right? Am I getting my own vault that is off balance sheet, right? And having a provider who can actually physically show you that your assets are segregated, preferably on chain, is probably the very first question you should ask. And if the answer is not crystal clear, you're probably with the wrong people to begin with. The second question has to do with liquidity, right? So if I want to trade 50 million into cash, what does that mean? Give me an example of what the spread would be right now if I was to execute that trade with you, and let me go try to execute a fake trade and see what that would be. If you don't like the answer you're getting, you're probably not with a wealth management platform that actually has that breadth of execution skills, custody capabilities that use modern technology like MPC, et cetera, et cetera. And for those of you that are holding cash, then you should also think about, what are my yield options, not only for my Bitcoin, but for my cash? If I'm coming in and out, if I'm actively trading, that's one thing. I do want to earn yield, but we have a lot of clients now who are actively looking at both a combination of not only Bitcoin, but also cash treasury commingled with Bitcoin. And this is where the modern kind of stable coin oriented yield services have become super interesting, right? So we're now offering probably something in the 8 to 9%. It fluctuates day to day, but something in the 8 to 9% on cash stablecoins, and that is in our world the quote unquote safe yield versus what you're obviously getting in a traditional money market corporate treasury. And we're seeing more and more, especially mid-market corporate clients, but it's going up the stack as well, clients who are interested in a combination of that cash yield as well as the Bitcoin yield. But the number may be important, but there are some really more important questions around risk management that you should really think about. Okay, so obviously as a SEC registered investment advisor, we're one of the only companies in the space that publishes an ADV on the SEC's website that you can go to and actually look at risk disclosures around where the yield has come from. How many times have you asked someone in crypto, those rates sound fantastic, where does the yield come from? And you actually either don't understand the answer or you don't get an answer, right? And for us, the good news for you is you're actually obligated to get an answer, and you don't even have to ask us. You can just go to the SEC website and you'll get the answer. But of course, we disclose it within the website as well. So, I think what we're seeing now with kind of what I would call this second generation of crypto investors is that people are getting savvier now. It's no longer, 5 years ago when I would present to RIAs, it was, can you explain to me again what this Bitcoin thing is? We're past that now. And it's, all right, so I get it. I may have some exposure to ETFs, but my clients want direct exposure. They want to earn yield. Can you explain where the yield comes from? And we can actually have a very intelligent conversation about DeFi, how staking works, whatnot, and give them the disclosures they need. And you can also talk about different risk profiles, right? Generally, our clients have a don't put my Bitcoin at risk policy. I never want to lose a single sat, and our risk management tends to be more in that direction. And then on occasion we have clients who are a little bit higher up the risk curve, but in general you should be getting those disclosures as you go. And so that leads to the whole borrow discussion, right? So this has probably become the most interesting for the vast majority of our kind of existing clients. But what's also interesting is we're seeing even more and more who are buying and then borrowing immediately, right? So I know that I have 50 million in treasury that I need to put to work. I'm going to do that, but I want to basically take out a 20-25% LTV loan immediately, or again, I bought Bitcoin 10 years ago. It's now become 50 million, and I would like to borrow maybe at a 35% LTV. And so here, the questions are equally important, right? What is happening to my collateral? Are you rehypothecating my collateral, which in English means, are you lending out the collateral to someone who can then lend it out again, who can then lend it out again? And in other words, you have no idea how deep the rabbit hole goes. And if the answer is yes, I would probably, without knowing any details, discourage you from taking that approach to borrowing against your Bitcoin. And so as an advisor to our clients, we generally advise them to use next generation services that we use off our own balance sheet to test to borrow against Bitcoin where there is no rehypothecation. And we're now in a position to advise and help clients facilitate those loans, and it's become a significant part of our advisory as well. And so if that's something that's of interest to you, you should definitely get in touch with the team. So we're here at the event. The few of us are still here. Come find us. You can schedule via the QR code if you want to learn more. Even if you're not looking to deploy, if you just need to get in touch with an advisor to start to learn the right way to do these things, start asking the right questions so you can prepare. A lot of times you have teams that you have to go back to and educate. We're very good at helping companies figure out how to educate their teams back at the office who don't understand what our illustrious colleagues were talking about when they talk about all the fancy products that they have now in the Bitcoin space. We can help navigate that complexity. We've been at this for 10 years. I believe we're the only SEC-registered investment advisor in the United States that's doing advisory around yield, around lending, staking, MPC technology, all of it for facilitating these types of custody. And so, yeah, please come check us out. Oh, and yeah, by the way, and I've never had a one more thing. It's not my style, but you know, we've been at this for 10 years, and so you know, in the coming days, we'll be sharing the details. But ABRA is going public. We're super excited about it. Thank you. So not only would we be the only RIA doing this, to my knowledge, but we'd be the only public RIA doing this. And I think that having the scrutiny of not only financial regulators, but securities regulators, bank regulators, as we move more and more into that space, as we become more integrated between TradFi and DeFi, it's going to be even more important, in my opinion, for what I would call more the old world to understand that the people who kind of oversee both the old and new worlds are integrated into what we do. And we've thought long and hard about this, and we are fully committed now to you know, going forward from this perspective. You know, I think I have a lot of friends who do nothing but kind of the pure play DeFi stuff, you know, the protocol stuff that, you know, your companies can never touch directly. But now, as a public regulated entity with lots of different regulators, actually, you know, we'll be able to broker access to a lot of those technologies now and help give the public comfort that, you know, we've been vetting these things, and as a fiduciary who has to put your interests first, are recommending things that only we would be willing to use under the same circumstances ourselves. So more details probably next week. I don't know if the lawyer said I'm allowed to say that, but yeah, it's pretty cool what we've done. You'll probably see things like real world equities on the platform as well, so you can build. It's closed room, so I guess I didn't really say that, but you can be able to build, you know, portfolios across different asset types, including our own stock, hopefully very soon. Yeah, as an advisor, if you want to basically have a combined equity crypto portfolio, even that we'll be able to do in short order. So yeah, so the team's here floating around. I think a couple are in the room, but if you just scan the QR code, even if you can't do this, this will take you to the website anyway. But if you can't meet us this week, then you know, the team will usually get back to you in a few minutes. They're very quick. So thanks for listening, and yeah, feel free to find me as well. I'm around for the next day or so. Happy to talk to you about you know, Bitcoin strategy. So thanks for the time. Enjoy the show.
Hi, I'm Nisha Surendran, and I'm here on behalf of Citibank. My role in Citibank is to head our digital asset custody product build out. And I'm here to talk about one idea, why that's important, and how Citi is going to execute on it this year. But before I actually cover that, I want to tell you a little bit about what we're doing in digital assets in this space. So in the traditional world, today, we connect into about 220 plus payments networks, settlement networks across the globe. And over the last 4 to 5 years, we've started connecting to blockchain networks within this infrastructure. Granted, we started with private permission networks, but then as the regulations started getting easier for us, allowed us to venture into public blockchains, and our clients started asking us to connect into public networks, we started doing that as well. So you will see that with digital asset custody, which is the foundational key management, wallet infrastructure, and custody to support assets on public blockchain. And we're also building capabilities to support our clients with tokenization and issuance of assets on blockchain networks. But the use case which has really resonated the last couple of years in production is our Citi Token Services for Cash. So this is a 24/7, always-on blockchain network that's being used for moving money globally within the Citi network. And our clients are starting to see real value. Just a couple of weeks ago, during the precious metals volatility, we had a client in Singapore who had to do a margin call in the US after market hours in Singapore. Now, if they had used the traditional settlement network, the traditional systems, it should have only reached here the next day. But because they used the blockchain rails using the solution, they're able to do real-time margin financing. So yes, as we move into the world of 24/7 assets like Bitcoin, we definitely need 24/7 US dollar or 24/7 digital money. And all our systems and processes are also being uplifted into 24/7 support. Like, we absolutely need that. So in some sense, we are back to the world of Citi never sleeps. So this is the one big idea, to make Bitcoin bankable. Later this year, Citi will be launching our infrastructure that integrates Bitcoin into traditional finance. So we're going to start with core custody and safekeeping capabilities, institutional grade key management and wallet infrastructure. So what does it actually mean to make Bitcoin bankable? 3 things. First, as we said, institutional grade custody and key management infrastructure, bringing Bitcoin into the fold of bank grade risk and controls. We also will be bringing Bitcoin into the fold of the $30 trillion of traditional assets that our clients entrust with us today. So it'll be the same framework that's applied and now brought to Bitcoin. We will be offering our clients a single service model across crypto, securities, and money. What this would mean is we will be feeding the Bitcoin positions through the same reporting channels and frameworks and tax workflows that traditional securities fold into. This will help bring in a lot of simplification and standardization. We've heard from our clients, like, they don't want to handle wallets and keys and one-time addresses. They actually wish we just take that away from them so they can just focus on executing their strategies with Bitcoin or the asset of choice. And they don't have to spend sleepless nights worrying about how they connect, whether it's safe, and all of that. So we will take care of those problems. And why is this important? Like, why do we need to bring Bitcoin into the fold of traditional finance? The first thing it does is reduces operational friction and adoption. I mean, I'm not sure how much this resonates with this crowd. Like, clearly, you're all early adopters. You're probably familiar and maybe even prefer all of the complexities of U2XO and all of the nuances of the Bitcoin network. But the next wave of adoption is not going to come from people like you. It's going to come from the more traditional institutions who probably want to get into the asset class, but are held back by all the novelty and newness, especially around infrastructure, having to build new processes, systems, infrastructure. So taking all this away from them will hopefully help drive adoption. The second point is segregation of regulated custody from trading. Now, this could be a big thing to reduce systemic risk in the ecosystem. And this is something that's in place in the traditional world, in the traditional financial system, especially post the 2008 crisis. Like, there are so many instances and scenarios where if Citi is a trading counterparty on like both sides or one side of a trade, there are lots of scenarios where Citi cannot be a custodian on the same trade. So this is how the traditional world operates. And bringing that same segregation of regulated custody from trading would help facilitate more systemic way of dealing with these assets. And it also helps drive further adoption because all these trading systems and tools now will just need to handle and build new infrastructure on the trading side, and they can just plug in existing rails for settlement and custody, which they do today. The third one could also be really promising in terms of facilitating cross-margining between crypto and traditional assets. Today, the way the world operates, you've got Bitcoin sitting on the Bitcoin blockchain. You've got traditional assets sitting in financial systems and accounts. But the way we're building this infrastructure and the account structure, you have like one big master, what we call safekeeping or custody account, and under which you could hold a range of assets, ranging from, it could be a US Treasury, which is actually sitting at an account of the Fed. It could be a German bond sitting in the German local depository. It could be Bitcoin sitting on the Bitcoin blockchain in an address. Or it could be a tokenized money market fund sitting on the Ethereum network. The fact that all of these are accessible within the same account structure would then make it easier to sort of use these for cross-margining, like use the crypto assets in traditional exchanges or with broker-dealers and vice versa. So we think that could be a big unlock. We'll build the infrastructure for that. So how will Citi do it? I will spare you the details the same way we will spare the details to our clients. From a client's perspective, all they should care and all they should see is they instruct us, we go away and do all the clearing and settlement complexity, and then we report back. Regardless of the asset, it could be an equity, a bond, it could be digital money, or it could be Bitcoin. They could instruct us through Swift, API, UI, and yes, we'll bring Bitcoin into the Swift ecosystem. And depending on the asset, we'll route it to one of those 60+ markets or the multiple traditional securities network, do the processing, and report back to the client. And if it is Bitcoin, then we route it to the network. We obviously need to translate a lot, like to, add in like best practices around one-time addresses, actually translate like a from and a to a UTXO model. There's a lot of complexity there which we'll handle. But all our clients will see is they wait, the block confirmation comes through, and then they see that the transaction settled. And that's all they care about. So that in a nutshell is basically where we are and what we're going to do. So the QR code should take you to the Citi Digital Assets website, where you can see more about what we're doing. Please also drop us an email. If there's ideas, requests, we will start slow, but we will scale. And before I wrap up, I just want to do a little throwback to history. For Citi, building infrastructure to connect networks is nothing new. Some of you may be familiar, like in 1904, when the Panama Canal was built, Citi was the main financing force behind it. Or maybe even more relevant to building digital infrastructure, in 1854, when the first transatlantic cable was built, like literally the first digital project for the world, Citi was one of the main banks behind it. So it cut communication timelines from weeks through ships to minutes through the telegraphic cable. So what we're doing right now is sort of building the same new digital infrastructure to the Bitcoin ecosystem. Hopefully, this gets us ready for a world of 24/7, always-on, programmable assets and AI agents. Thank you.
Hi there, it's good to be here. I guess I'm the second Morgan Stanley speaker for today, so you may get tired of us. We were supposed to have a third, but the snowstorm out in New York kind of slowed us down a little bit. When I started to do this presentation, I was kind of thinking we're close to crypto winter. It could be an interesting time to do something like this. And I didn't realize that like an actual winter in New York with like the worst snow we've seen in years would potentially disrupt it. But here we are, so we made it here today. I wanted to talk to you about Bitcoin and wealth management. Morgan Stanley has been a leader in this space. I think it's partly because of how the bank is structured and how important it is for our clients to make money. You're not really disrupted by crypto, and it's something that we can be a little bit more forward-thinking about how we talk about crypto with our clients. And so we've been a leader for a long time. Just a history. I joined wealth management in 2017 out of the equity research team. Back then, we said, this crypto thing is starting to disrupt some of the traditional fundraising mechanisms, and maybe we should write about it. So we wrote about it back in 2017 for the first time. Then later in 2021, we were the first bank to offer Bitcoin long-only products. We offered a private placement fund, and there was a lot of legal and research work that you have to do to launch a fund like that. You need to look at the pros, you need to look at the cons, the risk, and make sure that the clients invest in that fund are okay with that. So we did that in 2021. And since then, I've written a number of papers on a lot of the topics that people are interested in with crypto. We've talked a lot about asset allocation, we talked about the cycle, we talked about diversification. So there's lots of questions that Morgan Stanley advisors have, and we've tried to help them on this journey. And I always say, I think a lot of you, if you're here today, you probably have a pretty good understanding of Bitcoin, but for a lot of people, it takes several times to really get comfortable with it. The first time you hear about it, and you're like, that kind of seems like it might be a scam. And then the second time, you're like, hey, this is still around? Like, I thought that died years ago. And the third time, you're like, maybe I should dig in. Maybe I should understand this a little bit. So this is some of the stuff that we talk about with our clients when they have questions. We like to lead them through a couple things. So I wanted to start off really just by our most recent report. It got a lot of press back on October 1st. And October 1st was the first time in wealth management that we decided we can actually make a recommendation for people that want to have crypto in their portfolios. Now, before that, we were a leader in allowing people to do it if the client really wanted it, but the advisors didn't really want to make that recommendation themselves, and we had certain breaks on there. Even the advisors that did want to, we kind of held them back a little bit. But on October 1st, we thought there was enough information out there for us to make a recommendation for those clients that do want crypto. So what we said is we have 5 buckets of investors, bucket 1 through 5. And so we said, look, for this kind of medium investor, you could have 0 to 2% of your exposure in crypto, and you're not really going to mess up your portfolio. For the more aggressive ones, it was 0 to 4%. Now, those might sound like low numbers. I know Amy talked about it earlier today. But in terms of a portfolio, that's the level where the crypto exposure starts to dominate your portfolio. So once you get over 4, it starts to be the main variable that you need to watch every day. And so going up to 4 is an area where it won't really mess up your portfolio, but it can add a little bit through diversification. So that's where we came up with these numbers. These numbers assume a 6% annual return for Bitcoin, which I'll talk about how we come up with that. And it assumes a volatility that has been decreasing over time, but it actually might go back up to where it was a few years ago. So we don't assume that it's going to stay at the low volatility levels it's been recently. We assume that it kind of reverts back to where it was a few years ago. Now, underscoring this report, and of course it came out on October 1st, the peak was October 6th, and so there's a long history with Bitcoin of the first futures came out around the 2017 peak, the first ETF came out around the 21 peak, and then our report came out around the 25 peak, and that's typically how it goes. That's the point where people get the most optimistic. But coming out with these products or reports is just the first step. It takes a long time for investors and clients to get comfortable with their allocation. I've even spoken to investors today that say, hey, we saw your report, we started buying Bitcoin, we're only at 0.3 bips or 0.3%, and we're trying to get up to 2 or 3%, and we're going to do it over a year or 2. So it's the first step in a long journey. Now, how do we come up with our annual return assumptions for Bitcoin? That's one thing we wrote about back in 2024. And we use something that I think Michael Saylor has a very similar philosophy. Is what we do is we say Bitcoin is a store value asset. And so it's competing in other store value assets like money out there. So if there's 115 trillion in money, it's got a couple % of that market today. And what you really want to know for returns are really two variables. How fast does that market for store value assets grow? And how much share does Bitcoin have of that market? So the store value market grows around 6.9% a year. That's global M2 growth. And so you have to offset that with the supply of Bitcoin, which would increase about 0.5% a year. And you kind of come up with this level of around 6.5% a year if there's no people that join Bitcoin or no people that used to be holders of Bitcoin that leave the industry. So a lot of the work in that assumption number is your adoption number. And when there's more adoption, you get a much higher return rate. When people are leaving the industry, there's a lot lower return rate. Now, we personally, the way I work on the framework for how to think about this, and so we don't actually talk about like where we think that number will be. We leave that to everybody that's making the investment decision. But we give you this framework and we say, look, if you look at things like income growth, population growth, you can easily get up to like a 10% a year number. And if you start to say, well, now that it's bigger, some of the old holders are now selling, they're getting out of the market, maybe the returns haven't been as good, you can get to a 2 or 3% number. But somewhere between 3 and 10 is probably where the number goes in the next few years, and you'll have to put your own assumptions in there. Now that's how we come up with the long-term return assumptions. Let me turn a little bit now towards the, let's see. Now, we talked about the position sizing. So we talked about our recommendation of 0 to 2, 0 to 4%. Now, how do you put those numbers in context? A lot of advisors actually, they say, I want a little Bitcoin, but I'm kind of nervous about it. I don't know if it's going to go up in value. I don't know if these encryption or these risks are going to hit it. I just don't want to get left behind. So with a lot of investments, people just want to be equal weight. They don't want to be overweight because you're taking a really bullish position, and they don't want to be underweight because you're saying, well, this isn't going to work, and it has been working. So it's kind of a nervous place to be either overweight or underweight. But being equal weight is a nice place. You're not taking a big position. It's really truly the efficient markets theory. Like if you're equal weight, you're just going to get the average return. So what does that mean for Bitcoin? When we think about Bitcoin, we think about 3 investor types, and most people are going to fit in these 3 buckets. So the first bucket is your digital gold bugs. And these are people that found Bitcoin and they said, look, this is a lot like gold. It's got limited supply growth. If the government's printing money, if there's a lot of inflation, this is an investment that should do well. So a lot of people put Bitcoin in the same precious metals bucket that they have. Now, precious metal buckets in portfolios, usually around 5% is a pretty common number for your precious metals exposure. So for equal weight Bitcoin, you could say Bitcoin is about 4% of the market cap of gold. So therefore, that 5% precious metals exposure, maybe you should have 4% in Bitcoin. And that leads you to about a 20 BIP exposure. Now, other people think of it more like a disruptive technology. So if you look at any investment, and AI is the poster child these days, there's these crazy investments. They seem really wild, and then they reach that first 1% penetration. And people say, okay, maybe it's not so crazy. It got to 1%. The real question is, how much is this going to capture of the entire addressable market? And so these can be great investments. If you find something early that has low adoption, and then over 10, 20, 30 years it has higher adoption, it's a great investment. But some of them do fail. So when we think about investing in that type of philosophy, it's a venture capital idea. It's like, hey, this could be a great investment. I'm going to hold it for a long adoption until it reaches peak penetration. So if you look at venture capital in people's portfolios, people have about 20% in alternatives, and maybe 10% of that might be venture capital. So about a 2% allocation to an entire portfolio. If you look at the size of the crypto market, it's about the same as the venture capital market. So you could say, hey, if I want to be equal weight, I can just split my venture capital half and half between Bitcoin and between my venture capital investments. And that gets you to about a 1% position. The third bucket are what I call the portfolio diversifiers. These are people that say, look, Bitcoin is interesting. It's very volatile. It's had good returns, and it's not correlated to other assets. It tends to zig when other things zag. I don't know if it, how well it does, but if it just doesn't die, if it doesn't disappear, I can stick a little bit in my portfolio, and it will actually help diversify the entire portfolio. So some of these investors are going to have an equity-only model, and so they're going to put Bitcoin as like similar to an equity. Some are going to have a bond and stock portfolio, and they'll stick it in there. If you look at the size of the market cap of Bitcoin, you come up to 1% of a bond and stock portfolio and 2% of an equity-only portfolio. So these are the other places where you'd be equal weight. And so that's how we think about position sizing. Our 0 to 4 guidance is basically saying you could be maybe twice equal weight, or twice, if you wanted to be overweight, would be the 4% level. So that's a high-level view of how we think about position sizing. There's other, let me see, my next one on here. The other thing that comes up a lot is people talk about, well, there's these long-term returns in crypto, but I know it's very volatile, and you tend to notice after a while that there is a 4-year cycle. You tend to have 3 up years, 1 down year. And anyone that's followed it for a while kind of knows about this cycle, and it's something that new investors often don't know about. They often have never even heard of it before. A lot of people will tell you the cycle is old, it's not going to be around in the future, it's an artifact of the early days. But when something is repeated this many times, you do have to give it the benefit of the doubt. And so we have a 4 seasons of cryptocurrency framework that we think about the cycle. Each year is kind of similar to a season. There's a winter season, which looks like we're in now, and there's spring, summer, and fall seasons. Each season you kind of want to do something differently, but you kind of want to know which season you're in. Now, what causes these cycles? There's really 2 explanations that we think resonate. One is the macro and one is a micro. And this is true for all kinds of investments. If you look at NVIDIA, some people will say, hey, it went up because interest rates were down. Other people will say their new chip is amazing. So with Bitcoin, what are those macro and micro solutions? The macro is really that Bitcoin has a high correlation to global money supply. When it's accelerating, it tends to go up. When it's decelerating, it tends to go down. Now, money supply recently has kind of peaked out around 10%, and it's starting to decelerate. And so a lot of people that look at money supply are starting to think we're in the down part of the cycle. The bottoms-up explanation is related to the halving, which I'm sure a lot of you know about. So the halving, of course, every 4 years, the number of Bitcoins produced is cut in half, and it creates a supply shortage. That creates positive price momentum in the price of Bitcoin. People, when they see positive momentum in an investment, they tend to invest more. And so you tend to see a levering up of people investing in this asset, and it tends to go parabolic, something pops the bubble, and then the whole bubble unwinds. And we've seen that 3.5 times so far. I don't know which of these is the most true, the macro or the micro bottoms up, but I think both of them are an important thing to follow. And so our investors hopefully are aware of this cycle, and they may not agree with the cycle, but you should at least be aware of it if you're going to be investing in crypto. Now, the last thing I want to leave you with is, like, if you're thinking about investing in the crypto winter, there's a couple things you can do. There are people that just hold on for dear life, and they just say, I'm just going to ignore it. You can never predict it. Other people reallocate to the parts of crypto that do a little bit better. You could look for fixed income opportunities that maybe sell vol, turn that into income, stable coins, tokenization. Those are things that tend to work well in the crypto winter. Or maybe stocks that, companies that have a fixed income that's somewhat tied to Bitcoin that converts the volatility of that asset into an income stream. Those are all things that are good to do in the winter part of the market. So that's where we are today. You know, we think we're in the winter part of the market. Let me give you a few more updates about what Morgan Stanley is doing in crypto. And this is the part of the presentation my colleague was supposed to deliver. So I'll try to remember all his details. We tend to have people for our clients that are either allocators or traders. And that can be a family office. That can be a wealthy individual. It can be a less wealthy individual. And they all kind of react a little bit differently. But there's a lot of them. I'd say most of them are really this allocation type investor. Now, for our clients, so far, most of the activity has been in the ETFs. The most popular ETF has been the IBIT ETF, which has around $2 to $3 billion amongst our clients. Most of that is in our brokerage business, which is a commission-based business. And then a lot of it is in our E-Trade business, which is a discount brokerage business. Very small percent, around 10% or less, would be from the advisory channel, where advisors are recommending, hey, I think you should own Bitcoin, and we're going to put that into your portfolio. IBIT has been the most popular. The second most popular is MicroStrategy. So MicroStrategy has been around a $1.5 billion. Most of that is in the stock. And most of that is, again, in that kind of brokerage or E-Trade channel. There are, maybe $200 million or so in the preferreds. And so that's a new category that people are finding interesting. I think people don't know about it. Any new financial instrument, you have to be skeptical when it first comes out, how it will do. And I think people are starting to watch this. It's an interesting winter investment, but not many people have actually purchased them yet. And we'll see what happens with that. The third category would be the other ETFs. So we do have a lot in the grayscale ETFs and the Fidelity ETFs, but smaller. Grayscale, I think, is less than $1 billion, so is Fidelity. And again, mostly through the E-Trade channel and through the brokerage channel and not the advisory channel. Now, if you look at the history of what we've done here, back in 2017-18, we had ETFs of crypto companies. We started offering unsolicited ETFs when they first launched in January 24. And we started offering solicited ETFs in brokerage back in August of 2024. And then we just had the advisory channel ETFs that were listed back in October 15th of this year. In the future, we're still doing a lot. We are, we've announced that E-Trade will be offering trading in Bitcoin, Ethereum, and Solana. We're looking at more ETFs on the platform. We're looking at borrowing and lending. And there's a lot of things that we're working on to further integrate Bitcoin and cryptocurrency into the investment menu for Morgan Stanley. So we're at the beginning here. I think we're going to continue to lead the way. I think we have an open mind about how these things can be good for some investors, maybe not all investors. I think that the big risk that we always talk about is encryption failing. If encryption fails, it would be pretty devastating. So we view encryption or a software bug as the biggest risk. And for some investors, those risks are so big that they just wouldn't want to take them. So that's why our recommendation is 0 to 2 and 0 to 4 and not 2 to 4 like some people say. Some people, it's like having an apartment building on the San Andreas Fault. It can make rents for 100 years, but when the earthquake hits, you need to have a plan to get out when the earthquake hits. And so we view the encryption risk, the software bug risk, as like an earthquake that you have to be ready for, but it doesn't mean you don't want to invest. You might want to invest. It's up to the individual investor what they want to do. And hopefully we'll give you the tools to make that decision for yourself. But with that, thank you so much.
This year's Legal and Regulatory Panel. It's going to be moderated this year by Thomas Chow, Executive Vice President, General Counsel, and Secretary at Strategy. On the panel is Connor Brown, Head of Strategy at the Bitcoin Policy Institute, Dax Hansen, Partner at Perkins Coie, and Brittany Ruiz, Partner at Latham & Watkins. Please welcome the panel to the stage.
So a huge welcome to our regulatory and legal panel. This year we only have 30 minutes, so we're going to try to cover a lot of ground on some meaty topics in a rather short amount of time. So please don't be surprised about the rather quick pace. To kick off, I do want to frame our discussion a little bit by zooming out wider than the last 3, 4, 6 months to the last 14 months and the past year and the new administration. When we do that, we look back and see that it's been an incredible time for Bitcoin and for digital assets generally. For the last year, digital asset legislation and regulation has been top of mind for Congress, the SEC, the CFTC, and the White House. From the Genius Act to SEC guidance on tokenized securities, digital assets are at the forefront of discussions, not only politically, but they're part of the public discourse. And when I look around this room, at many of the attendees here this year at Bitcoin for Corporations, I'm seeing a lot of financial institutions coming and getting more and more interested in holding Bitcoin, working with digital assets, and providing services to other institutions and ultimately to retail investors and consumers. In our minds, and in my mind, this is a very special time for crypto. And for those of you who know Greek, there are actually 2 words for the concept of time: chronos and kairos. Chronos is that word that describes linear time, the passage of time. Kairos describes the sense of time that is one of opportunity and one that you can take advantage of. When we look back at this past year, this is actually Kairos time, and it's a time to build. And so this panel is going to cover not just developments from the past year, but we're going to try to help people in this room figure out ways that each of us can contribute to the policy and regulatory dialogue on a go-forward basis to make this better for our entire industry. So with that in mind, the first area that I think we need to focus on and seize the opportunity with is in capital markets. Now, we've seen interesting products, such as Strategy's flagship product, Stretch, but we're also starting to see other innovative approaches in capital markets. And so, Brittany, I'm going to turn this to you first. In your mind, are capital markets still open for business for Bitcoin and other related products? And what are you seeing amongst your client base?
Well, of course, I always think the capital markets are open for Bitcoin products. So for others, I think, we've been seeing a little bit of a slump in the market, in the digital asset treasury market, as we had a proliferation of companies adopting the strategy that Strategy adopted, several years ago. We saw DATs launched for Solana, for ETH, and for various tokens. I think, Bitcoin has the advantage of being an institutional grade, token, and that has the ability to survive the volatility in the digital asset treasury market. So we've seen some interesting things happen, probably most recently, aside from the various products that Strategy has launched. Strive, launched SATA, as you mentioned, which is a variable perpetual rate preferred product, very similar to Stretch, that's designed to trade at or near par. Metaplanet, they've always kind of doing some interesting things, equity raises, 0-rated bonds, and various other products. Of course, as I mentioned earlier, we do have some other DATs, with respect to other tokens, SharpLink Gaming, for example, various Solana-focused DATs. But I do think the capital markets are open for business. My clients are consistently innovating, thinking about where to go next, not just focused on U.S. markets, but focused on Europe, Asia, and elsewhere. And so I think we'll continue to see a lot of innovation in this space.
Great. So, Dax, we see all these things happening in capital markets. We see things in yield strategies that DATCos are taking advantage of. Another area that I think is ripe for the taking is tokenization. Mm-hmm. And last year, at all the conferences that we went to, Bitcoin, Consensus, real world assets and tokenization were really the two buzzwords that kept coming out. What are you seeing amongst your clients? What are you seeing in the space where people are starting to actually tokenize and take advantage of capital markets? And what are the things that we can do to take really advantage of all that potential there?
Yeah, great question. So I think there's a hunger for assets other than the blockchain native assets. And so there really is an opportunity to take other traditional financial instruments and assets and make them blockchain enabled by attaching them to some sort of a token. And that can be some sort of like a mutual fund or some bonds, often some sort of loan assets. It's going to be the range of traditional financial instruments that are sometimes illiquid and hard to trade. There's a lot of opportunities in the private markets here, things where there's a lot of inefficiencies perhaps. It's slower. There's an opportunity to create some operational efficiencies, chance to democratize access to them. And so we really are seeing in the first instance a lot of funds that are being tokenized. And when I think about the issues related to that, it's to ask, well, what does that token represent? Is that token actually beneficial ownership of the security? Is that token just an instruction token to a transfer agent, or is that some sort of a claim to a securities entitlement to the security that's held by some third party? At the end of the day, these assets are coming into the system that can be used not only in traditional markets, but also like in DeFi, where there's a real interest in having real-world assets to back up a lot of the activity in DeFi. One of the issues that comes up often, though, in tokenization of these financial instruments and the regulated instruments is to figure out the anti-money laundering considerations and the sanctions considerations, and that goes to some of the transferability. And so often, maybe the first guardrail is to figure out if it is blockchain enabled and it's transferable, do you have the ability to block and freeze and whitelist those assets? But I think all this matters because we're growing the infrastructure around digital assets, including Bitcoin and stablecoins.
Yeah, so it definitely seems like it's still early days and a lot of the functionality needs to be built out for tokenization. I'm going to pivot a little bit and go back to Brittany. We've heard from some of the banks that were here already presenting that they are getting more involved in digital assets, right? Morgan Stanley has a pending Bitcoin ETF now, and who would have thought that one of the big three bulge brackets would be doing that? And we heard a little bit that Coinbase and others want to provide, digital custody services to more and more. So what other adoption are you hearing amongst your client base within traditional finance, large financial institutions? What are they looking to do next?
Yeah, so it's interesting because, last year we speculated on what we might see the banks do this year. And now we have the chance to see, after the repeal of SAB 121, whether any of our predictions came true. And in particular, I think after the repeal of SAB 121, which basically forced banks to hold their customers' crypto assets as liabilities on their balance sheets, effectively blocking, the banks from participating in the digital economy, that repeal has allowed the banks to offer a lot more services in the digital asset space. In particular, you see banks such as JP Morgan, State Street, BNY Mellon offering custody services. JP Morgan has also announced that they're considering allowing Bitcoin and ETH to be collateral for loans, and other banks have followed suit. SoFi offered direct digital trading for their customer accounts. They were the first to do that. So we've been able to see really a lot of innovation, by traditional institutional players and a lot more product offerings for their clients after the repeal of SAB 21, and it's been a really exciting time. And it's also nice to know that I was right a year ago. So.
No, it definitely helps to be right?
Yeah.
Because then we can invite you back to next year's panel, and then you can say things that you got right again this time around. So, Dax, what else are you hearing amongst your clients? Because I know that both of your firms are service a little bit of a different client base. So what are you hearing in terms of traditional finance and institutions getting involved?
Sure, absolutely. So outside of those services like custody that Brittany mentioned, I've seen a big interest in stable coins and tokenized deposits in particular. The Genius Act really provided the regulatory certainty that I think that a lot of the banks needed to get involved with some form of digital asset, in this case, the stable coins. So there's an interest in taking some of the deposits related to those stable coins, figuring out how to integrate them or some tokenized deposits into their systems for their customers for international payments. And so there's a lot of focus on wallets and on the infrastructure to support digital assets, and even things like the monitoring of those transactions using the tools to monitor the blockchain. Outside of that, there's an interest also, I think, in wealth management, wealth services, and professional fiduciary services. And then lastly, we just seen a very active OCC, Office of the Comptroller of the Currency, chartering many new entities as limited purpose trust banks to engage in a whole host of activities around custody and lending and trading.
That's great. So custody, lending, trading, new bank charters. So there's a lot going on. But all of that then is predicated on continued and productive regulatory discussions. So I want to turn to you now, Connor. What do you think we should expect from regulators in this coming year? Are we going to finally see this SEC and CFTC joint rulemaking? And are we going to see harmonization around digital assets? What can we look forward to?
Yeah, I think a lot of it comes down to what's playing out in the Senate right now. So TBD. I think that broadly speaking from a regulatory perspective, we know the direction of travel for the next couple of years. We've seen joint statements by the SEC, CFTC. I think that joint rulemaking is probably next in order. Whether or not we get market structure legislation is obviously going to weigh heavily on this. And my guess is still sort of 50-50 on that. It's going to really hinge on these sort of last minute negotiations before midterms. But I think that, we'll continue to see more certainty and more clarity for traditional institutions as they get more comfortable. It sounds like as your clients are getting more interested in it, the regulatory groups are really trying to say, look, we're open for business, come and talk to us, and they're going to be looking to make sure that the industries have the guidance that they need to sort of, really go head first into this industry and make the most of it from their business perspective.
Yeah, and Connor, just anecdotally, there's so much more comfort now among my clients when we discuss issues that we don't have the certainty that we'd like to just pick up the phone, call the SEC in a way that there wasn't that comfort maybe doing that in prior administrations. And so what we're seeing is our clients are taking advantage of this time to put in front of the SEC a bunch of no action letters to cover all of these issues that have kind of been hanging in the balance for several years, and to get the kind of clarity, the kind of legal clarity that they need to proceed. And so I think in the coming months, I mean, I can't speak to a lot of these because they're still in a confidential process. We're going to see the SEC, making a lot of interesting decisions and announcements that aren't just in the form of speeches, but in the form of, no action letters, which have much more of a binding and comforting effect for my clients to take action. So that's been a really exciting development.
Yeah, I think we're going to see a lot of no action relief. And I think that the SEC especially is looking for ways that they can clarify rules of the road. And it's just such a stark 180 difference from a couple years ago where, you'd be worried about sticking your hand up because you might get a Wells notice or something. So yeah, I think we'll see more, specific fact patterns that are getting sort of hammered out for clarity.
So we have exemptive relief increasing. We have people going and lobbying Congress around clarity or the Senate market structure bill. Connor, what are some other things, though, that people could be doing? Like, are there other quick and easy wins for people in this room to move the needle a little bit on legislation or regulation?
Yeah, I think the biggest thing is to stick your hand up. I mean, a lot of people, whether it be in Congress, whether it be at these agencies, they really want to get this right. and they lack the technical expertise, both from how does this technology function, what is the opportunity for the market, what business lines would you want to put together, but you don't have the certainty on it. This is something that we deal with a lot at Bitcoin Policy Institute, is how can we translate what we're hearing from industry to make sure that America has the tools at its disposal to be sort of the Bitcoin superpower of the world. And I think the key thing is just go talk to, every corporation, has representatives in Congress. Go talk to them, talk to the staffers. You'll find that they are remarkably open to hearing your concerns and will route you to the best way to make a difference. And also get engaged with, the people in DC that are working these issues. We all the time are taking ideas that we hear and turning them into research reports, papers. We're taking meetings and sort of talking about what we're hearing for how the U.S. can lead on this. So get in touch with us and get in touch with other policy groups in D.C. and really think about making an impact. I think a lot of people will typically be more passive or see the law as some fixed thing that is difficult to change or not worth engaging with. But especially right now, especially with an administration that is so pro-Bitcoin and open for business, there is a huge amount of leverage that can be sort of used there. And I think it's on everyone to sort of figure out the best ways to plug in and get involved.
So that was music to my ears because I heard Bitcoin's superpower of the world. And that actually is a good way for me to then pivot and think about, let's talk about Bitcoin, because we've been talking about capital markets, we've been talking a little bit about regulation, but let's talk about Bitcoin and treasury strategy. And in particular, what are companies doing to maximize their balance sheets? How are they getting involved in Bitcoin, or Bitcoin adjacent products? So yesterday, we heard two great announcements from both Prevalon Energy and Anchorage that they are acquiring Stretch and putting it on their balance sheets. So I'm sure other companies, though, are exploring other ways to get more involved in the Bitcoin ecosystem or hold Bitcoin. So I want to start with you, Dax. What are you seeing amongst your clients?
Well, I think most of them are just continuing to just hold Bitcoin in particular. Many of them are exploring how they might loan against it, be able to borrow against it. If they're non-DATCOs, they are just continuing to build and to innovate, build the wallets, the custody solutions, the user interfaces that need to be improved to make Bitcoin ready for prime time. There's Lightning development. For the non-Bitcoin digital asset treasury companies, I think they, depending on the protocol, have some additional options. If it's an asset that's a proof of stake token, then they're usually employing some sort of a staking strategy to earn some additional yield or rewards off of the assets that they're holding.
Okay. And Brittany, what are you hearing amongst your firm's client base?
There's a lot of public company adoption of Bitcoin, not just what I would call, the digital asset treasury companies, the Strategy and Strives of the world, where they're kind of Bitcoin first, but also just companies that do something else that view Bitcoin as a balance sheet class asset to have. And so over 170 public companies are holding about 5% of, the circulating Bitcoin supply. Bernstein projects that, in the next few years, $330 billion of Bitcoin will be held by public companies. So we definitely see, Bitcoin being adopted, by public companies as a long-term store of value, and they're treating Bitcoin like real estate, and they're holding it through volatility cycles, and it's transforming Bitcoin from a speculative asset to something more akin to gold. As Dax mentioned, as we mentioned earlier, we're seeing, Bitcoin-backed loans, and then, of course, most excitingly, as you mentioned, the announcement of Stretch being acquired by Prevalon and Anchorage Digital, which I think, again, just represents kind of a further adoption of, of Bitcoin as an institutional grade asset. So there's some, really exciting times here for public companies. But anecdotally, I attended a panel of 170 GCs of high growth tech companies. So not GCs of digital asset companies, who came and dialed in to specifically hear about what they needed to know if their CEO founder wants to have Bitcoin on their balance sheet, the issues they need to consider. The fact that we were able to get so many people into a room that wanted to listen about that, I think just speaks to how far we've come over the last few years.
All right, I do want to pivot a little bit because we could talk about Bitcoin forever, but I do want to get into a little bit more of a spicier topic, which is we're seeing all these great developments in capital markets. We're seeing companies explore Bitcoin, but we're also seeing now private actors trying to shadow regulate Bitcoin and digital assets. So let's start with MSCI and its consultation last year, where they were actively looking to exclude companies with over 50% of their balance sheets in digital assets. Was there an actual justification to that? And as they do that, these neutral indices like MSCI, FTSE, S&P that are supposed to be neutral, aren't they really just passing judgment on Bitcoin and trying to scare the public? Or at least that's how I perceive it. But Brittany, would love to get your thoughts on that.
Yeah, I mean, look, there is always a risk, and we saw that with the MSCI rule proposal of private entities, private players in the market, imposing de facto regulatory constraints on the digital asset industry, right? I think MSCI's rationale for excluding companies that hold more than 50% of their assets and digital assets from their indices was because that they look like investment funds. And in fairness to MSCI, I understand why they exclude investment funds, from their indices, but we aren't, digital asset treasury companies, the ones that hold Bitcoin aren't investment funds, right? We're not regulated by, we're not investment companies. Bitcoin is a commodity, and no similar standards exist from MSCI for companies that hold gold or other commodities. So it felt very arbitrary to single out Bitcoin, but not single out other commodities as well. It's even when you have all of the support of the federal government, the presidential administration, the SEC, the CFTC, all of these regulators, you still have the private market acting like a regulator, in kind of their day-to-day activities. And it's important that, we're vigilant about that we mobilize Bitcoin for corporations and strategy. We're obviously, incredibly key in, ensuring that rule proposal was not adopted. But, I'm sure that there will be other fights to follow with other private players in the market.
Well, let's actually turn to another one of these fights then. The Basel Committee on Banking Supervision in 2022 set the risk weighting for Bitcoin at 1,250%. And in comparison, other highly volatile securities are ranging anywhere from 150 to 250%. And fiat currency, which today actually shares many of the same assumptions as Bitcoin and how we value Bitcoin and how we look at it as a store of value, fiat is at 0%. And so is this another area that the industry can push back on and take an advocacy role with? And so I'm going to turn this one over to Connor.
Yeah, I think this is a great example of ways that you can weigh in. We just published a paper at BPI on this specific issue on Basel and basically took a look at it and said the treatment for Bitcoin is completely out of line with how anything else is treated under the risk weighting frameworks. You have extremely illiquid, opaque, highly risky credit instruments that are at 400%, and Bitcoin's at over 3 times that at 1,250%, despite the fact there is no counterparty risk at all. There's no credit risk. It trades 24/7. It's completely transparent. You can audit it at any point. It's an asset that should have, close to zero, apart from the operational risk of just managing your keys. And so our recommendation is this is a point where we can say, look, the legacy financial system is not catching up to Bitcoin. And American regulators need to say, look, if we want to lead on this issue, then we need to look at what the international standards are and figure out where we need to diverge from it. And our recommendation at BPI is that the U.S. should advocate for changes, or for its own corporations, for banks in the United States, they should have a separate risk weighting. Ultimately, these are just recommendations. They're not binding. And it really does inhibit American capital markets. It inhibits American Bitcoiners. It inhibits American Bitcoin companies. It inhibits our banking sector from allowing this to flow through sort of an artificial, stifling through these numbers that Basel came together. And I really think it comes to a misunderstanding of what Bitcoin is. Yes, Bitcoin is new, but its properties, why Bitcoin is valuable, comes down to long-term fundamental properties that other things have been valuable for as well. Gold is risk-weighted at 0%. Gold is risk-weighted at 0% because it has no counterparty risk, because it has a lot of the same properties that Bitcoin has. So I think this is like the perfect example where you should, all of us should be proactively searching down the sort of discrepancies between, where the barriers are for legacy finance and how Bitcoin can fit into those. Because I think the people that are making the decisions on implementation are amenable to these arguments. They're certainly receptive to it. It just needs to be brought to their attention and advocated in a smart way. And I think that everyone will sort of be better off for it.
So in your mind then, are things like Basel or the indices getting involved, is this Operation Choke Point 3.0 kind of happening in the background? Or is it actually a lot more innocent than that? And it's really time for people in this room to take advocacy positions to get things changed?
It's tough. I think in some ways, some of it is probably just a knee-jerk reaction. Bitcoin was initially thought of as this thing that was like completely anti-bank, or it came from parts of the internet that were anarchist or something like that. And so the initial reaction to it might have been, all right, we need to really be careful with this stuff. But I think as it's matured, as people have got to understand it better, it's really seen as a tool for everyone, for individuals, for corporations, for countries. And so I don't think at this point, I don't want to ascribe ill intent to people that are just not grokking it and they just haven't done the homework yet. So I think for something like Basel, maybe it is just a question of they don't understand the stuff yet. MSCI, I don't know. That one might have been more intentional. I have some strong feelings about that. But yeah, hard to say.
Okay. So I know we're starting to come up on time, so I'm going to end on one last question, and I want all three of you to weigh in. We've heard a lot earlier today about companies talking about the market structure bill, or what was formerly known as Clarity. In your minds, brief answers, so 30 seconds or 60 seconds at most, do each of you think that the market structure is actually going to pass in 2026? Yes or no? And really quickly, why? Let's start with Connor.
Yeah, I think if I had to say, I would say yes. I would say it's a coin toss favoring yes right now. I think that we'll hammer out a deal on stable coins, and that the pressure of the midterms will force them to get a deal done. Everyone knows that this is really the only shot potentially for years. And so I think that the incentives are there to get it done.
Yeah, I agree. I think it's going to get passed. I just don't know that it's going to pass the way that the digital asset industry wants it fully on the yields related to stable coins. I think there's going to have to be some compromise there. But I think this is a situation where the banking industry and the digital asset industry just need to realize that there's multiple types of products and assets out there. There's room for more than one. And if you can't add yields or rewards to stable coins, it's like banning credit card companies from offering rewards and miles on credit cards, right? Like, so we really do need differentiation, or we're not going to have competition in the space.
Okay. Brittany?
It's so hard to predict the future with this administration, but I do agree with Dax and Connor. And, hopefully we'll see something pass this year. But next year when we speak on this panel, we'll know if we're right. So.
Yeah, if we're wrong, then you can just find a whole new panel.
Exactly,
Exactly. We'll start over. Yeah.
Well, thank you so much to our panelists, and thank you for all of you for sticking around to listen to this. We covered a lot in 30 minutes, and if you have any questions, please feel free to find any one of us. My fellow panelists here are just terrific resources and have lots of knowledge that can be helpful to you. And also, if you have any thoughts that this discussion has triggered and you want to get involved in some of these discussions, to lobby, to advocate, to write letters, please come and speak with any of us. And with that, I think we are standing between you and coffee break.
It is indeed time for another coffee break, so go ahead and take a little breather. We're going to come back for 4 more sessions, and that'll be followed up with that interactive Q&A where we've been able to acquire some questions from the audience. They're actually going to come up, some of them, and offer those questions to both Phong, Lee, and Michael Saylor beginning at 4:45 p.m. So we'll see you soon. Have a great break. Okay.
you please make your way back into the room. We're going to resume our session for our closing panel and session. Thank you. Please make your way to your seats for our closing session. Thank you. If you would, please return to your seats. We're about to resume our session. Again, please return to your seats. We're about to resume. Thank you.
I think we can all agree that Bitcoin education is so crucial. How else are we going to get 1 billion people into this asset class and technology? And our next session is focused on education. There's something called the Bitcoin Education Institute, and here to tell you all about it is Karok Ray, the academic director. Welcome to the stage, Karok.
Howdy, my name is Karok, and I'm here to tell you about Bitcoin education. So contrary to what you may have heard, Bitcoin is not based on speculation. It's based on science. 40 years of research and development have gone into Bitcoin and led to its genesis. Cryptography, computer science, computer networking, economics, and game theory. Let's remember the cypherpunks, the rebels and intellectuals who fought for freedom and defended their privacy, who translated academic ideas into usable software, who wrote code, and whose community itself was a prototype for Bitcoin: open, permissionless, decentralized. Let's remember the Austrians who wrote about the fatal conceit of central power, who believed that money should serve the people and not the other way around, and the Chicago School, who proved that discretion is inferior to fixed rules. 4 of the men on the screen have won Nobel Prizes in economics, which reflects Bitcoin's rich intellectual heritage. And most of all, let's honor Satoshi, who combined all these ideas together. A digital signature that unlocks a transaction, that assembles into a block, that connects into a chain, that spreads across a network. Based on math, written in code, secured by energy, make no mistake about it, Bitcoin is a profound scientific breakthrough, a singular human achievement that should inspire generations to come. We must study this. We must teach it, and we must understand it. But today, Bitcoin is not well understood. I know this because I've taught Bitcoin at Texas A&M for years. My students come to the class knowing only what they read in the newspaper. And it is the most important work that I do. Within a month, my students can write their own Bitcoin transaction, push it on the mainnet, in a wallet that they built themselves, with code that they wrote themselves, in Python from scratch. The fact that this is possible itself speaks volumes about Bitcoin. But this has not been easy. It took me years to get the class approved. I applied many times. And even today, I don't get paid to teach this class, nor does the university give me a teaching assistant. In fact, they just let me reserve the room because Bitcoin is not a priority. To which I ask, how is it possible that how is it that learning a new technology is not a priority? How is it that understanding money is not important? How is it that teaching sovereignty, ownership, property does not matter? And so we have to understand what's happening. The truth is, Bitcoin and universities have evolved separately. Universities are isolated fiefdoms. Faculty specialize in specific domains. Students concentrate in specific majors. Bitcoin shatters all of these silos. It doesn't quite fit in the university because, for example, an engineering professor may understand how Bitcoin works, but not know why it has value. A social scientist may fathom Bitcoin's impact, but doesn't quite know the difference between all the other cryptocurrencies out there. But like everything else, Bitcoin fixes this. And what was Bitcoin's liability from the perspective of the university can be its greatest asset. The big opportunity is to bring Bitcoin into the domains that it touches and integrate it inside of existing classes. This will avoid the hassle of creating new classes, leverage existing infrastructure, and also reach more students. Imagine a corporate finance class that teaches how to value a Bitcoin treasury company. Imagine a microeconomics class that uses the transaction fee market of Bitcoin as an example of a free market. Imagine a power systems class in electrical engineering that teaches how Bitcoin balances the energy grid. Imagine a political science class that documents Bitcoin's adoption worldwide and talks about its human rights. Or a macroeconomics class that gives Bitcoin the best example of a rules-based monetary system that's never existed before. Or a cryptography class that uses digital signatures and hash functions as leading examples. And finally, a math class, my major, to see how finite fields and elliptic curves are actually used in the wild. So how do we find these faculty? Well, the reality is that research is the currency of the realm inside the university. And there are 1,800 research projects active right now on Bitcoin. And you might think they're not from great places, but you'll see this is the distribution of where they are around the world. And the top schools have a good representation, as well as in the US. You might ask, what are they writing about? Mostly finance, also on security, some on adoption, machine learning, and some economics. But are they positive or negative towards Bitcoin? So I took all 1,800 papers, I fed it into an AI engine, and did some sentiment analysis to see if it is favorable or hostile towards Bitcoin. And you might be surprised. There's a lot of variation, but on average, they are positive towards Bitcoin and statistically different from zero. This is our beachhead. This is how we will identify our faculty. Today, Bitcoin education is handled by a small and persecuted minority, a band of brothers and sisters like me who have fought their institutions to bring Bitcoin to their students. But we are growing, and just last month, I spoke to half a dozen faculty from great places and who are domain experts, all of who are open to introducing Bitcoin into their classes and researching it. For example, Dongning Guo, a professor of computer engineering in Northwestern, grew up in communist China, secretly read Austrian economics on nights and weekends, and today teaches a class on blockchain that is 90% Bitcoin, unlike most others. This is how we will move forward. Allow me to introduce the Bitcoin Education Institute, a new nonprofit dedicated to advancing Bitcoin education at scale. Our goal is to support faculty, support students, convene together in an annual conference, align with industry partners like the Bitcoin Student Network, Bitcoin Policy Institute, and Bitcoin Park, build and spread curriculum, and ultimately to win the hearts and minds of the next generation. And for this, I need your help. To the alumni in the room, if you are thinking of donating to your university, but want your gift to match your values, come talk to us. To my fellow faculty, we are bound by a higher covenant, not just to our students, but to the truth to which we are also a student. Give Bitcoin a chance and assess it on its principles, not on your perception of its politics. To the Bitcoin professions in this room and beyond, we need you to talk to our students, share your experience, share your Bitcoin journey. We are assembling a database of speakers, and you need to join it. And to the students, my most important audience, the time has come to put aside childish things, to understand Bitcoin, what it is, how it works, why it has value, to fathom the amazing power of a system of rules without rulers, to witness digital scarcity that cannot be silenced, and to fight to build a future that belongs in the land of the free. And to everyone else, I say this: if we are successful, if we can bring Bitcoin at scale in education, then I promise you that one day we will empower the youth, answer the skeptics, eliminate the FUD, end the scams, balance the grid, reform the banks, cut the deficit, discipline the Fed, protect our savings, liberate our time, and ultimately secure our freedoms for ourselves and our posterity. That is the dream. That is the promise of Bitcoin. So, let's unite digital capital with human capital and make tomorrow better than today. Thank you.
Applications, I know a book that should end up in that curriculum, hopefully. Our next 3 sessions are about new market structures using Stretch and Bitcoin-linked products. Our first speaker is Dan Kang, Chief Strategy Officer at Apex and DeFi Development Corp. Then we'll hear from Kevin Lee, CEO and co-founder of Saturn, followed by Austin Reed, Global Head of Revenue and Business at FalconX, and Duncan Moir, President at 21 Shares. So welcome, please, to the stage, Dan Kang.
Now, for the few of you online or in the room who actually know who I am, you're probably wondering, how did a Solana treasury guy get invited to speak at Bitcoin for Corporations? Before you know it, you're going to hear all my Solana taglines. Bitcoin stores value, Solana moves it. And even worse, what I'm about to say might actually get me escorted out of the building. So let's get the awkward part out of the way. Satoshi got it wrong. I mean it. Satoshi got it really, really wrong. And at this point, Bhakti from Strategies backstage like, damn it, I knew we shouldn't have invited that Solana guy to speak. What did he get wrong exactly? Was it something he said? Was it something he did? Dare I say there's something wrong with Bitcoin? No, let me clarify something before the bouncers actually take me out of the building. There's nothing wrong with Bitcoin. Bitcoin is a masterpiece. So that still begs the question, what did Satoshi get wrong? And for that, I'd actually like to turn to the white paper, and I want you guys to pay very careful attention to the words. Bitcoin, a peer-to-peer electronic cash system. Let's read the abstract. A purely peer-to-peer version of electronic cash would allow online payments to be sent directly from one party to another without going through a financial institution. And yet here we are 17 years later. Nobody uses Bitcoin as cash. Nobody uses Bitcoin as a form of payment. And frankly, they shouldn't. If Bitcoin is a masterpiece, which it is, you don't exchange your masterpiece for groceries. You don't go to Starbucks and buy your latte in the morning with a Picasso. Bitcoin is too good a store of value, too precious to ever be used as cash, payments, or money the way we understand it. Now, when I woke up this morning, I actually didn't have a title for this keynote. And I decided the best title for it was the title Full Faith. Full Faith. And that'll make absolutely no sense to anyone until the very end. But I want you to think about that for the remainder of this presentation. And for now, I want to ask you one simple question. What is the perfect form of money? Not good money, not functional money, not the best money ever created. Perfect money. When I think of perfect money, I think of three things. Let's go through them. Number one, stability. The stability promised to us by treasuries and the dollar. Now, of course, I say promise because we all know that promise was a lie. When the United States Federal Reserve can 8x the size of its total assets on its balance sheet over the span of 2 decades, when inflation can run north of 5% for years on end, that's not stability. That's your purchasing power drowning. I'd go a step further to call it a sedative. And it's a sedative we have been swallowing for half of a century. So perfect money needs to actually be stable. What's the second ingredient to perfect money? Speed. I like this one. Perfect money should be fast as crypto. Instant settlement. No intermediaries slowing you down just because it's the weekend or after banking hours. No intermediaries denying you your fundamental human right to transact. No, in the internet and AI era, only internet and AI speed will do. So perfect money needs to be fast. And the last but essential ingredient to perfect money is real yield. Now, for all of the hype around stablecoins and USDC, well, they effectively offer zero real yield to their users. And in fact, you have issuers like Circle who extract enormous value from USDC holders. And it's still backed by fiat. It's the same disease, but with different window dressing, or a clown wearing sneakers instead of clown shoes. So these are the three ingredients. Stability, speed, real yield. What happens when you mix all three of these ingredients? Ladies and gentlemen, I present to you a hallucination. Thank you, I yield my time. Actually, I should mention this was a hallucination yesterday. Today it's real. Ladies and gentlemen, my name is Dan Kang, and it is my honor and privilege to introduce to you Apex, the holy trinity of money, a digital dollar backed by the Apex asset itself, Bitcoin. So, let's go a little bit into how it works. Apex is a protocol designed to give you perfect money. At its heart is APX USD, a digital dollar designed to maintain a one-to-one peg collateralized by Stretch, Strategy's variable rate preferred equity instrument, which is, of course, backed by the largest BTC treasury on Earth. When you hold APX USD, you're not holding an IOU backed by a government that can change the rules whenever it's convenient for them. No, you are holding digital money backed by digital credit, Stretch, backed by digital capital, BTC. But here's where it gets interesting. Lock your APX USD and you get APY USD, the high yield version. APY USD, we estimate, will generate yields up to 30%. How? Through a combination of optimization and active risk management, we pass all of Stretch's dividends and then some directly to users. And there's no intermediary hoarding fees. So, you want digital money, hold APX USD. If you want digital yield, hold APY USD. Now, stablecoins, as they stand today, are a $300 billion asset class, but of course forecasted to reach trillions by the end of the decade. And as that market scales, Apex will scale with it. Every dollar of demand for stablecoins going forward will become a dollar of demand for BTC-backed credit instruments. But what makes Apex special, revolutionary? Well, for years, there's been a wall between Bitcoin and DeFi, with Ethereum maxis dismissing DeFi, dismissing Bitcoiners as, well, not living to their full potential because you can't really use Bitcoin. Apex tears that wall down. Apex brings Bitcoin directly into decentralized finance. From Bitcoin to Stretch to Apex, Bitcoin is now programmable, composable, useful in ways that BTC alone could never be. Starting today, Ethereum will no longer ignore BTC, and BTC users no longer have to choose between conviction and yield. So I know what you're wondering, who built this? Why should I trust you? That's fair. Track records matter. Apex was built by a team that has been operating in crypto long before Strategy ever bought its first Bitcoin. We hail from Kraken, one of the longest standing and most reputable crypto exchanges on Earth. We survived Mt. Gox, even if our CFO's hairline didn't. We've weathered every crypto winter, and we built the best performing DApp of 2025, delivering over 600% returns since the inception of our treasury strategy. Apex is the culmination of a decade of conviction, the product of a belief that the existing financial system doesn't need an upgrade, it needs an overhaul. And the best part is, we're not doing this alone. We have some of the biggest names in crypto in our corner, from Strategy to DeFi Development Corp to Kraken, Anchorage, BitGo, and more, and we're just getting started. I'd like to leave you with a parting thought. For 50 years, the world has accepted a simple arrangement. The dollar, backed by the full faith and credit in the United States government. Full faith in an institution that hasn't balanced a budget in decades. Credit in the largest accumulator of debt in human history. We can do better. Starting today, we will do better. Apex is a dividend-backed stablecoin. It is a dollar that does not debase because its core collateral cannot be printed and cannot be manipulated. It is a dollar that works for you, that generates yield instead of extracting it. Everyone in this room knows Bitcoin is inevitable, and Apex is here to accelerate that inevitability, to prove that a monetary system anchored in mathematical certainty is not a hallucination. It's here. Now, I started by saying Satoshi got it wrong. I'd like to amend that statement. Satoshi gave us a pristine asset, the most pristine asset in human history, but he left one problem unsolved. How do you use an asset that is too perfect to spend? Apex is that answer. It is digital money backed by digital capital, backed ultimately by Bitcoin. It is a yield that respects your conviction. It is a currency for those who believe but still need to live and transact in this world. Apex launches today, and we are ready to let DATs and digital capital, not banks, not governments, back the best dollar in crypto. Full faith in Bitcoin. That's the dollar we built. Thank you.
Good afternoon, Las Vegas. I'm Kevin, the co-founder and CEO of Saturn, and we are setting the new standard of yield for the on-chain economy. I'm excited to be here to share more about the convergence of TradFi and crypto and how Saturn is bridging digital credit to the on-chain economy. The acceleration of the conversion of TradFi and crypto really started in 2024 with the ETF passing. There's been 85 ETFs, over 200 public companies have bought Bitcoin. BlackRock's Bitcoin ETF has surpassed their gold ETF within the first year. The integration of Bitcoin into global capital markets starts in 2024. In 2025, we're beginning to see this financial layer being built on Bitcoin as banks are using Bitcoin as a collateral. You see JP Morgan, Bank of America, all accepting Bitcoin as a collateral. Strategy, as the biggest borrowers against Bitcoin, has increased their credit size from $2 billion in 2023 to $15 billion in 2025. And they have standardized their credit instruments across 5 preferred equities that spans across yield, duration, and liquidation preference. And what this effectively did is it created the first yield curve for Bitcoin. And with the ETF, with MicroStrategy stock, it unlocked Bitcoin access to the entire capital stack and different investors of all risk profile. Once this yield curve was formed, we believe that the credit layer is ready to be built on top of. Saturn's thesis is that the future of finance is built on digital credit, just as TradFi today is built on US credit. And as US credit erodes, the world is looking for a diverse new collateral asset and a diverse credit base. And we believe Bitcoin can become the new collateral asset, and that the future of finance will run on digital credit. Saturn is building the digital yield layer that will power and connect all applications of the future. The issue with digital credit is everything lives off-chain and in the physical world. We bring digital credit to the digital world with 2 assets. First, we have USDAT, which is the first digital dollar on the digital credit. And second, we have SUSDAT, which is the first digital yield asset that pays 11% yield backed by Stretch. And as we bring SUSDAT on-chain, it actually leads DeFi yields at institutional scale. The benchmark yield today on-chain is 46% on Aave and Morpho, over-collateralized by altcoins at a 150% to 200% ratio. And yet Stretch today is paying 11% backed by Bitcoin with a higher backing ratio. The superior yield is obvious. Higher yield backed by a better asset with a higher backing ratio. And if you look at the running protocols on chain, there's 7 protocols that pays a 10% plus base yield at a $50 million scale. And there's only 1 protocol that pays 10% plus base yield at $150 million in TVL. Yet, Stretch today already pays 11.25% at $3.5 billion. It will pay at $30 billion, it'll pay during a bull. It'll also pay during a bear. Stretch is a yield. Digital credit is a yield that doesn't compress and is durable. As you can tell, DeFi is starving for yield, and they're looking off-chain for corporate credit and private credit. But there's 5 properties of digital credit that makes it work better. First, the collateral asset is backed by Bitcoin, right? The on-chain economy appreciates and understands Bitcoin as a collateral. It's globally verifiable, so it's easier for on-chain people to understand it. Second, it inherits the properties of a digital asset. There's real-time mark-to-market, there's continuous risk. So as post-1010, as a lot of black box yield on-chain has collapsed, transparency is the top priority. Third property is that these digital credit instruments is perpetual. So we don't have to worry about financing, refinancing, maturities. All we have to do is hold Stretch on chain. The fourth property, and it's the most important, is digital credit has balanced liquidity with yield. It is much more liquid than all of the credit instrument off-chain. And what this really enables is a really smooth on-ramp of digital credit and off-ramp. You can buy it and sell it. You can mint and redeem whenever you want. And when you compare this with a traditional corporate credit or private credit, when you mint, you need to find a company that issues it. And when you redeem, you need to find a buyer. And this could take a long time. The fifth innovation is that when strategy put Stretch on the broker, they can instantly issue the ATM, and this increased asset issuance almost by 100x. And it scales with the demand. We could go to strategy with $100 million of Stretch demand, and they can print $100 million of Stretch instantly, back it with $500 million of Bitcoin that protects it. So our thesis is that as RWA comes on chain, digital credit will be the first RWA that will scale at billions. There are 4 major unlocks as we bring digital credit on chain. The first major unlock is we are delivering digital credit with digital rails. We were trying to understand how many international brokers have access to US brokers, US stocks. So we added up the top 10 international brokers with substantial funded accounts, and there was 32 million accounts. Yet today, there's already 500 million users globally with access to stablecoins. So if we deliver digital credit with stablecoins, we can increase the investor base that you can't get otherwise. In fact, in emerging countries, stablecoins and blockchain has become the de facto financial rails for them. The second unlock that we see is that DeFi unlocks the Stretch carry trade. SUSDAT unlocks Stretch as a collateral, and users can increase their leverage on Stretch to a leverage ratio higher than what you can get in TradFi. One of the reasons why we started Saturn was because I wanted to increase leverage on Robinhood, but the LTV on Stretch was 50%. So what that means is the most leverage I can get was 0.5x or 0.8x. But in DeFi, we can increase it up to 2x, 3x, or 4x. You can get 18% yield, 24% yield, 30% yield at 4x with a higher Sharpe ratio than even Bitcoin today. And the other thing that we found was that a lot of Bitcoiners actually want to borrow against their Bitcoin and capture yield. All of the Bitcoin L2s have came to us and was like, can we create an earn product on Bitcoin? There's 70% of Bitcoin idle today, and as Bitcoin matures, we see this demand increasing. And if you take a step back, as assets all go on chain, you can capture the spread with any asset. You can use any asset as a collateral, and you can capture the spread. So what we've unlocked is what we call Saylor spreads. Anybody can arb Stretch yield against the cost of capital on chain. The third unlock that we saw was we can actually make these assets composable as we can create yield tranching. We can split SUSDAT into a PT token and a YT token. The PT token locks in a fixed yield of Stretch, and the YT token takes on the Stretch yield volatility. So when the yield goes up, you make money. When the yield goes down, you lose money. And what this effectively unlocked was a capital efficient way for users to trade where Stretch yield goes. And if Stretch repegs, you can trade that as well. And the bigger picture is we've created a yield market for Stretch yield. And it can predict where Stretch yield could go. Saylor could wake up the next day, look at the YT market, and see how the market is pricing the yield of stretch. The fourth unlock that we see, and the most important, is we can actually volatility tranche stretch. We can create a senior tranche of SUSDAT and a junior tranche of SUSDAT. The senior tranche will pay a risk premium to the junior tranche, and the junior tranche will take on volatility of the senior tranche. And if you take a step back, the senior tranche is digital money, 8%, 6 to 8% with no volatility, while the junior tranche is earning 15 to 20% with higher volatility. In fact, the junior tranche is a unique way of expressing leverage stretch without liquidation risk, and we have packaged volatility as a product for everybody. And for stretch, we believe that volatility does not equal to risk, as it will repeg, so we think that junior tranche is exceptionally exciting. In conclusion, we believe DeFi amplifies digital credit, and digital credit is made for DeFi. We unlock global access, higher leverage, we unlock a yield market, and we can volatility tranche stretch. Lastly, in order for Saturn to push up the market, we will incentivize and subsidize early SUSDAT yields to approximately 14%, and this makes the entire bootstrap and the leverage much more interesting. If you want to learn more about amplified digital credit, if you want to learn how DeFi is making digital credit better, please reach out. Thank you.
How's it going, everyone? We are excited to be here. My name is Austin Reed. I'm the Global Head of Revenue and Business at FalconX. Just quick context on us. We are one of the leading institutional brokerages in the crypto and digital asset markets. And one of the things that we're most excited about is in Q4 last year, we made a big acquisition, which was that of 21 Shares, which is one of the leading ETF and ETP issuers globally for crypto instruments. And the intention in doing that was to basically be able to work together to bring innovative financial products to market and unlock greater capital efficiency and usability for both our customers and the broader institutional community by doing so. So with that, I'm excited to pass it to Duncan to go through our announcement today.
Great. Thank you, Austin, and good afternoon. My name is Duncan Moyer. I'm the president of 21 Shares, and for those of you who don't know that much about us, we're the Europe's largest crypto asset manager. 60 products, or more than 60 products, on about 12 regulated exchanges globally. Probably more importantly, we were the first asset manager to put a spot Bitcoin ETP on an exchange back in 2018. And we've really been innovating ever since. We were founded with a simple mission: to make investing in crypto as easy as buying a stock, and to take a fast-paced, often misunderstood part of the market and put it into a familiar, transparent wrapper that can be bought with existing infrastructure through traditional brokers. And it's exactly that kind of accessibility that's made exchange-traded products like ETNs in Europe or ETFs in the US so dominant. ETFs today are an enormous part of the investment management industry. $20 trillion in assets, that's like a fifth of global investment management AUMs. Something like 100 million individuals and institutions investing in this structure. And it's where we've built our business and our brand. Now, what we are hearing from investors today, mostly the institutional investors, is one clear message: we need yield. Unfortunately, creating yield in crypto isn't always easy when you're trying to sell it into institutions. Yield in crypto can often have complexity. So it begs the question, what would it look like if we put stretch in an ETF? Now, the good thing about speaking late afternoon on the second day of the sessions is I don't think I have to explain stretch to anyone here, hopefully. But what would it look like? What would it mean to put STRC in an ETF? Well, the first thing it means very clearly is yield, superior yield, way more than what a typical ETF investor is used to. Of the 5,000 or so ETFs in the US, STRC would rank near the top, maybe the top, in terms of yield after tax. Now that's a compelling message and one of the differentiators that really gets investors' attention. The second thing is reach. With a US ETF and a European ETP, so products on exchanges in those markets, we can reach more than 80% of the world's wealth. It's not just the US, it's not just Europe. It also means investors in many other markets where their brokers, their platforms are connected to those exchanges. So we take yield, we take a familiar wrapper, and we take reach, and we create what I think is a compelling investment opportunity. And today, we are seizing that opportunity. Today, I am proud to announce the launch of the 21 shares Strategy Yield ETP, the first exchange-traded product listed on a regulated securities exchange that is backed one-for-one with STRC. Hey, there we go. That's what I was looking for. Now, this is just the first step in our digital credit journey. It's a great step forward for the market. It's great for investors in Europe, in Asia, in the Middle East that can access this. They get yield, they get the familiar wrapper, they get easy accessibility. I think it also says something about the way 21 Shares thinks about innovation as well. We look at investor demand and where that aligns with market structure, and we create accessible, familiar access to that. So we're excited about the opportunity. We're excited about increasing accessibility. But it's not just about accessibility. The next question is, how can you take a structure like this, a vehicle like this, and use it in an efficient way in a portfolio and in institutional workflows? And that's a perfect segue to hand back to Austin, because FalconX are doing just that.
Great. Thanks so much, Duncan. And I think one of the things that makes me quite excited about both this product and the broader opportunity for continued collaboration here, both around Stretch and other items, is, from my perspective, so much of the initial innovation that Strategy and even the initial ETFs brought to the market was the ability to just unlock net new pools of capital that didn't historically have access to this space. And if you think through the next stages of Bitcoin adoption and broader digital asset and digital asset credit adoption, so much of that exercise and where we spend our time is figuring out how do you open the aperture to a broader range of investors, institutions, for them to be active within this space. And so what makes me excited about this product offering is that's exactly where what 21 Shares will be able to enable through very strong European-specific distribution here. But if I think more broadly around, okay, for institutional market participants who are active in the digital asset space, how can we incorporate this into a broader platform? And what we're excited to do at FalconX is you can imagine a future where your Stretch ETP, for example, with very attractive yields, as everyone's mentioned so far today, is enabled for collateral use cases. So you can actually use your Stretch ETP, for example, to be able to purchase Bitcoin, or to be able to trade a wide variety of different derivatives contracts that we offer both in the United States and globally. What we're really seeing institutions want within this market is greater capital efficiency yield, and the ability to express their views in the market in more nuanced and effective ways. And we're very excited to collaborate with both 21 Shares and the MicroStrategy team to make that happen. So thank you guys so much, and looking forward to the next presentations.
Thank you.
We are standing by to resume our session, so please don't go too far. We are just standing by for just another minute or so, please don't go too far. Thank you.
11%, that is your new stretch anthem. We have saved the best for last, everyone. We're gonna have a Q&A with two very big VIPs, Phong Lee and Michael Saylor himself, but I had to recruit some help because I sort of ran out of questions, right? I mean, my interview with Michael Saylor is up to 1.3 million views just on X. I needed some help with some questions, so we recruited Q&As from the audience. What do they suggest we ask? So we're gonna actually be calling them up and having them ask the questions live. And we've also got James Lavish to help me out on stage. So please welcome Michael Saylor, founder and executive chairman of Strategy, Phong Lee, president and CEO of Strategy, and James Lavish, co-managing partner of the Bitcoin Opportunity Fund. Loving this rock. All right, why don't we start with you, James? Why don't you ask your first question?
All right, so the first question here, Michael, I've been thinking about this a lot, and I want to hear your thoughts on this. So AI is scaling toward AGI, potentially within years, not decades. And if that happens, a productivity shock could be massively deflationary. But deflation crushes nominal GDP, as we know, is making government debt burdens explode. So in response, governments will have to, or this government in particular, will have to print aggressively and monetize their own debt. So we get the biggest deflationary shock in history, forcing the biggest inflationary monetary response. Where does Stretch, STRC, fit in that world? And does digital credit become the ultimate financial bridge to this paradox?
I think we're living through the digital transformation of everything. And AI is digital intelligence, and we're going to see the digital transformation of labor. In essence, digital intelligence should demonetize human capital. So if you had a massive, millions of people doing a job like driving a car or doing a white-collar job, and the AI comes in, it's going to demonetize them, transform them, dematerialize them. There'll be a massive increase in productivity. It is deflationary. There's going to be extraordinary increase in productivity, a dislocation, and a transformation of what people are doing, and they'll migrate. We see Stretch as the digital transformation of credit. Bitcoin is the digital transformation of capital. So as the capital dematerializes to Bitcoin, the credit on top of it replaces physical credit. I think that certainly there's always this debate, should I spend $250,000 on a college education, or should I just keep the money? And I would say 30 or 40 years ago, the money wasn't worth that much, and so the consensus was I should spend the money on education so I can work hard. It's not so clear to me now. It seems like you're probably better off to buy $250,000 worth of capital, or like a Bitcoin. Then in theory you're getting 20 to 30% a year on that forever, or $250,000 worth of the credit. And if you're going to spend the money on the education, the question really becomes, why don't I just get a digital education for free, or from nearly free from the AI, instead of paying an institution to educate me? So I think a lot of people will make a lot of different decisions, but it's going to be a reallocation of money from physical education to digital education, from physical labor to digital labor, from physical or traditional credit to digital credit, from physical capital to digital capital. We think that the $300 trillion credit market is broken, and it's you could characterize it as all return, or it's basically return-free risk, because the credit spreads on top of the risk-free rate are de minimis. Like, why would you take 77 basis points to take the credit risk of a company, or 288 basis points to take the credit risk of a high yield issuer. So you could kind of say the credit spread of sovereign debt, which is the credit spread of sovereign debt is 50 to 350 basis points. That does not cover the credit risk of the debt, of the sovereign debt. The credit spread of the investment grade credit doesn't cover the credit risk of the company. The credit spread of the high yield of the junk, 288 basis points, doesn't cover the credit risk of the weak company. The credit spreads on municipal debt and mortgage debt don't cover the risk of those. So pretty much all $300 trillion of capital is non-performing. And you would think that as people become, people have been forced to either take risk, like on Bitcoin, or take risk on equity, or they're just slowly suffering. And what we see is human nature is, human psychology is, they actually would like to own the credit and not risk the principal, and they haven't had a good option. So we think digital credit maybe is the way that we recruit 75% of the capital in the world to the digital assets ecosystem and to Bitcoin. It's the gateway for them to transition from slow suffocation, right? Or, being slowly squeezed to death, to something better, and so that's where I think it's positioned right now.
Michael, you mentioned on my show that you could do 1,000 hours of podcasts and we still can't reach some of the people in order to buy Bitcoin, but you seem to be looking at digital credit and instruments like Stretch as the way to sort of reach the mainstream public and the majority. So what is the gap? Like, if that's layered on top of Bitcoin, why is it easier for someone to understand Stretch, and how do you market it? What's the challenge there?
I think chemistry is really complicated. Most people don't understand chemistry, but everybody wears nylon and polyester and lycra, and they like Teflon, and they like plastics. And the truth is, they don't want to understand. I don't think people want to understand nuclear power. They don't want to understand petrochemical. They don't want to understand physics. What they want is a car that's easy to drive, and then they want a dishwasher and a hairdryer. Not 1 in 100 people can explain how an air conditioner works, but they all want one. So I don't think 1 in 100,000 people understands how an iPhone works, but they all want one. So I think the great products are all bought. I don't think people that drink Coca-Cola know how to make Coca-Cola, right? Wasn't the recipe for Coke a secret for 100 years, right? That's the most famous secret. So you don't have to understand it to want it. And I think the mistake is sometimes to think that I have to teach people how to create their own explosives, or how to create their own, heat exchangers, or how to create their own internal combustion engines. And when you're in the hobbyist stage, or the early innovator stage at that point, I think that people want an insanely great, simple to use consumer product that just makes their problems go away, that has complicated technology embedded in it. And so I think that we're moving from the early adopter phase. Imagine people used to create their cars from a kit, or they used to if you were an aviation hobbyist, you constructed your own aeroplane, and then you tested it and flew it. And then we eventually got to the point where people just purchased an airline ticket, and they got on a plane they didn't build, they didn't understand, flown by a guy, did something that they can't do. And eventually where you end up is, we're just going to have cars that drive themselves, that take us to places when we say, take us there. So I think we're moving to that point in digital assets and digital credit and the Bitcoin industry. And bottom line is, billions and billions and billions of people want a company to create a product to solve their problem. And if you want to change the life of billions of people, you know, you create that massive consumer product and give it to a billion people. You know, sometimes they want you to create the product and then finance it for them and give it to them for free. Like how many people paid for their car in cash or their house in cash, right? They want someone to create a house and they want the government to finance it with a Fannie Mae, Freddie Mac loan, and then they'll willingly move into the house paid for by someone else with credit built by someone else. But I never seen anybody that said that they didn't want to live in the house unless they built it with their own hands, every part of it. So I think that's the case with most things. And this industry is evolving to that.
I would also add, Coca-Cola was originally successful because they convinced pharmacists to sell it as a tonic against an upset stomach. And the iPhone was successful because they convinced AT&T initially to distribute it. And so for Stretch to initially be successful, it already is, but we had to convince banks to distribute it because that's how products get sold today. And now you see all these layer 3 folks building on top of Stretch. So the distribution is starting to happen even as we speak on a 6-month-old product. And that is another way that Stretch is going to be successful, is using the distribution of traditional finance and decentralized finance.
And catchy tunes always help. So we're going to call up our first audience member, Quentin Yenny. Do we have a microphone anywhere? Yes, take your seat. We'll come to you.
Hello, thank you for taking my question. Quentin from the One Share podcast. So my question is around the regulation of digital credit. If Strategy is successful in massively scaling their preferreds like Stretch, you could see a future where those products start to rival government bonds. So my question is, how do you think long-term, what is your long-term strategy in navigating this? And do you think that there's going to be new regulations that will be implemented to try to stop this?
No, I don't think anybody's going to stop it. I think that the government is going to take the position you can't call these things a money market fund. Money markets or stable coins will have to be backed by currency equivalents. But I think that it will propagate as a security or as a yield fund or as an investment fund or with a adjective. Whether we can call it digital money is unclear, but you can certainly probably call it digital yield or digital income. And I think it'll spread through traditional banking systems. I think it'll spread as digital income. I think you'll have digital income securities like STRC, but then you'll see wrappered ETFs. I think it'll spread as an ETP, like the 21 shares STRC is just a security. I think that it will get built into digital income type tokens or the like, and I think people will create digital savings coins, you know, like people are working on here. And I think that you'll have a set of digital assets regulators, and that'll be one set of types of products. I think you'll see the security regulators will be a different set, and then there'll be a set of bank regulators. I don't think this will be an exercise in anybody. I don't think anybody's really threatened by it. I think it'll be an exercise in getting regulatory approvals to roll out various flavors of digital money and digital income or digital yield. The good news here is the most powerful financial regulators in the world are the Secretary of the Treasury of the United States and the head of the Fed. The Secretary of the Treasury, Scott Bessent, believes that digital assets are the future and is an enthusiast. The head of the Fed, Kevin Warsh, believes that digital assets are the future, is an enthusiast. The President of the United States wants to make the United States the digital assets leader, the crypto capital of the world. So you have the support of the President, the head of the Fed, the head of the Treasury. You also have enthusiastic support from the head of the SEC, Paul Atkins, and the head of the CFTC, Mike Selig. And I've traveled all around the world. The most progressive set of financial regulators in the world are in the US right now. The most powerful set of financial regulators in the world are in the US right now. Just today, the OCC put out guidance, you can see it on X, where they said stable coins are fine, we encourage you to look at them. So the OCC, the FDIC, Treasury, and the other financial regulators and banking regulators in the US are going to be supportive. The UAE is the second most progressive set of regulators. They're also supportive and enthusiastic. Everybody else in the world is going to defer to and follow the US. Everybody else, the Europeans, the South Americans, Singapore, the Hong Kong regulators, even the Chinese, and I suspect the Russians. I think our enemies will defer to the US. I think our allies will defer to the US. And I think that the train has left the station. There will just be nuances. You won't be able to represent that it won't be a stable coin, and you won't be able to represent it as a currency equivalent or a money market equivalent, because those are defined terms that have very particular meanings. But I think that digital credit and digital income, digital money will thrive in the digital assets economy. And at this point, we're just going to see a Cambrian explosion of new flavors and types. And you're going to see a very entrepreneurial movement, because, releasing this in Australia will require an Australian issuer or a distributor of sorts. And it'll be the same in New Zealand or Singapore or UAE or every single country in Europe. So there's a lot of work to do, but I don't think there's much controversy or much risk that any regulator is going to crack down on this at this point. I think we've crossed that event horizon, and the genie is out of the bottle. There's broad consensus that Bitcoin is ethical digital capital at this point.
Okay, it's also going to be a win-win-win, right? This is right now, and it's, love to project out 10, 20 years what happens to digital credit, but Stretch is a $3 billion asset class. Digital credit is $7.5 billion. Let's say Stretch goes to 30 billion. Let's say it goes to 300 billion. It's still quite a small percentage compared to what U.S. Treasuries are. And let's say we get to 300 billion. You have 300 billion people, many of them U.S. citizens, and people all around the world now earning 11%. Perhaps that causes them to save more money. That's good outcome. It brings people up. It increases income. So I don't see why the government would look at $300 billion of Stretch and say that's a bad thing. They would be supporting that. And then that money pours into Bitcoin. Bitcoin goes up, so everybody who owns Bitcoin is doing well. Stretch does well. Bitcoin does well. People do well. Governments do well. I can't imagine they look at a $300 billion asset class and they say, oh, let's regulate this. People will just be more happy.
Yeah, there's a point to be made that digital credit is not competing with sovereign credit. Digital credit is competing with private credit and junk bonds and unrated credit instruments. And so there's no way a large government will feel threatened. The entity that's threatened is a going out of business private company that's attempting to get a loan and offering 8% or 6%. So and that's a huge market, right? Right. The people that are buying Stretch at 11 are saying this looks less risky and better than my junk bond portfolio that yields 7. And so it will squeeze probably high yield, low, non-investment grade corporate credit probably for the next 5 years. And then maybe 10 years out, if it's a, trillion-dollar asset class, it'll start squeezing investment grade corporate debt. And 20 years out, it'll be squeezing various types of investment grade, corporate debt, high yield, and then mortgage-backed securities and other random types of credit instruments. But it's going to start on that side of the credit curve. And it's the same mistake people make with Bitcoin. They think, oh, Bitcoin, it must threaten the dollar. No, Bitcoin's capital, it threatens someone's like second rate or it's someone's international real estate portfolio or alternative assets. I'm deciding whether to buy oil and gas rights in Argentina or Bitcoin, or I'm deciding whether to buy real estate, in Asia or buy Bitcoin, or I'm deciding to buy, a mixed portfolio of buildings, real estate, and gold, and oil rights or Bitcoin. And when you look at it that way, you realize that it's just a better form of alternative capital, just like digital credit is a better form of alternative credit. The banks and the nation states that embrace it will thereby grow and prosper because they're embracing a new technology. And so the confident ones are not insecure. They're not going to be threatened by it. I don't think JP Morgan doesn't think that Bitcoin's going to eliminate its role in society, and the United States is not concerned about Bitcoin. That's why the president endorsed it. That's why Warsh endorses it at the Fed. That's why Scott Bessent believes in it. It's just technology. And to Fong's point, we probably got 20 years before we're at 5% of the market. In 20 years, people will say, here's a new thing, and it looks like it's 2, 3, 4% of the capital in the world. And that's perfectly fine with us.
Thank you, Quentin. Next up is Radu. Got a microphone behind you. Oh, no, behind you.
Okay, so imagine it's the year 2060 and the world is fully on a Bitcoin standard and Strategy holds 3 million Bitcoin. The arbitrage window that enabled the accumulation phase has closed. What will Strategy's role be in that future Bitcoin economy?
In the year 2060, there's still going to be a lot of capital invested in real estate. There are going to be rich people living in Palm Beach and the Hamptons. There's going to be buildings. There's also going to be companies. There's going to be a company with 1 billion robots that makes robots, and there's going to be flying hover cars, and there's going to be nanobots, and there's going to be a lot of valuable equity, a lot of valuable real estate. There's going to be a lot of money invested in Bitcoin. There's also going to be city and state governments. So I think that world is a world where maybe 20% of the capital is digital instead of 0.1 or 30%. And then maybe instead of, digital credit will be successful, but there'll be other forms of credit. There'll probably still be other forms of credit. Our role will be to support digital credit and then all the innovations. There's probably going to be some brilliant, interesting things that get invented in the year 2045. And then we'll have 10 years to work on that, but we don't know what those are right now. I rather think, though, it seems pretty clear that white-collar labor is getting turbocharged and transformed by AI, and blue-collar labor is getting turbocharged and transformed by AI. And you're going to have an explosion of diversity in products and productivity. Our role is to improve, to digitally transform and improve the economic system of the world. So digital capital is a better foundation for credit than physical capital, and digital credit is better. And so the result presumably is weak credit issuers will get squeezed out, and all around the world where people are suffering from financial repression, there'll be less, and probably the credit rates of other instruments will increase over time, and as those credit rates increase, the decision-making of the borrowers will improve because the cost of capital will change. And so I think the world will be more rational and will be a contributor to it. But otherwise, there's still going to be a lot of diversity and a lot of innovation going on. And probably the world will be evolving across 100 dimensions much faster than it is today. Instead of having 50 million people or 20 million people engaged in basic research, maybe you'll have 1 billion people engaged in basic research in 10,000 areas that we don't even think are worth researching or we can't afford to research right now. So I'm not worried that there's a collapse. I think rather there's an explosion in productivity and rationality and opportunity and optionality. And the world won't be perfect either. There'll still be imperfections, but it'll be a better world than it is now. And there'll be more opportunity for everyone, and more rationality will be, spreading from here to there.
Yeah, 2 million Bitcoin is still really just 10% of the Bitcoin in existence. It's a lot, but it's not that much. There are companies that own more of the search market, more of the mobile phone market, more of the electric car market. And in 30 years, there will be new markets that open up. We'll be worried about how much real estate's on Earth. There will now be real estate sold on the moon, and somebody will go grab 20% of the real estate on the moon, and people will say, is that too much real estate? And I think there will be new markets, new products, new capabilities. AI will be around, humans will be around, society will be around, and innovation will continue. And by then, we'll have 10% of the Bitcoin, and maybe there will be a brand new category of product that we've never thought of, and maybe we'll have innovated in that space too. 2060 is a long, long time away.
Thank you, Ray Du. Our next question comes from Christopher Adock.
Awesome. Thank you for taking my question. My question is, if Basel moved Bitcoin to Group 1 tomorrow, no other changes, do the big banks that you've been meeting with recently, do they start buying Bitcoin all of a sudden, or do they need proof that the consumer demand is there? Because there's a dichotomy of the products that are being rolled out versus them holding on their balance sheet. I was just curious on your experiences with the banks and your thoughts on the Basel rules and how they should or may change in the future.
I don't think it's overnight. I think Basel is an important standard because it'll open up banks, insurance companies, pension funds, and others to holding Bitcoin, to holding MSTR, other Bitcoin treasury companies. It'll help. It's not as existential, right? It's just another sort of barrier to overcome, like FASB, fair market accounting, right? We'll overcome these things, but I don't think it's existential. I think what's going to cause Bitcoin to grow fast is, and we've talked a lot about it, corporate adoption, which has happened in the last year, banking adoption, which we'll see happen this year. I think when those things happen, the distribution channels of Bitcoin and digital credit will increase, and Basel is just one piece of it, and we'll fix that. But Bitcoin doesn't have these existential things that keep it down, or step function things that are going to cause it to grow overnight anymore. It's too big an asset class and too much support in the government. So I think it'll be helpful, but it's not necessary. And on the flip side, it's not going to just cause an avalanche of investment either.
There's no one milestone. There's going to be a progressive adoption everywhere in the world, quarter by quarter, for the next 40 quarters. And when 40 quarters have gone by, it will be deemed to be, cool and new, kind of like the iPhone in 2020. Be like, well, you probably have a digital account, or you have a digital asset or something, don't you? And banks that don't handle digital assets, 10 years out from now, will probably be deemed to be, traditional, quaint heritage banks. Like, kind of like when you go to the boutique bed and breakfast that is styled after the turn of the century, whatever, and it'll be something like that. But it'll be 10 years of just progressive adoption everywhere in the world, and then it will be new and cool and modern.
All right, so the next question we have is from Chris Ritter. Chris is here.
Thanks for taking my question. Strategy is pioneering a new world of digital capital, digital credit, digital money. My question is, what role, infrastructure-wise, does the Lightning Network play in this new world?
I know Lightning is one of the layer 2 protocols. It's not the only layer 2 protocol. I mean, for tech-forward companies, digital wallet companies that want to create really cool apps on a mobile phone, and if they want to do things that are high speed, low cost, they'll probably look at something like Lightning to do it with. And Lightning may be a high frequency, low mid security settlement layer between a bunch of digital assets players that want to swap Bitcoin around. But there's going to be a lot of other types of products that don't require it. I mean, it's quite possible, for example, I just wire $100 billion to JP Morgan and they just pay me 8% and they buy a bunch of digital credit with it, and I just collect the 8% and then I give it to my heirs, and like there is no transaction for the next 100 years. It's like that will probably be a more economically consequential thing. So there's a lot of interesting things that will happen in the space that don't require layer 2s. There'll also be layer 3s that will form at some point. I wouldn't be surprised if you don't see, Zuckerberg roll support for Bitcoin transactions on WhatsApp or Messenger or any of those networks, and you could see it get built into the iPhone and it moves on iMessage. And so they're going to be layer 3 protocols. Lightning is going to be a layer 2 universal protocol. There's going to be, there's always going to be the Bitcoin base layer, and there's going to be a competition. I happen to like Lightning, but I don't think the success or failure of the digital asset future relies upon any one particular layer 2 protocol or layer 3. The only protocol that really is critical to us is the layer 1 protocol, which is Bitcoin. And so the thing that we need to defend, with all of our hearts and souls and all of our intellectual energy, and we need to protect and cherish, is the layer 1 Bitcoin protocol. As long as that isn't corrupted, then you can create a $100 trillion economy on top of it. And then every other, like right now, if you look at, the blocks are not empty. Transaction fees are at an all-time low. There's plenty of bandwidth. That's because the rest of the free market solves the problem of transactions by transacting on layer 2s like Lightning or on layer 3s, whether the layer 3 is an exchange or something else. So I think that there's going to be a very competitive market in layer 2s, and there's going to be an insanely competitive market in layer 3s, and they're going to they're going to create every piece of functionality and bandwidth we need, and they're going to be in a never-ending war with each other. I mean, you're even going to see the crypto networks like Solana and Ethereum and Hype, and they're all going to compete to be a layer 2 to move Bitcoin around one way or the other, or a layer 3 if you want, depends on how you deem them. And so technology is going to evolve. It's really the core base layer of layer 1 from which all value flows. And as long as the layer 1 is protected and not corrupted, then the rest of the ecosystem would be very healthy.
So the next question we have is from Tom White.
Yes, hi. Could you address concerns regarding shareholder dilution from further issuance of shares of common and preferred? Thank you.
Yeah, that's primarily just a short seller narrative or a Twitter troll narrative, because by people that aren't very well informed. We don't do things that are dilutive. We do things that are accretive. So whenever you issue shares, whether you swap them for Bitcoin or swap them for money, if it's a good idea, it's accretive. If it's increasing Bitcoin per share in the near term or the long term, it's accretive. If it's diluting Bitcoin per share over the near term or the long term, it would be dilutive, right? In all cases, for the history of the company, we have never done a capital markets transaction that we believed was dilutive or would be dilutive over the long term. Occasionally, 1 in 20, 1 in 50 transactions is short-term dilutive in order to be long-term accretive, but very, very rarely. So we will occasionally take a slight dilution in Bitcoin per share or assets per share in order, and in all cases it was to improve the creditworthiness of the company, because if we didn't improve the creditworthiness of the company, we created a reflexive lack of confidence, which would be long-term equity negative. But as a general rule, everything we're doing is equity positive and credit positive. If we do anything that was dilutive to the equity, it would be dilutive to the credit rating of the company. And so doing things that are not equity positive or bad business for the credit, doing something which is credit negative is bad for the equity. If the creditors lose confidence in the credit lines dry up, that is, no one wants to buy the credit instruments like STRC, that's bad for the equity. So sometimes you would do something which isn't immediately screaming home run for the equity, but it is long-term good for the equity because it's good for the credit. And we balance the interest of the credit investors and the equity investors in every capital markets transaction. But as a practical matter, you can literally track the BTC gain. It's on our website. We update it every week. You can look at the BTC yield. We update it every single week. If the BTC yield in any given quarter or year or particular period is more than zero, then all of our equity transactions are accretive. They're not dilutive. So issuing of shares is in and of itself not dilutive. That's a sloppy use of the English language, right? When I issue shares in order to create shareholder value, it's an accretive transaction.
Yeah, I think it's just sloppy is a pretty good adjective. We've been very clear. Our goal, what we consider accretive, is increasing Bitcoin per share. So if someone thinks the act of issuing equity is dilutive, then they're just misdefining what is dilutive or not. It's like saying a company that is growing 200% but has negative income for 2 years is losing money versus growing as a company, right? They are early stage companies looking for revenue growth. That's the objectives. And so you have to understand what is the objective of our company. Our objective is to increase Bitcoin per share. We are as transparent as any company possible as it pertains to that metric. We update every single week what our Bitcoin per share is, what our Bitcoin yield is, what our Bitcoin gain is. We talk to all of our active shareholders, our top active shareholders, Capital Group, Morgan Stanley, Fidelity, they all understand. And so I think it's just really either somewhere between misinformed and just trying to get hits on X to say that it's dilutive at this point in time.
I will say 2 other observations. One is I think we're the most shorted stock. I read we're one of the most shorted stocks in the stock market. That's because a lot of people are hedging the converts and I think that the narrative that we've done anything dilutive is coming only from people that are short the stock. I personally have met with hundreds and hundreds of stockholders. I've never met a shareholder that thought we were doing anything dilutive that was long, that was actually holding the stock. So this entire narrative is only from people that either don't own the stock or are shorting the stock, hoping that it will go down. And so it's an ironic proposition. our long-term goal and expectation is we'll double Bitcoin per share over 7 years. But if you look back, we had a 74% Bitcoin yield 2 years ago and a 22% yield last year. So the company's actions have been screamingly accretive, and they will continue to be accretive.
So, Phong, a question for you. Yesterday, Michael showed us the 3-layer model with Stretch as layer 2, digital credit, and everybody saw that with yielding over 11% with the 22% volatility. Layer 3 above it, digital money, has a goal of near 0 volatility. So when you think about Stretch's position in that quadrillion-dollar global asset chart that we see from Jesse Myers, right? $370 trillion in real estate, $320 trillion in bonds, $135 trillion in equities, $130 trillion in money, $35 trillion in gold. How do you see layer 2 fitting into the institutional portfolios, allocating to each of those buckets? And how does layer 2's role evolve as layer 3 develops in the future?
Well, I'd start with that. I don't think layer 2 and layer 3 are necessarily mutually exclusive, right? There are people, one very simple way of thinking about it is if you have money that you need immediately, you need 1 month or 3 month money, right? You probably want to put it into layer 3, right? And that individual or that institution or that corporation that has 3 month money that they want to spend, typically right now are just holding it in some form of a money market, right? Or if you're lower income, lower assets, you're holding it in a checking account, right? And you want access to that money. You want to know that it's going to be perfectly stable so that when you have to pay your rent, or if you get in a car accident, you have to fix your car, or your AP is running a little bit high and your AR is running a little bit low, that you want to have 3 month money, right? And that's where layer 3 comes in, right? That same individual, that same corporation, that same person, that same family, then has everything between 3 month money and call it 4-year money, right? And maybe you're saving, that's for you to put as a down payment on a car, or you want to buy a nice refrigerator, or you're a corporation and you want to grow and you want to hire another 100 people. That's what Stretch is perfect for, right? And in that particular case, right now, where are they holding it? They're also holding it in a checking account, or they're holding it in a money market, or they're holding it in a T-bill. They might be putting it into private credit, which I wouldn't do, right? Maybe a corporate bond, and it replaces that. So it's the same individual, the same corporation. It's just different asset allocation. And of course, then the perfect scenario is that individual or that corporation or that asset manager has money that's greater than 4 years out. And that's where Bitcoin comes into play. The first two categories represent somewhere in the category of $300 to $400 trillion worth of money, right? But it's the same person that should be holding all three, layer 1, layer 2, layer 3. They just serve very different purposes, and it's primarily a duration.
Right, and don't you think with the illiquidity of private credit in particular, which may have a little bit more yield, but way higher risk, and you actually can't access your capital? I mean, it seems like that's a perfect avenue for Stretch right off the bat.
It's a perfect avenue, and I don't understand why people buy private credit personally, right? I've been pitched so many different private equity investments where they lock up your money for 4 years, and they charge you 2 and 20, and maybe you'll get 15%, or maybe 20%, and of course you get taxed on that too. The reason people buy it is the distribution channel gets paid a lot of money to sell it. Right, and so the distribution channel, whether that be private equity, and they have an entire group of people selling out to wealth management and other tiers, that's the reason why people are buying it. And when you have a 4-letter ticker that you can just go buy on the NASDAQ that offers significantly improved characteristics, right? It's shorter duration, better maturities, it's higher yields, it's tax deferred. It pays you monthly. It's just sort of, it has to, like anything, the issue and why I get obsessed talking to banks and others is the distribution channel is controlling who's buying what, right? Which is why I thought it was brilliant that Apple created the Apple Store after they went through the carrier, right? And why Tesla started distributing directly and disrupting and it was regulatory, hurdles, or Uber decided to go straight to give people rides without having to get a taxi medallion, right? We think of these things as sort of cute and novel, a taxi medallion, or even now a car dealer. Well, right now the distribution channel owns distributing private credit. 10 years from now, we'll think of that as cute and novel because people will be able to buy securities, not just on the NASDAQ, but 10 years from now, they'll be tokenized. You'll be able to do it right on your phone, or you might, chip implanted in your brain. You just think stretch and it just appears, right?
I think anybody after this conference is already happening.
Yeah. So I think there is an opportunity for disruption with the product, but there's also an opportunity for disruption with the distribution channel.
Yeah, and we may have time for, if you have time for your question, it is a perfect lead-in to your question.
Well, we actually have a final question. Every room I walk into, every table I walk by, everyone's talking about AI, artificial intelligence, Claude, ChatGPT. And we know that AI was deployed to help you create your preferred instruments. So I just wanted to know from both of you, how are you personally using AI in your workflows, and how should other business leaders deploy these technologies?
Yeah, I'm using AI for everything we do in the capital markets. So we used it to define, to design strike, strife, stride, stretch, stream. We use it to decide how to manage our capital markets programs. So we're using it in order to work through the monetary engineering and the all of the digital engineering issues around digital income, digital yield, digital money, and we'll continue to do it primarily because you've got a mixture of financial issues like frequency, like for example, how many days is it, before what is the logical frequency of liquidity on stretch now? Right. You wouldn't have to wait more than 4 weeks to actually get your money back on stretch right now. But as the liquidity builds and the volatility falls, that time frame goes from 4 weeks to maybe 4 days. And to Fong's point, we're thinking about the frequencies of money and the frequencies, and we're thinking about the harmonics of risk. So I use it a lot to think about risk, credit theory, monetary engineering, and then use it to design digital money, digital yield. Think about how it compares to everything else. We use it to analyze the private credit market and all the other credit markets and the like. So for me, it's pretty strategic in capital markets execution, securities design, strategy, competitive analysis, and communications. And so I think it's critical. The biggest I think question mark for me is just which various AI models should I use in which mode, and then how frequently should I reconsider whether or not it's still the smartest one? Do I need to it's like we used to actually redo the RFPs with our vendors every 3 years, and then it was every year, and you kind of have to redo the RFP with your AIs more and more frequently because there are just more and more capabilities, and you have to reconsider whether or not you need to reprogram the way you do work. But otherwise, I find them to be pretty transformational. And stretch wouldn't exist, digital credit wouldn't exist without AI, right? I mean, I can say that very unequivocally. None of those credit instruments, and when you finish the credit instrument, you can see there's one that's better than the next, and then the next is better than the next, and when you get to the best one, I used to be known for that phrase, there is no second best, right? You find that there really is no second, there's a best, and when you find the best, it's so much better than everything else. You think, why did I even ever waste my time doing the other thing? And the real contribution of AI is it helps you move from the third best to the second best to the first best. And then when you've got something that's really good, it helps you figure out how you make it better.
Yeah, there's really not anything that I do that requires thought that doesn't go to an AI in parallel. Meaning, if you think about our legal department and our government affairs, I have an accounting question I would used to go ask our accountants. Now I ask the AI, and then I would ask our accountants. If I have a question about, we talked about Basel, we talked about MSCI, like how did I figure out how these things work? I go ask the AI, and then I go ask the lawyers, right? And then you go to finance, you go to HR. If I have a question about what's an HR policy, external, internal, what do other companies do? I go ask AI, then I go ask the HR team. And sometimes I don't even ask the team because the AI is good enough. So people probably see I pester them a little bit less. I ask them fewer questions. And then you go to areas like marketing and, our videos and a lot of the stuff that we're doing in marketing now. Translations. We used to spend millions of dollars a year translating all of our code, all of our marketing materials. When I joined the company, we had 14 languages. We decided to go down to seven languages so that we could cut our translation costs in half. Now it just doesn't matter anymore. So our engineering is 4 times more productive than it used to be. And to Mike's point, the hardest thing is trying to keep up with the technology at this point. It's not using the technology, it's trying to figure out which is the better one, which is the best one. Because you ask the AI which is the best AI, and I'm not sure I trust that answer quite yet, right? But it's just what is the best technology, and that's actually fun, right? As technologists, I like seeing what's out there and seeing how quick it's moving, and everybody's studying it. That part is exceptionally fun, but it's crazy. Every now and then, you'll ask some of your vendors, some of your partners, like an attorney that you're working with, do you use AI? And I think they want the answer to be no. I think they're worried that we're feeding, they're feeding our privileged information into the AI. No, not worried about that at all. Worried that they're not using AI and they're going to bill us 10 times the number of hours that they should. So I love it.
There's one other point worth making, which is before AI, there was a tendency to create a team, an accountant plus a lawyer plus a marketing person plus a finance person plus a tech person plus the business executive, and now the geometry of work is morphing into, it's like the CEO or the single business executive, a domain expert, and the AI. It's like, it's like I want the artist, and then me, and then the AI, and the teams are really teams of 2 plus an AI, and it used to be it was teams of 5, or and so the team structure is collapsing almost to like duopolies. Like you need the domain expert, right? Or the practitioner, the one lawyer, the one artist, the one programmer, the one something. And then you need the business person to say, this is not worth doing, or this is, with the taste is like, we're going to take the risk or we're not going to take the risk. I want it, I don't want it. But, if you take those 2 roles, the expert or the domain expert, and then the business expert or and then the AIs just do all the work. It's like the robots do the blue collar work, and the AIs do the white collar work. And so we've consciously worked to slim down teams it's like just me and you. And it's not me only, because the AI is not quite good enough to replace the domain expert. And maybe hopefully they won't ever, because if it's just me and the AI, it's a pretty lonely world. I think.
You and Claude.
I'm thinking 2's a good number. But there's a lot more things where it's like, I'm going to talk to that person, and the 2 of us together will work it out, and the AIs do all the heavy lifting. And there's a lot more of that. 5 years ago, it didn't work that way.
Yeah, you need the 21-year-old who really knows how to run the AI and is unafraid, and you need the person who has some business experience who's going to say, no, don't do that.
Yeah.
And everyone else in between has to be worried. And I see this at times. There's a lot of anxiety when an exec, like when Mike goes and talks to a junior person in marketing, everyone's like, what's going on? They get all anxious, everybody in between. But that's how business is going to get done. So you have to then become one of those two people or one of those three people. That's how you're going to create value, not sitting there getting anxious and being like, what did Mike say to you? Right? Like, and then creating friction. And that's what's happening right now. But it's so much more productive and it's so much more fun.
Totally. Those are such fantastic insights. Make sure to get to know these skills. You need to be able to know how to deploy AI. It's been so wonderful to hear from both of you. Thank you so much. AI and Bitcoin are a powerful combo. You two are a powerful combo. Thank you so much for joining us. Everyone give it up for Michael Saylor, Phong Lee, and James Lavish.
When your dividend is at 0, this is like a normal checking account. You can't hear anything. How about we turn it up to 3%? Well, this is like a money market. Pretty boring. At 10%, this is awesome. But then there is stretch. You see, the numbers go to 11. We can stretch all the way up to 11%.
Stretch your income to 11. We are in heaven at 11%. 11%.
Again, thank you so much, everyone, for coming to Bitcoin for Corporations at Strategy World 2026. We have our reception tonight. We would love for you to join us at 6 to 8 p.m. at Intrigue. And we also want to thank our room hosts again, Latham and Watkins. Thank you for joining us. Go out and build and buy some Bitcoin.